If you could give me a yes or a Y if you have sound. Looks like we've got some yeses. Not getting responses from many. Hopefully everything is okay. Okay, here comes some others. I just wanted to make sure that we didn't have some people without sound this morning. Well, we're going to get into a couple of the topics today that we decided we were going to talk about yesterday. But before we get started, I wanted to just clarify a couple things. I had a couple of emails that were asking about what I was saying yesterday about seeing price go green red and what it meant, and then back red green. And remember, we were talking about that on the time and sales, where we saw prints that were at the same price, like we'd see red 37 and then green 37 and then red 37, and we were talking about what that meant. And a couple of people asked about that, what that indicated for a trade, or how they would interpret that to take a trade. And that really was not the purpose of mentioning that. Maybe I didn't get that explained thoroughly enough, but I just wanted to touch on that one more time. What I was talking about there is when we're watching the time and sales and the prints are at the same price, but the color keeps changing. And so at a case like that, and you see it go red, green, red, green, red, green, it's back and forth, all that's indicating to us is that at that point, you can't hold the level. The buyers can't come into a level and hold it bid, or the sellers can't take that level back and hold it offer, and they're just fighting back and forth. It's just indicative of a spot in time, kind of a sticking point where they're fighting over a level, and neither one is real decisive. The buyers and the sellers, neither one is real decisive and willing to step in and hold that. So the point of doing this, if you can identify that off the time and sales, it eliminates having to look somewhere else to see that it's stuck and going sideways. And you may not even need to use it. I would say that of all the things that you can use on the tape, it's not necessary to process that and think that through. So I would just say keep something in mind here. If you are looking at your time and sales and you see at the same price, and you might just jot this down or write this down, and I didn't prepare a slide for it because it's not something that was really relevant. But if you have at the same price prints come in, and that goes from green print to red print, and you may just write this down, a green print to red print is an uptick if it's at the same price. Now, I don't mean if it printed green 37 and red 36. If it printed green 37, red 37, price just upticked. If it goes from red to green, red 37 to green 37, that means price just downticked. And so you might remember that the coloration is still the same as what we were talking about with our green being buyers, red being sellers. So if it's green at the same price, that means it upticked. Red at the same price, that means it downticked. And again, it's indicative of a state where there's a fair amount of equilibrium at a price level, and neither side is real aggressive about stepping in there and claiming that price level and saying, we're going to take this level and hold this level. So just wanted to mention that as clarification in case others had questions and didn't ask. It's not the foundation of a trade setup, but it can show you kind of a state where neither group is trying to come in. So any further questions on that as far as the meaning or how you would use it, or does that clear it up for everybody? And for you guys, there's a couple that came in late. We were just referring to the topic yesterday. If it fires off red first, if we see a red 37 and then we see a green 37, that's a downtick. Whichever one we see first, if it's followed by one of the opposite color, the uptick or downtick we could say is based on the first print. So if the first print was red and the second print was green, that would be a downtick. And then if it goes back to red, then it would be an uptick. And sometimes you'll see that. It's not necessarily on every market. You won't see it as much on the S&P, but you will see that frequently on the thinner instruments. You'll see that, and I shouldn't say thinner. I mean, there's still plenty of volume to trade, but a dome that's a little bit thin at each price level in the market depth or in the book. We would say things like crude or the YM or soybeans, stuff of that nature, where you don't have 5, 6, 700 at each level. And so they're thin enough. And remember the explanation, and let me just put a dome back in here, if I can find a dome. Remember the explanation of what we're talking about here, and I'm going to just freeze this real quickly with my screen drawing. If these levels are real thin and we don't have many people here at either side, if I came in at this price right here with a sell order, and let's just say that I put a 20 lot sell order here, that's a limit order, and it will only execute against the size that's here. Now, we would do that type of an order if we just wanted to get into a market and we didn't want a market order. We didn't want to get slipped 4 or 5 ticks. We're just placing a market order and we say take whatever's there. So let's say that in doing this at that point in time, we put a 20 lot. Whoop, I got to get rid of that. Get something thinner that we can read. And I apologize. I don't have my. I usually use a bamboo pad, and it's a lot easier to write than my mouse, but I don't have it plugged in right now. We put a 20 lot there, and let's say that on this side, the bid, there's only 14. And if we put that 20 lot in, we're going to get an instant execution on 14, and that's going to clear that level out. In other words, it was a downtick, and my 6 is going to be left here. So if that's the case, it would appear that the offer just stepped down. We just took a level, and in reality, it was just one order that did it. So at that point, if somebody else steps back in, let's clear this off. I now have a 6 sitting here, and somebody comes in over here, and they put a 20 lot order to buy. That clears off my 6, and that leaves them sitting here with 14. And so in essence, what happened with the market is it would appear to us that market downticked and then it immediately upticked. And it's not just that it was a red-green print, but actually the whole book stepped down one level and then it stepped right back up one level. And where you see this on these thinner markets or thinner domes, you see this frequently, and on the S&P you'll see it to a degree, but not as often. It will still happen many times a day, but it just is showing us that at this point nobody's really willing to step in and add to that 14. And if he gets filled and somebody has a large market order, then we're going to see it appear that price is just ticking up. Whole book ticks back down. Whole book ticks up. Whole book ticks back down. When we see that, we don't necessarily say there's a trade, but it is a warning to us that right now they're not opinionated enough to get in here and move the market around and do something to it. Yeah, Pete, you ask, that'll happen if you hit the bid button to go short on the ES. And let's say that you had a 20 lot there and you came in here and you hit the bid button. That would put your 20 lot right here. It would hit the bid, and so it would leave you with 6 if there was 14 here. Exactly. If you say sell at the ask, that's going to just join you into this existing offer, and you'll be at the tail end of the queue. And if market buyers come in, then you'll get your fill. So just for people, I don't know if you guys even use these. I have them visible on my dome. I don't like them. They're too small. I like the way it appears on the chart trader better because you've got a bigger button, and in here it's just too easy to miss it. I usually would use a hotkey, or I would just come down in here if I wanted to sell I would just come down in here and click which would sell me at the best price, or I would come over here if I wanted to buy. I would just click up above price, and that would just fill me essentially at the market. Yeah, Pete, you asked, so my 20 lot would effectively tick the inside ask down for a second. Correct. And if you had a order submitted that was larger than what was there on the bid, that would tick down and stay there until a market buyer came back in and hit you, because your order would just be sitting there. Whatever wasn't processed would be sitting there waiting to execute. So I wanted to readdress that briefly, just because we had some questions about it, where individuals were wondering what it meant and how to interpret that, or was I calling that a trade setup? And no, I was not calling that a trade setup. It was just, when we see that happen, just be warned that it's very two-sided right there. Now, it's not necessarily a warning to flag you out of the trade completely. Let's think about some situations where we might see that happen. Remember, we were talking about identifying reversals. We come back up, we're up at a resistance level, and as we come up to that resistance level where buyers have just been in control the whole time, when we start seeing that kind of behavior and the buyers can no longer hold a level, we're going to see this type of behavior on our dome. On the dome, it's going to tick up and tick down. The book is going to move up, the book is going to move down. But when we look at this on our time and sales, if we're not looking at the dome, that's where we're going to see red print, green print, red print, green print, but it's all at the same price. And it just is telling us it's ticking up, ticking down, ticking up, ticking down, and neither one can hold the level. So if we were identifying this point in time as potentially a reversal, it's starting to give us a little bit of confirmation. To me, it's not as good as seeing ton of big sellers start hitting it, but it is starting to give us some confirmation that the bulls are losing their momentum. They don't have the same gusto they've got up there, and now they can't take a small offer and clear it out and then move into that space and keep the price. So hopefully that clarifies it. For those of you that asked the question, I appreciate your patience. I just mentioned in the email that I would address it again this morning. But if anybody still has a question on that, throw it out there now. I just wanted to clear that up before we started in this morning. So no questions there. I'll go ahead and just clear this off then. We'll get rid of that. The topics that we're going to go through here for today, let me get the disclaimer screen up there real quick so it's in there and in the recording. We're going to again be talking about some hypothetical trades today, and so just keep that in mind as we're talking about these trades, and we're looking at the time and sales, and we're looking at the dome, and we're looking at charts. We are going to be talking about hypothetical trades. Obviously, you guys figure that out. If I'm not taking the trade on a live account in front of you, it is hypothetical. For some reason, the CFTC is fixated on hypothetical trades, and they think everybody apparently gets confused and can't tell that it's not a real trade. So anyhow, our topics that we're going to go through today, we're going to look at some proxies for tape, and by that what I'm referring to is for guys that just say, man, I can't get my mind around the tape, around the time and sales. What can I use to give me as close as possible the same thing? Then we're going to talk about taking an action plan. This is what I would say for the day. When I sit down, I want to have a plan in my mind. I have some scenarios already laid out. I'm going to come in here and build this plan so that I know what to do when price gets to where I'm at. And then I'm going to go through some information about using price levels. And maybe I could just get a little feedback from you guys here before we get too far in. Do you guys tend to prefer in your trading right now, and you could just type in a one-word answer, do you prefer a price level, or do you guys tend to look at like channels and uptrend lines and things of this sort? And when I say that, do you prefer like a horizontal price level where you just have a number in mind? You're just looking at 12.25 and a quarter, and that's going to be your level that you're looking at? Or do you tend to look at uptrend lines, moving averages, don't so much look at levels? Okay, so a lot of you are commenting on that you like horizontal price levels, you like, some are saying support and resistance levels. Um, I think we've got, I can't remember, one of you in here is into market profile, and I can't remember who it is. Another one, moving average first and then levels. Okay. Yeah, the channels, we'll talk about that a little bit as we get going. Somebody remind me, because I wasn't planning on talking about that. But the channels can be a struggle. The I think the key to channels is identifying them very quickly. Okay, so someone else says horizontal price level is a guideline, and then it would be other things, moving averages or something of that sort. So anyhow, so we'll take a look at this then, as far as the proxies for the tape. And actually, I'm not ready for questions yet. I'm going to get rid of the presentation here, and we're going to put up just a little small workspace. So what I would encourage you guys to do, if you've got your time and sales that we were building, where you've got the filtered time and sales and you've got an unfiltered time and sales, let's put those together here and get yourself your little workspace set up. I'm going to have two time and sales. One of them is filtered, one of them is not. I'm going to change the filtering on this one. This is on the S&P. I'm going to change the size filter to 20. And then I'm going to bring in a DOM, if I can find the DOM. And again, like we were talking the other day, I'm going to get these up here as close as I can. Narrow them down just a little bit. So if you guys can make yourself a little workspace, something like this, and then that way as we talk about things, if my voice is coming in and it doesn't match the video, you can look at your own. If you don't have the screen space to do that, you could look at mine or just look at your own. I would say one or the other. This is going to come through a little bit choppy, and so it's not going to be probably completely clean. It's going to move up and down, and it may blank out and turn black, and it's going to look like it's on some kind of a massive delay, where you're just getting an update here and there. But that's just it'll be clean on the video. So I do have one question here. Somebody asks what happened to the Euro trade from yesterday. So before we get too far in there, I'll throw that in there. The Euro trade, this is a 1 hour chart, and I'm going to just turn on the historical trades. This was the long entry, and you can see up in the upper left corner of the chart screen, bought 10 units at 40.48.6, and here was the exit, take profit of 10 units at 42.50. So when you take the original spread into account, got a 200 pip profit on that. But just to show the scaling and I should say the scalability of this, where you can tailor it to any size of account, that 200 pip move, I made 20 cents off of it. So I don't know that I can buy a sim stake, but at least it was 20 cents of real money and not sim money. And that's kind of the beauty of doing this. You see these little trades, and you take something on a trade, and it's still real money. It still makes a difference. Even if you're just trading a $5 account, I would still suggest, for anybody that's looking to improve here, it's still going to be better to have something like this to do on the side when you're nervous, when you're not thinking clearly. It would still be better to come over here and do this with small money, to me, than it would be to do it on the sim, where there's just nothing remotely realistic about it. At least here it can still matter to you. So it was a nice gain. You could brag about 200 pip gain. To be able just to take that and let it go, great. But you wish you had the whole contract there, because it would have been a $2,000 move on a full lot. So anyways, that's what happened with that trade. I'll get that out of the way. Somebody was asking, and it did. Yes, it did go up and hit the profit target. I just left the profit target there, and it was up 90 pips last night, roughly, when I went to bed. I just moved the stop to break even, and even though there was nothing there, just for the small account, I would still manage it that way. I get up 80, 90 ticks, I'll move my stop to break even on it. I do that on my swing trades. I may wait on a swing trade till I'm up 150 or 200, and then I'll get my stop to break even. Just because the euro can pick them up and put them down, and really, really can make some serious trend moves. So, okay. So anyhow, we're going to look at some things that we can do if we're struggling with the tape, and a way of approaching it to try to still get the same information or the bulk of the information. And this is how I would go about setting that up. And I'm gonna take this here and say, for our purposes, as we're trading, we would have this layout, and then either to the right of it or the left of it, whatever our preference is, we would just have a chart. Just a 5-minute chart or a tick chart, whatever type of chart you prefer. But that would be, for me, the most I would have on any instrument. I don't have 4 charts or 6 charts open on an instrument. I have one chart. It's usually a short-term tick chart. That chart is compressed to the point that you can't see the candles. And then I will have a time and sales, and I will have a dome. And I will have that for each instrument that I would be looking at. On the chart, I can set some alerts and so forth, and we'll go into that when we start talking about the action plan. But let's just try this, and maybe you can try this. If you've got my window up, do it on mine. If you've got yours up, it would be preferable to do it on yours. But let's say that we were trying to identify the uptick, downtick that we were just talking about earlier. And we could look over on our tape, and we would see that where prints, and let me just freeze this right here. We've got prints at 13 red, and then immediately prints at 13 green. Remember, the red print was first, and then it went green. So remember, whatever color goes first, that's what happens. So price just downticked. The book just downticked right there. If we can't see that here, then having this setup will allow us to see that book tick up or move down. So how do we do that then and still get the other information? Well, let's go back through the 7 things that we talked about, that we said this is going to be key things, and you may get 4 or 5 of them, you may get 2 of them, but some of it will occur at every reversal point. And if you've picked a good level, a good reversal point, it's enough to trigger you into the trade. So let's just focus our eyes, just for a drill here. Focus your eyes right here on the center column, and I'll just highlight that here. Get in the center column of your time and sales, and if you've got your last print shown in gray, then keep your eye on that, and don't worry about reading whether or not it was a 1 lot or a 3 lot or a 2 lot, because it cannot keep up. It will not keep up with your time and sales. But as you focus on that, what you're going to end up doing is, out of the peripheral vision, can you still read the speed of the tape? You see it sit there slow. It's not coming through real fluid. You can watch it tick up, watch it tick down, but you should be able to see that on both sides. Now, if you can't, you may need to move back a little further from your monitor. I don't know how close everybody sits. I tend to sit about I probably sit about 3.5 feet, 4 feet from my monitor, but I've got a pretty good sized monitor. You should be able to see all of those simultaneously. So let's just think about this for a minute. If we can watch the dome, is that going to be easier to you in terms of finding out where it's upticking and where it's downticking, or is it going to be easier to interpret that from the tape? And I have to say, for the vast majority of people, that's going to be easier to see watching the dome and then letting the peripheral vision take care of the speed. So we want to see if it speeds up or if it slows down. Can we still do that without just staring straight at the time and sales? And you have to say yes, you can. Now let's try something else and just see if you can do this or not. As you watch the center column, can you tell whether or not you've got double digit print or single digit print? So each one of you, it's going to depend on how close you are, what your font size is. People will have peripheral vision where some guys got, they're like an owl, they can see behind themselves. Um, it really varies from person to person. Yeah, Gerardo, your glasses come into play too. So get looking at this though. Can you see a double print or a triple digit print stand out as different from the width of the column? Now I can actually do that. If I'm looking clear over here at this side, I can still see whether it's a double digit print or a triple digit print. It's some people are real sensitive to that, others aren't. But if I can see it from over here, I for sure can see it from here in the middle, or watching this level, right here. So it's only an inch away from the green column to here. So if we were going to do that, then let's talk about several of these 7 factors. Remember, we had 7 factors that we were looking at when we're identifying reversals. We see the one lot buy order speed up. Can we see that with our peripheral vision using this setup? Yes, we can. We see the large buy orders disappear. Can we see that while we're still looking here in the middle column? And I would say yes, you can still see that, because in peripheral vision, if large buy orders disappear, you're not going to see green prints dropping in. You're not going to see half of that screen move down green. You're going to see it red. You can see that out of your peripheral vision. Whether it was a 127 lot or a 20 lot or a 50 lot, it really doesn't matter. We just want to see them dry up. So can we see that while we're still watching the dome? Yes, we can. Another factor, the third factor we talked about, was that the speed of the prints frequently will slow down. If we come in like a last ditch push, the tape is just screaming, and they come in there, this last ditch effort to try to drive it through a level, and all of a sudden it slows down. Can we see that? Yes, you can. Brian, you asked a question. Would you suggest the middle of the dome be up near the top of the time and sales? I have mine typically sitting just like it is right now. The difference is that on my monitor, on my big monitor, I will have twice as many lines on my time and sales, and I will have twice as many, I shouldn't say lines, but rows, twice as many rows on my dome as well. So because of that, the middle level is not near the top. For me, it's going to be 3 inches, 4 inches below it. If that gives you trouble, you can just take your dome and use your scroll wheel. You can just move that up so that they're up closer. But I would say that's just going to be personal preference. It doesn't bother me. I could scroll and I could put the book clear down here near the bottom, and I can still see what I need to see out of the peripheral vision. But it's just whatever's comfortable to your eyes. If it's easier to scroll up a little bit, you can just scroll it up a little bit and look at it there. But anyway, speed of the print slowing down, we should be able to see that just as easy as we were able to see them speed up. Peripheral vision, it's either frozen or it's moving slow or it's moving fast, and that's easy enough to see. Then we've got our fourth factor, the flurry of sell orders. We get a flurry of sell orders, and we define this especially when we come up into a high. First time sell orders hit it, we see the flurry, we see it turn red, moves the price back. We see price tick back 1 or 2 ticks, and then as it tries to come back up, it's really slow recovery. Well, that will probably be easier to see here than it would be on the tape, because on the tape we might see 50s print. We see it get knocked back a tick or two where we were getting some 13s, and we see 50s print, we see 50s print, and we see a 75, and it's right back to 50s, and there's 4 75s go off, right back to 50. When we're doing that on the tape, in some ways it's probably easier on the dome to see the recovery. But again, this is just If you need to watch both, watch both. If you can get it off the tape, then get it off the tape. I would encourage everyone try to get it off the tape, but if you do this for 3-4 weeks and you still feel like you can't process that well, then I would go this route with it. Or if you've already been looking at the tape and you just can't get yourself to see it, go this route, use the dome in there, and let the tape primarily be for your speed, and the momentum and the shifts in speed, and then look at the dome for your numbers. Now the fifth level we were talking about earlier this morning, that's the level that we're talking about where the buyers come in and they clean out the offer, but they cannot get the bid up there and they can't get the bid to stick. They can't firm it up. They can't keep it running there. Again, if we're watching that on the dome, that's going to be easier to see in this setup than it would be to say, we're going 13 red, 13 green, 13 red, 13 green. We can see that book move up and down very easily when we're just sitting there looking at that. And then we've got the sixth point, which was specifically on the dome already anyways. Remember, that was that when we're sitting there on the dome, there may be a small offer out here, and this offer is not hit. Let's say that we get on the S&P, we're down to 60 or 70 contracts that are out there on the offer, and the bidders, the market buyers, will not come hit that. Let's take the reverse scenario at a bottom. We may have a very small bid, but the sellers will not come hit that and clean that out. Again, that's something that we're looking at specifically on the dome already. And yet while we're watching that, we can still see the speed or the momentum of the tape, whether it's varying, whether it's changing, is it starting to accelerate and so forth. And then the seventh factor that we talked about was seeing large sell orders. And the large sell orders, remember, we're talking about several rows on the large side dropping into place at the same time. Remember, we talked about that with the changes where we might need to see 15 or 20. So we gauge the height of our screen, count off 15 or 20 rows, and then just keep that in mind. If you see that drop in all at one time, all at the same timestamp, very likely that was a large market order. At the same time over here, you'll probably see the whole screen drop because there will be ones or twos or threes or fours, and you can still see that very clearly because we've got it color coded correctly, and we can see a big block of red hit it and a big block of red drops into place here, and the green that was visible is gone. It's off the screen. We're able to see that very easily while we're watching the price tick up and down over here. So if there's questions about this specific aspect of what I'm talking about, put the questions out now. We'll address it right now as we go through these things point by point. But like I say, this may feel comfortable enough to you that you just start doing this right now, and it doesn't matter. We're just trying to get the same information. So if you have to get it from this setup versus just the time and sales, and that's easier for you, who cares? We just want to be able to get this information and then be able to interpret it correctly and use it to trigger our trade. So those factors that we're talking about on the tape, we can use this together without just staring at the numbers and trying to memorize 13 even, 13 half, 13 even, 13 half, 13 even, where's it at? 13 even, 13 half. If we can't memorize that, do it this way. So if anybody's got a question there, put a Y or a yes. If I see a question come in after I move away from this, I'll still address it while we're recent on this topic. But let's get that out of the way right here. Karen, with your comment, sometimes you see what you think is a big block of sellers, and then it instantly heads the other direction, and you've seen this on the YM. I think one of the reasons you always, I think, keep in mind the market conditions. And if you look at a daily chart, what do you see on the daily chart? Is you've got an irrational, getting close to 40-day move up, and the sellers have not had a whole lot of success really at any point over the last 40 days. So you will tend to see more of that where it doesn't work, and we're going to go into that when we talk about getting an action plan for the day. But if that happens, remember, one of the things we want to see is, are they getting results? I frequently, and I vacillate back and forth, and it's probably something subconscious that I couldn't even explain why. But I will vacillate back and forth between taking the trade on the first push into an area and then taking the trade when it moves up and pushes up into a high, taking that trade on the next retracement when I see whether the sellers are there or not. And I'm going to go through that more in a little bit, Karen, as far as what I would look for when we get the second push back into an area. I'm going to go through that when we put a chart up in here. Jose, do I place the chart in the same monitor? I do. I only trade on one monitor. The monitor that I'm displaying right now to you guys, the screen that I'm displaying to you guys, is a little 19-inch monitor, and I use that monitor in the room, and I just put 4 charts up. The charts don't clog the bandwidth down very much, and that way when I'm in the room trading with guys, if I take a trade, it's visible immediately. I don't look at that monitor. It's just there. It's just displaying a screen, and if I'm going to point something out to them on a chart, I can go over there and draw on it, but I don't sit there and look at it. So for my trading, I use one monitor, 32-inch. I will have on that monitor 3 instruments open. One of them is just a chart only. That would be the 6E, and then I would have a DOM, a time and sales, and a chart for the S&P, and I would have a DOM, a time and sales, and a chart for the crude. And all of those things would be on that 32-inch monitor. So let me do this. We've got on the recording enough time here. I'm sitting at about 35 minutes. Let me refresh that, and we'll take 2 minutes here while I rebuild that file, and then we'll come back and we'll start looking at some things we can do on the chart to try to get the same information. Okay, so that's all set and ready to go. Andrew, are you saying sound, is it consistently staying real low for you, or? Oh, sorry about that. How's this? Has it been that way all morning, or has it been okay? Just now, I when I stopped for a second, I took my mic boom and I moved it up on top of my head, and I didn't want to knock it off when I went out. I went under the desk and plugged in a USB, so I had my bamboo pad, and just about had knocked it off, and I forgot to put the boom back down. So thanks. That's probably better than having the whole morning thing recorded with no good sound. So okay, so here's what I'm going to do. Again, we are looking for things that we could use kind of as a proxy for the time and sales if we can't figure it out. So what I'm going to do here, don't beat me up. I am a price action guy. For years, I haven't used indicators. I do show people occasionally at times how to use indicators, not in the way they were intended, but in order to get something different out of them. And so I'm going to show a guy how he could go about doing this from the standpoint of looking at a chart with an indicator to try to get something that would come fairly close to approximating what you would see on the time and sales. So again, like I say, bear in mind, this isn't necessarily because I use it, but if you can't figure it out any other way, I still want you to be able to get the same information. So before I put the chart up, I'm going to just address a couple other comments that came in. question here from Karen. When you get time, can you let us know what tick amounts you use on charts for various instruments? I tend to go fairly short term, and I have something that I like to see kind of as a criteria when I look at a tick chart. This is just a result of me being anal, but I cannot stand to look at a chart where every candle is either a real body or a hash mark or a wick. And by saying that, let me just put this up. Let me change my time frame. I'll just put a chart in here, and we'll get it in here as I answer these questions. Let's change this here down to a 50 tick, and this will be on the S&P. And I would say that a 50 tick, there's going to be basically a tremendous amount of 1 tick tall real bodies or just a little tail. And when I look at that, even if I take this and make it fatter, to me, I can't stand looking at that chart. Range charts would never work for me in a million years, because I cannot stand a candle that doesn't look like a candle. And it's probably just too many years of looking at 5-minute charts and candlestick charts and candlestick patterns. And so when I put that up, I cannot stand the way it looks, because to me there should not be this many full body, no wick, no tail on it. So when I try to set up a chart, I want it to have candles that actually look like candles. But I tend to prefer tick charts for a couple of reasons. If I just put up a 5-minute chart, and let's just change this here. When I come into the overnight session, it starts to get pretty ugly to me on many instruments. And I do chart a 24-hour chart. I start it at 6:30 Pacific, which is the broader market open. So that being the case, frequently on instruments, like if you look at the NQ and you look at this overnight session, I can't stand the way it looks. The S&P is doable, the 6E is doable, but if you put this on the NQ on the overnight chart, I can't stand the way it looks. It just messes with my eye. So that's the primary reason I use tick charts. It's not because I think they're better, but there are some advantages to tick charts that we can get if we understand them. It just leaves something that's more natural looking to my eye. So when I break that down for the S&P, what I would find is that first thing in the morning, when the market's flying, it needs to be at about a 500 tick to leave me a normal candle. But the 500 tick will still give me a reasonable chart overnight. And see, when I take this to the 500 tick, I can look at these candles even when I blow them up, and they will have 2-3 tick, maybe a point bodies. They will have a little bit of a wick on it. It looks like a normal candle. So S&P, I would say 350 to 500. And it just depends on whether it's first thing in the morning or later in the afternoon. I don't think there's something magic about a number. The YM NQ, I had always done those at an 89 tick, and I got into a thing for a while where I was using fib numbers on the charts. When they changed back in October, I had to stretch that out a little bit further, so I would go to like a 200 tick on the NQ, and then I would be on the YM. I still left it at like an 89. I don't think it matters. Around 100, 125, 150. That's long enough that it gives me what I'm after, but it's still not going to get me these little frinkly looking bodies on the candles. 6E, I actually do the 6E on a 5-minute chart. The 6E is active enough overnight. It still builds a very clean chart, and don't bother me at all to look at that on a 5-minute. Crude, I usually use a 200 tick on crude, and if I want to see more history on crude, I'll just change it to a 2000 just to look at some levels, but then I'll go back to the 200 for the bulk of the trading. Now, just one thing that I do with it on any instrument I trade, I will take that and I will completely compress the time axis on the chart as far as it will allow me to compress it, because I don't care whether the candles on a tick chart have a topping tail or um, bottoming tail, or whether it's an engulfing candle. It's irrelevant on a tick chart. I'm looking at the swings, and I want to be able to come in and look at the day's action and say where were the highs and where were the lows, and that's what I'm interested in, is these swings in price. So I will put a tick chart on there because it will allow me to see those swings easier than a 5-minute candle. So I think you guys that have been with me in the room have seen, with Ninja's charting, you can put a box candle up behind this candle. Are you guys all familiar with that, or is that something that you guys haven't heard of? I'll throw it in there. Somebody asked if I could show them. This is a feature that's on version 7, and I'm going to come up here on my chart toolbar. I'm going to come here to the data series window, and I've already got the S&P in here at a 500 tick, and I'm going to add that contract again. And then for time on here, I'm going to show this as a minute chart, and I'm going to put it at a 5-minute setting. I know a lot of people either do 2-minute or 5-minute candles, but what I want to do is a 5-minute chart, and instead of doing this as a candlestick, I'm going to do it and call it a box. I'm going to change the color of this to a lighter red, and I've got a light red and a light green, and I'm going to set this, I think my tick chart is 10 days, so I'm going to set this to 10 days so they stay the same. And I'm going to make sure that I have this set at my 6:30 open time on both of these. That way they both show the same open, they both line up with each other fairly well, and I'll go ahead and apply this. Now what this is going to do is this is going to plot two different ways on the S&P, one in the top of the screen, one in the bottom of the screen, and I'm going to just grab it here at the bottom and I'm going to drag it up to the top, and now I'm going to have both of those overlaid on top of each other. And when I broaden that out, you can tell that you can't see my tick candles anymore. So I'm going to come in here and I'm going to hold down shift. I'm going to select price. I'm going to hold down shift and I'm going to scroll. And I'm going to bring this so that my tick candles actually come up on top of these 5-minute boxes. And what the 5-minute box does when I widen this out, and let's change the, I need to get a shorter tick count. The 5-minute box, if it opened higher than it closed, it's going to show me a red candle. If it closed higher than it opened, it's going to show me a green candle. But that allows me to see the actual action inside of each 5-minute period. So each one of these boxes is 5 minutes long, and you'll come in there when the market is really moving, and you can see frequently how much wiggle there is inside of a 5-minute candle. And it is one of the advantages to using a tick chart, is that you can see the little thrust and the little waves back and forth, and yet on a 5-minute candle, it may only be it looks like a continuous move down. For example, you take this candle, where it moved down, moved back up, and it moved back down before the end of the candle, and it would have looked like a negative candle on a 5-minute chart. But in here, we could see the little swings moving back and forth. So, you could take this even more extreme if you wanted to. You could take your minute candle and make it 15-minute periods, and you might play with this. It just depends on the instrument you're trading. And I'm going to tell it to reload all the data just so it refreshes everything, because I've changed time frames here. It'll take a second because it's going to reload it all on both a 15-minute and a 150 tick. So it takes a minute to load that and process it. Sorry, it's definitely running slower. I'm taking a lot of bandwidth with the presentation and everything that I've got going here. See, we can go back and we can look inside of that first 15 minutes, and look at those wiggles, and we can see indications for trades that we might never have taken if we were just looking at a 15-minute candle. And so there is some value to the tick charts just because of that. When I start looking at those levels on a tick chart, and I see it break off over this swing high, I very well may say, the next pullback, I would like to get long there, see if we can get a scalp out of it. We come in here and we sell off, and we come back down into the low. On the tick chart, you have to say you saw an attempt to buy it, and it came back and tested the low again, and then they pushed it up even higher, and they came back, left a higher low. To me, that says, hey, you see buyers coming in there. There's a long entry. We're testing that low. We've got 3 points of room to the upside. There's a chance to nibble at that and take that whole thing. The ticks, Tom, that's up here in the corner, left corner, 150 tick. Nothing magic about it. I'm not saying trade this. I'm just trying to illustrate that in between, there's a lot of wiggling going around that can give us indications for trades, and that's why I do like the tick charts. But it's kind of taken us away from what we were going to discuss, but hopefully it's something that's beneficial to look at as well. And what I'm going to do, I'm just get rid of the chart, and we'll go back to the tick chart. And I'm going to switch that back over to my 500 tick. Here's something, again, there's some tools that you can use. If you use version 6.5, someone programmed, and they may have it available for 7, I don't know if it works on there or not, but someone did program a time and sales that will print on your chart, and you can actually print that right into the chart down the right hand side. You can set up your configuration just like the time and sales now. It's a 0 time compression on it, and that has been out there. I think there's a couple of them out there that have tried to do this. In fact, I think Karen, you sent me one a while back, didn't you, to forward to Pete? Is that what that was? Was that I can't remember if that was a time and sales, but I know there's a couple of them on Ninja's forum. Oh, that's right, that was the dome that printed on there. I couldn't remember what it was that it printed on the chart. It would print a little version of the book on there, or the dome on there. On Ninja's forum, there are a couple of different indicators that will put your time and sales up on the chart, and so you can print it right on your chart and look at your chart. Essentially, what it's going to do would be like having your chart back over here, and then it would be like having your time and sales over here on the side, and then your price axis would be off visible there. Now we can do the same thing simply by telling this to stay on top. We can still have similar feature where we've got that time and sales just right on our chart platform. But again, we want to say, what can we come back to on a tick chart to get the same type of information that we're going to get on our time and sales? Well, there's some things that I would tend to look at on a tick chart that I say would correspond relatively well to the tape, but it's going to be slower. And this type of a scenario, I think if a person had to do it, they would basically be waiting for confirmation more so than you would get off of your time and sales. But I look at it like the information that we had going back into the open, where we came down and tested a level, and I'm going to make this a little bigger just so it's visible. I tend to prefer areas where we come down and we test a level, and I do like to see a new low as opposed to coming right to the low. I would rather get a new low by 3 or 4 ticks. But I like to see a scenario where they pushed price back up and some buyers came in. We know they came in whether we saw them on the tape or whether we saw it on the chart. Some buyers came back in to a degree and got a little small move up. Is that big enough there for you guys? Let me know if it's too small. I'll try to make it a little larger here so you can see it. And maybe I could just highlight that as well with a screen draw. Where I'm talking about would be this little move here. We've been in a downtrend. and we come down into an area where we could say this area, there probably is some support there, and we see the buyers push it back up a little small move, and then it comes back down to that same low again, and that's frequently where I start to look for trades. And at that point, I want to see if they didn't get a new low here, do the same buyers come right back in on the tape? Do we see any aggression come back in on the tape? Now, if we were looking at this on the tape over here, essentially we're going to say, does this turn green? You know, do we start seeing immediately like half our screen start dropping green just in one tick, showing us that some buyers are starting to flood back in? Well, if I do, I very well would take the trade right here at the bottom. So could a guy do this on the basis of a tick chart alone? At that point, it's going to be a little tough. It's probably a little dangerous because you could just keep right on going through the low. The next push up, though, it broke this high. So and where I like to see this isn't the greatest example in the world, but it fits, and it was this morning, so we'll just leave it here. If we've had a series of lows where it tried to push up and it sold off again, and it tried to push up and it sold off again, if they finally get strength to get above a prior swing high, that is really noteworthy to me. And what I would be looking at that point is the pullback. We get the next pullback, I would be watching very closely at that 50 to 618 retracement level, about half of the move. I don't draw the fib on my chart, but I just look at the chart. And visually I say that's the number, that's where I've got some interest, is halfway down. Now for you guys that have traded with me in the room, you know you hear me do this a million times, is I will say if it gets down there and we see the buyers come back in, I'm going long. So I've got that scenario in my mind ahead of time. So I have to say, could a guy just do this on the tick chart? Could he look for that same type of behavior? Well, you could, and here's the problem. Your signal is probably going to catch you somewhere right in here. You know, you're going to see this candle turn green, you see this one start pushing up, and you're going to say, okay, they're definitely buying it. And the problem that gives me is now I don't have a whole lot of room. I've got to get over this high to continue if we are going to start an uptrend, because now I've got a higher high on a very short-term basis and I've got a higher low, but until I get over this high, it's not free and clear. So if that's the case, the tape frequently will get you an entry right down in here, where the chart will get you an entry up here 2-3 ticks worse. But could you take that on the chart itself and still make it work? And I have to say, yes, you could. You could still take that same basic information. But if you can combine that with your time and sales, when you see those buyers coming in and they've just started showing a little bit of strength for the first time, you know, when it broke this high, now you're in a scenario where you can safely say, hey, where's the possibility of a target? Well, when I start picking targets, I like to get trades that actually move. I don't like, in my personal trading, I'm normally not shooting for little, 3-4 tick targets or 5 tick targets. I'm looking for 10-15 point moves. That's what I would prefer to have, because I know I can sit on it and ride it for that long. But if a guy was just scalping, to me, you've got to look over here and say, when you come back up into this area, that's where your resistance is going to be. And so I look at this and say, if I've got an entry down here, and when I say down here, let me just let's just take this across. If I can pick an entry up down here on my tape, you know, I'm looking at 7/4. And if I've got a target up here at 9/2, that would be a logical place to me to take off a piece of my position. And if I'm 2 points or 2.5 points away, I actually could take one off in the middle as well. And I get my stop to break even. And then if we get up here and break this high, I'm still going to have part of the trade left, and I'm going to take a runner. So I will judge very quickly how much room do I have overhead. And then when we pull back, when the buyers come in, I will take the trade. Now there are times, and again, as I mentioned a minute ago, it's probably something subconscious. There are times where I will hit that on the first move. There are times when I will hit that on the second move. But more often, I will wait until it has broken this prior swing high and then take the next pullback. Now I'm going to clear this off, and I'm going to show you why I feel that this is important and why you can use this as a proxy in a way for tape. When we take this move right here, let me get rid of that. We take this move right here, we were just able to observe over the last 3 minutes, we were able to observe buyers do something that they hadn't been able to do since the open. And that was to start breaking prior swing highs. And if we've seen that in the last 3 minutes, we have a fair idea of how fast the tape is moving if we're sitting there watching. It doesn't mean that we have to be fixated on the tape trying to memorize the numbers, but at a bare minimum, at any given point, I want to have an idea of how fast the orders are coming in. So we look at this and say, okay, at the bottom of the screen, 50 lines down, it's 8 seconds. Top of the screen, 47. So I say, well, okay, there's 39 seconds there on this time in sales, 39 seconds to get 55 ticks. If I realize that this accelerated in here and I have an idea of what the speed is, that we're getting, a tick a second, a tick every second and a half, when this pulls back, what I want to see is, do they come back in, do the buyers come back in as aggressive as they did right over here the first time? And I think most of us could remember 3 minutes ago how quickly it came in. It's an area of interest. We're right down near the low, so we're already watching it. We've turned our attention to the tape. We're looking at the speed of the tape. We see them push up. They see the first little glimmer of success down near support, and it pulls back. The sellers are trying to push it back. Can we remember that from 3 minutes ago? And I would think that most of us should be able to do that. So again, if you can't do that, what would you have to do on the tick chart to get the same setup, to get the same confirmation? You're going to need to see a green candle, and you're probably going to see half of that candle, and you're going to get a fill up here a little higher. And you have to determine, if you're doing that, do you still have room to get up to a logical target? Or are you, do you sit there 4 ticks below resistance? If you're 4 ticks below resistance, it's not a good time to be going long and hope that you can get a nice trade off. So I don't know if this makes sense, but when I trade over the years, this trade I have probably put on, I would say I have put on probably more than all other types of trades put together, is coming into a low, coming into an area of support, coming into a prior swing low. I see the first little change of strength, and I'm willing to gamble on it because I don't need much of a stop to prove me wrong. If it breaks the low and just keeps on going, I'm out. It doesn't take a whole lot to prove me wrong. But the thing that always interests me is since the buyers just came in right here, do they come in again right here as soon as we push back again? Now, if they don't come in, what do you do? See, again, this is one of the goals of reading the tape, is not even as much the entry, but does it keep me out of the trades that are losers? If we take this little push down and you see the sellers just accelerate and the buyers don't step right back in, this thing is breaking through the low and you don't take the trade. So you may give it right up to the low and say, I will let it pull back clear to the low, and at some point down in there, if buyers come in, I'll take it. I say some guys, would probably have better success waiting for a 318. I'm sorry, a 382. But it just varies on people's trading and preferences. It retraces often enough to the 50 to 60%. I feel like a lot of times if I just jumped in around the 318 at the first little shot of buyers, I probably am going to sit a little bit of heat on that trade, which I don't want to do. I don't know if you guys have questions about that, but when I look at this, just from pure candlestick action, it's going to look considerably different if you were to look at this 5-minute period on candles, because essentially on a 5-minute candle, you're just going to have two candles side by side there that close near their low. If I come to a tick chart, I can start to see a little bit of that pushing back and forth and try to take advantage of that. Now it's not necessarily, well, it's not even remotely reading tape. But if you were reading the tape and you saw it push down to 1207 and it stalls at 07 and it stalls and stalls and stalls and they push it back up to 08 and it comes back down to 07 and then they push it up to 08 half, 08 quarters. You know, you're looking at that saying they're starting to make a little expansion to the upside. You get the next pullback and you're gauging the speed of the pullback and you say, you know, they're definitely pushing it back a little slower now. It's not coming down as fast as it did a few minutes ago. And now you see it start to go back to buyers. It starts to move back up. You're taking the trade on the tape. But this is what it would look like on a tick chart at that point in time. Is you would finally be breaking those swing highs or the swing lows, and you say, okay, next retracement, if the momentum is the same, if the speed of the tape is the same, I'll take the trade, make a fairly low risk trade. You know, I can risk 6-7 ticks, and I've got a potential target of 4 or 5 points. You know, that's that to me is the type of trade that I am interested in, that I want to take all day long. You know, I scale out. Everyone who's traded with me knows I scale out, and usually I will take off the first portion of my position at a 1-to-1 risk reward. And in spite of the fact that I'm scaling out, and I do have a lot of these trades that come back and stop me out at break even. You know, I might get 1 target, 2 targets, and stopped out at break even on the runners. In spite of that, I can still maintain almost a 2-to-1 risk reward. And I have to say, if I just went for my bigger targets, I would have no problem getting 5-6-to-1 risk reward out of my trading. If I wasn't scaling out, if I just went to break even and went for the target. So it's more comfortable for me mentally to scale out, so I scale out. But that is one of the primary things that I look at and that I try to do. Now, if anybody has questions on this, throw it out. Karen, you mentioned you have a couple, but want to think about it for a bit. If you, either way, you can throw it out there, or you can, if you want to think about it, shoot me an email. You know, if it's something that would benefit everybody, I'll mention it tomorrow as well. So I'll leave it up to you. Anybody else that wants to throw something out, throw it out. I'm going to reset the tape. So, you know, we've got 30 minutes here, and then I'm going to show you, using an indicator, what could you look at to try to get the same type of fill. So, well, I'm going to be here, but I'm just going to mute and get everything reset. Okay, so back with this. Couple questions. Sean says, I'm sure you covered it already, but 500 tick chart for intraday trading. I will base that on what looks normal, on candles that look normal. And so on the S&P, when it's a real busy day, it may need 500, 600 ticks. It may need 350. It's going to show you the same thing, but I think if you go much beyond 500 or 600, you basically are trading a 1-minute candlestick. So, you know, I normally have mine on 350 the majority of the time, and I just realized that right at the open, the candles are going to look a little bit goofy. And then as it slows down after the open, then I'll get my normal, you know, my normal appearance back. And that is on the S&P. And Sean, where you're kind of looking at the 6E right now potentially, remember that one I do use a 5-minute chart on it, and there are some other ways of seeing it on the 5-minute chart, but the 5-minute is actually pretty stinking clean on the 6E. Yeah, Karen, with your comment, you say you find that at turning points it starts chopping around, and you think you see it turning. If it keeps chopping around, you're not sure what's going to make it break the level, and then you miss it. That is common. We look at a 1 hour chart or a 15-minute chart, and every reversal, man, it just looks like just a beautiful, clean, um, just straight down and reverse on a dime and straight back up. And it's never that way in the real world. You get, you do get a little bit of chop and a little bit of pushing back and forth. I mean, nobody wants to give up on a trade. We don't want to give up on ours, and a guy that's trading 100,000 lots of something don't want to give up on his either. And he's going to push and chop and see if he can get a little more. They can smell the stops right below, and they want to try to get to them. So there is going to be some pushing and shoving and chopping back and forth at most points. And so that is something that, to me, I've had the problem of seeing things too early. And sometimes I've done this for years where I'm looking at it going, I always see it too early. Just let them retest the level one more time and then see if they're still there. And I do miss some moves. But I tend to be, in my trading, I definitely tend to see the moves reversing earlier than they actually do. Um, so I do try to adjust for that. If you start seeing that in your trading, that you're seeing it a little bit too early, you have to just realize here's the conundrum. You see it too early, and occasionally it just reverses and it's gone and you missed it. And you have to weigh the psychological impact that has on you versus being too early and you weren't right. I look at it and say, doesn't really bother me if it moves without me. I mean, there'll be another trade in a few minutes. So I'll just deal with that, or I may look at the next retracement and see if it's still there, if there's still a target or whatever. It doesn't really bother me to miss a trade. And where I frequently see this drive people crazy is I will sit here in this scenario and I'm waiting for a pullback to at least the 50%, and it pulls back to the 38, or it pulls back to 25%, and then it's just boom and it's off running for the high. And I've traded with many people who just go insane with that because you saw the reversal and you didn't get the pullback that got you into the trade, and it just drives them out of their mind. It doesn't bother me. It would bother me more to jump in at the 25% and give up a point of entry that I could have gotten. And so when I weigh the two against each other, I say no, I would rather miss a trade than get in so early that I miss the premium entry point. So, we have to judge that for ourselves. I wouldn't say that my way is right. It's a double-edged sword. If I wait for a deeper retracement, it could go through the bottom and stop me out. And the ones that pull back 25% tend to be moves that just run hard and fast. So in a sense, I'm guaranteeing that I will have a likelihood of getting in a loser, and I'll miss the really, really fast moves. But when I look at my trading overall, I'm very comfortable with where I sit with it psychologically. I would rather get the deeper pullback 7 or 8 times out of 10 than miss one blazing runner out of 10 or 2 blazing runners out of 10. And I would still rather take the chance and say, when it comes down to that point, I can still blow the trade off if I don't see it there on the tape. But it is about psychologically finding something that works for you. The guys have heard me talk about it before. We were laughing about it. I think Brian and Ken, we were in here trading crude. And, I had a trade that was up, it was coming right up to $1 on crude, had one lot. And a buck on crude is $1,000. And Ken, he's my buddy who's always reminding me to get the money off the table. You see $1,000, you take $1,000, and he's always harassing me about it. So I'm sitting there, I'm like, no, I see more. I ended up hitting $1,500. I got $1.50 on the trade. I'm hitting $1,500, and I'm like, do I take it off here? No, I see more. I think we still got more up ahead, but I'll move my stop up, and I end up getting like $1.35 on the trade. Subsequently, it went higher. What absolutely drives me out of my mind is when I saw it higher and I tightened my stop up a little too much, and and it ticked me out, and then it went higher. Drives me crazy. I would rather take 5 full stops than miss one runner like that. And so, I look at it and say, for me, psychologically, I would rather give up. I frequently will take $600-700 on my runner, and it'll stop me out for scratch because I saw the potential to get 2,000 or 2,500, and psychologically, I'm comfortable with that. So each of us have to sit there and look at it, not to get into psychology too much right now, but we have to decide for ourselves what absolutely drives us crazy and what allows us to be comfortable. And then we put that into practice in the real world and say, now am I making money with it? Yeah, Ken types in here GTM. Do you mind if I tell him what that stands for, Ken? Where that came about? He started. I'll probably tell it wrong, but he started a business years ago, and was trying to figure out what to name it, and he ended up naming it GTM, which is get the money. And then I think you started another one, which was KTM, which was keep the money. So he had the get the money, keep the money. And so when he sent me the little stick for raking the chips off the table, it's inscribed up there on the end, GTM, KTM. Get the money, keep the money. So I got a real kick out of that. And that for Ken, that's what makes him comfortable. He sees the profit and he takes that profit off the table, looks for the next trade. I look at it and say, you know what? I don't especially like entries, but I can sit on anything. Doesn't bother me at all. So I would rather, psychologically, I would rather enter and then run and run and run and run. So it's, to me, it's just something that each of us are going to have to deal with. And I wouldn't say copy me or copy Ken or Karen or anybody. We have to analyze it for ourselves, and then we put it into real money trading and say, is it making us money, or do I need to tweak it? So anyhow, so that gives us kind of an overview of a tick chart of what I would be looking for on tape. And I try to show this when I'm trading in the room with the guys. I try to show it on the chart just to burn that pattern in, because it's hard to show it on the time and sales. The time and sales is flying, it's done and gone, and I can't comment on it because it's already gone. But that is the pattern that I trade over and over and over and over. So I'm going to take this now and I'm going to go into an indicator, and there may be ways of using indicators that are not technically correct, but they can be very beneficial. And what I'm going to show you is one way of using an indicator completely backwards from what it was intended to be used as, but using that to kind of act as a proxy for the tape. Now this indicator is something that is this is available on NinjaTrader's forum, and it works on version 6.5 and version 7. And I'm actually going to expand this out so that it's real visible, so you can see what it is and what I'm going to do with it to try to clean it up. I'm going to get rid of the time and sales for this for right now. This indicator on Ninja's forum, it's called CCI histogram. And actually, let me do this. You can take your CCI out of your existing indicators, and you can see the CCI histogram, CCI underscore histogram. And I'm going to put both of these up here, and I'm going to set both of them to the same time period. And you'll see that a lot of the information is basically the same. Give me a cursor here. The problem with the upper indicator is it gets really sloppy because it's printing a border on it. And to me, this was reminiscent of something. It looks like something from what Woody uses. And I don't know who programmed it, but I've seen some charts people float around of Woody's stuff, and they've got these weird boundaries outside it that's supposed to be telling you this and that. But when I look at the point where it breaks through the zero line, you can see, using this vertical crosshair, you can see it breaks through at the same point. It crosses back through at the same point. So all it is, if you're not using Ninja, all this is CCI, but it's plotted as a histogram. as opposed to plotting as a line. So I'm going to get rid of the lower one. And let me get rid of this stinking cursor, crosshair. It's amazing. Little thing like that would give me the GBs so much I can't even take a trade just having a crosshair on my cursor. But I'm kind of anal that way, I suppose. Here's what I'm going to do. I'm going to show you guys how I would configure this, and the standard setting on this is the way that it's set up, and I'll just put that up here so that you can see all of it. In fact, we'll just put our properties across the whole thing. The standard setting on it is a 14 period CCI. It's going to be calculating tick by tick. The panel, it's going to be on panel 2, and then you're going to be printing off levels and showing a 100 and a 200 and a negative 100 and a negative 200. And that would be kind of your standard settings for a CCI. Now, if anybody has ever used CCI, the basic use of it, the way that it was designed to be used, and let me just get this out of the way for a minute. The way this was designed to be used was that if the CCI came through the positive 100, that was an indication that the current move was going to keep going to the upside. And that is what if you research CCI, that's how they tell you you should primarily use it. If you see a move and the move is moving to the upside and it goes through the positive 100, it will keep on going. Yeah, Ken, your question that you say you don't have the CCI histogram, and did I load that separately? That is something that is on Ninja's forum, and you download the file. I'm happy to email it to anybody that wants it. Just send me an email and I'll send it out. In fact, let me do this. I'll just send it to everybody because I've got everybody's email address on a list. I'll send it. It's just going to be a little same compressed file, and I will have a little video. I will direct you to a little video to show you how to install it. So that way we don't have to worry about everybody emailing me. Again, it's an indicator. I'm a price action guy, but if we change it, there can be some benefits to it. But like I say, going back to what CCI was intended to do, it was intended to show you where price was going to keep running. It wasn't designed necessarily to show you reversals. So if it goes through the positive 100 level, you're looking for price to continue. If it goes through the negative 100 and it's moving down, it goes through the negative 100, you're looking for price to continue going down. Well, I'm going to throw that all away because I'm trying to use it kind of as a proxy for tape to help see where buyers change to sellers and sellers change to buyers. So here's what we're going to do with it. First thing that I say has to go is these lines, these bounds that are running around the outside of it. And what that's going to be called is the CCI middle, CCI overbought, and CCI oversold. So to get rid of those, I'm going to select that, and I'm going to come down here to color, and I'm going to scroll all the way to the top, and I'm going to pick transparent. Close that one out. I'm going to take the CCI overbought, color all the way to the top, get transparent. CCI oversold, I'm going to change it from the lime, again all the way to the top. I'm going to pick transparent. And I'm going to go ahead and hit OK here, and you can see now that that's already cleaned that up considerably. And the difference between that and the standard CCI is that the standard CCI will only print one color. And this will change green above 0, red below 0. So if a person wants to try to do this just with their CCI, they can do that. But you will now see that these are crossing at the same exact points. It's plotting the same exact mathematical calculation. The difference in the CCI histogram is that changes red to green depending on whether it's over or under 0. I look at that, it's still not clean to me, so let's go back in here. Now we've got the lines, and the lines really bug me, and I want to get rid of the lines. So I'm going to do the same thing, color, transparent, and the only one that I'm going to leave is the 0 line. And just for you guys, if anybody's wondering, when I came up with this and decided to use this way, I went through probably about 30 different indicators trying to find something that would correspond to what I'm doing uh, on the tape. When I see it on the tape, which was rotating, and I had at one point 6 or 8 indicators, and I'm comparing them to see what can I find that will give me a quick cross or a quick signal as close as I can see it on the tape. Can I do something that will be within 2 or 3 ticks price-wise? And this is what I ended up with. So I would say there's nothing wrong with experimenting with indicators. There can be use. However, I would say they're probably not real useful the way they were designed to be used. One of the big factors with that, ironically, is that many of the quant firms look at how people use them, and they will scale that into that. The bots that are designed to try to trap traders on the wrong side of the market. They're looking at MACD crossovers, and they're looking at the time periods that most traders trade. And they're coming in there saying, if we see order flow activity that indicates they're getting short, we're going to run through them and take their money. So I think in some ways it's made indicators not nearly as relevant as they used to be 10, 15 years ago. Many of you have come to that conclusion and breaking away from them. Okay, so let's do this. I'm going to make one more change to it at the end, but now you can see we've got a fairly clean indicator here. I actually don't like the black. I don't know how I got this thing so big. I must have bumped the top. Windows 7, if you take it up and bump the top of your screen, it makes it full size. I'm just going to change this to a gray. Apply that just so I got something that's not really jumping out at me. I hate lines on my chart. The other thing I'm going to change is the 14 period. And Karen, you asked a question, am I using a 14 period or faster? I took it down, and what I found, if I got below 6, it started giving me too many. It was just back, forth, back, forth, back, forth, back, forth. And the 6 would let me see it somewhere right around the time that I saw it on the tape. I would say usually within 20 or 30 seconds, and it might be 2 or 3 ticks higher. But it still gave me a very fast signal. So now I'm set up, and you can see if I change the regular CCI to a 6 period, it's still going to match. So for you guys that don't have Ninja, don't worry about it. Just use your CCI, plot it out as a histogram, and tell it to update on every tick. It'll still work fine. So I'm going to just get rid of that, but you can tell it matches perfectly. They're just a little easier to see as the red green. Here's what is interesting. If you look at the chart and you look at where it crosses, remember we were talking about the pullback and seeing the buyers, and that I would probably be getting in right down in here within a tick or two of the low. This has crossed through the 0 line on this second candle. So do you see what that's doing? If I saw my entry down here and I saw the buyers coming back in at 07 and 7/4, and I'm trying to get an entry, I'm going to either get filled at 7/4, 7/2. If you wait for this to close the candle and confirm, and you took a market order right there, depending on where the bid ask was, you would either get 08 or you would get 08 1/4 at worst. So if I'm getting in at 7/2 and you're getting in at 8 even or 7/4, or excuse me, 8/4, you would be giving up 2 to 3 ticks by doing this, and that's the downside to the indicator. But the upside to it is to say, at least in doing that, it gives you some kind of a visible confirmation that may be easier for you to process than doing it from a stream of numbers. So when you stop and take this kind of thing into consideration, what would you think would be pivotal if this will give you a confirmation of tape within 20 seconds and within 2 or 3 ticks? What would become the most important thing about the trade setup? Maybe you guys can just throw your thoughts out there real quick. Well, that, and Kevin, with your comment about it being the zero line cross or reject, yes, that's going to be the actual signal. But when I look at the overall setup, the candlestick pattern, everything put together, what would be the important factor? See, wouldn't it be the level? I've got some various comments out there, but wouldn't it be selecting a level? We're at a point where we could expect some kind of transition, and if we get that transition, now we're going to come in here and confirm the trade with this or confirm the trade with tape, and now we're taking our chances on it. Brian, I just asked if you give your thoughts with the overall setup, what would become the most important thing or the primary factor? And what I was saying was that this would be picking the level. You're watching a level. You're not just trading every cross, because if you just trade every cross, obviously you would get destroyed. But if you come into a level that is of interest to you and you're watching for a reaction and you see a change, at that point you have a pretty good trade setup there. You're still going to get stopped out 3 out of 10. That's just a fact of life. As long as we can come back in and manage it to a good conclusion, then we're fine. But you have to say, is there a difference? Because we could come back in and say, well, it went through the zero line here, but were we at any kind of a level to expect to bounce? To me, I'm saying we're just basically halfway through a little tight range, a little 4-point range. We're halfway through a range. Now over here, we're pulling back into the low, and it pulled back again into that low, and it crossed again, and now it made a higher high if we're really waiting for confirmation, and it pulled back and it crossed again, and we look at it and say, well, if they bounce it out of here, we should be able to get back to the high. You've got a decent reward there for the little bit of risk you have to take. So, if that raises questions in your mind, I've never wanted to use an indicator and say I've got to rely on a red dot, green dot system, but I also have to come face to face with reality to say not everyone is going to take the tape and see the stream of numbers and interpret it correctly. So if you can't, then this is a crutch. If you can't and you're trying to learn it, then you could always use this just as a training aid. If you see that rotate and you never saw it rotated on the tape, you're missing something. If you see in any one of these, even when it just put one bar above the zero line, when you come in here corresponding to that bar, let me get my cursor back on, corresponding to that bar is frequently a green candle. We look up above, here's a green candle. Come back over here, it had pulled back off this low, was selling off. It had pushed up at one point, was a green candle all the way up here. So each time you look at that, you're going to see that cross back through the zero line frequently is going to be enough buyers to have pushed it up. So just trading the crosses can be dangerous, but if we're trading the crosses at an area where it's tested, it can't get through it. They've tested it again, it can't get through it, and now it crosses. See, now we're putting 2 or 3 things together, and one of them we can see in advance. We see the level. We have that level in advance. We've had that level for an hour. 45 minutes, we've seen that level held, and they moved it to the upside. So we've got that in advance. Now all we have to do is wait for the reaction when we get there. So to me, that says it's kind of confirmation for what I do as a trader, which is to pick levels and trade against those levels. And you watch for the reaction around those levels. So if there's any more questions about using this, go ahead and throw it out there. But the video will have, the video obviously will walk you back through the setup, and I'll send everybody a little brief video showing you how to import that into your version 7 or your version 6.5 so that you've got that in your list of indicators to choose from. Any questions? Somebody give me a yes or... Oh, no problem. I'll put the parameter back up there. Do you have something that you can take a screenshot of that? Basically, these colors, I'll just review it real quick since I don't see an answer. Okay, you don't have something for a screenshot. The colors here, I just put it to red and green. The CCI middle, CCI overbought, CCI oversold, that is done to transparent. The level 1, level 2, M1, M2, those are done to transparent. So the only thing that I want printing is the zero line, the CCI bar high, and the CCI bar low. And then it's going to be changed to a 6 period. I'll clip this little section on the setup. I'll clip this out of today's video, and I'll send that to you with the indicator itself. So that way you'll have that, and we don't have to spend any more time on it. No, Sean, or I'm sorry, no, it wasn't Sean. I just saw the thing pop up. That's not the 6 period specifically for the S&P. That would be on anything that you're looking at any time frame you're looking at. But I would say if you're the 350 to 500, the 350 is going to give you a cross through quicker than the 500 will. And you got to just keep that in mind. If you go to a shorter time frame, it's going to cross through more quickly. In fact, let's just mark this. When we got this cross through here, this was on a candle that closed at 17 and 49 seconds, and the high of that candle, the close of that candle was 12:08. And then let's just change this to a 350 tick, and you'll probably see that crossed through just a tick earlier. So you got to be careful, because if you went to an 89 tick, you're probably going to be flipping back and forth so fast that you can't even figure it out. So let's see, here we get the cross at 7, 17, and 31 seconds. So a 350 tick gave you a cross through 16 seconds earlier, and then the high of that candle, or the close of that candle, was 0775. So it was a couple ticks and a few seconds earlier on a 350 tick. If you go to your 200 tick on the NQ, around 100 tick on the YM, you go to a 89 tick on the beans, go to a couple hundred ticks on the crude. It's going to basically give you that same quick confirmation. And the shorter the tick count of the chart, the quicker you're going to get the confirmation, but also the greater the possibility that it's just going to be flipping back and forth. You've already had 2 or 3 confirmations by the time you came down into the low. You had your first one right here at 7/4. You had your second one up here at 7/2. It briefly went red. You had a third at 7/3, and then you take your fourth one at 7/3 or 08, right in that area. 6E, if you were going to do the 6E, I would run that somewhere right around 200 ticks if you were going to do that on a tick chart. You will be able to tell fairly quickly. Just scroll back and look at it for the last 2-3 days. I've always told people, don't get completely obsessed with back testing, because if it worked 2 years ago, it's not necessarily relevant to today. No problem. The market changes. I've traded the tape for years. That my efforts with the tape goes back to 2001. Any market condition that we've had, it's been successful for me. Things do change. Patterns that work quit working. Many things change in the stock market, and if you curve fit something too much and make too many rules, about the time you trust it, the market has changed enough that it quits working going forward. So I've always told people, if you see something like that, look at an instrument. At most, go back 8-10 days, pick the levels, scroll through the chart going forward, and see where the cross is and see if it works. And if it's crossing too early and giving you false confirmations, there's two things you can do. Increase the tick count a little bit, or go from like a 6 to an 8 on the CCI. Again, this is not how the CCI was meant to be used, and if you go read about the CCI, you'll come to that realization. But I was just trying to find a way to help clients who could not see it on the tape find a way to see it on the tape. I'm sorry, find a way to see it on a chart with an indicator. So this is as close as I'll ever get to a red dot, green dot system, and I don't sell it. I'm not going to code it and have it print a red dot on the chart to tell you to sell, or a green dot. If somebody wants to code, God bless you, go for it. This is something that's been out there in the market as open source information, the parameters of how it's calculated, and I don't feel any reason to try to rip people off by selling them an indicator when it's already in their platform. So I know a couple of you guys could get it coded and make it print on your chart and make it visible there where you didn't have to have the indicator down on the bottom. You could just get the signal. So if you decide to do that, let me know how it works out, and if it's a value, great. If not, I'm just putting some options out there. So anyhow, this gives us a couple, three things to look at that we could go back in and use on our charts, on our dome. If we can't figure it out on the tape, it will still get us those pieces of information. And the one that I see on the tape that most of us, I would say the majority of people should be able to do, is they should be able to tell whether it's speeding up or slowing down. So if they can tell that from the tape, keep one open, watch the momentum up and down. But if you can't see the buyers rotate to sellers and the sellers rotate to buyers, this is a couple ways of going about it. So I will leave that topic where it is unless somebody has questions. I'm going to do one more reset. I'll leave it up to you guys. I'm going to show you just a quick bit of information on choosing levels. But we're getting up here closer to the 2 hours. Again, I took a little longer going through this, and I wasn't sure. Just for you guys' benefit, I don't work off of notes. I have nothing in front of me. I'm not following a script, and it's probably evident because I stutter around and stammer around here and there. But I'm trying to just go through and show this like I would if you were sitting with me and I was working with you on a mentorship. The things that I would try to reason through and show you. So unfortunately for time, sometimes that means I take longer than I intended to do. So accept my apologies for that. If there's questions, throw it out. I'm going to reset the tape and then we'll show the final bit of information for today. Okay, so got that processed and back. Recorder's on again. Couple comments, couple questions. Yeah, Gary, I'm out there flapping around like a baby duck trying to run and take off for the first time. So I don't like notes and I don't like scripts. Ken tells me I should have a teleprompter. I thought about that until I started watching Obama using that all the time. So that said, oh no, I don't want a teleprompter. So Sean, your comments, will that work the same way for the 6E? You put it on there. Look at a 200 tick and just look at current conditions. Is it rolling through? Is it giving you decent indications? It'll roll through, and every time it rolls through, you should see a little uptick in price. And now you've got to look at it and say, am I picking good levels? Is it rolling through at these levels and giving me a way to make money with it? So, and yes, the CCI interval will be 6, and if it's giving you signals too quickly, try it at 7, try it at 8, try it at 9. Some markets wiggle up and down more. Markets with thin domes tend to wiggle up and down the dome more. And if it's too quick, again, you can either change your tick chart, make it a little longer, or you can take the CCI and make it a 7 or 8 or 9 period. Gerardo, with your comments, you mentioned a comment that we had the poll on managing trades and leaving money, and the you're asking the question, am I going to go further on that, on how to let the trades run? Yes, I am going to take one session and I'm going to go through, we'll probably do it on Monday, but I'm going to go through a bit of psychology and I'm going to go through some money management, trade management, and it's going to be relevant to any type of trading, not just tape reading. So if people feel really confident and comfortable with where they at, you don't want to show up Monday, don't worry about it. Um, that's kind of where I'm going to go. I do feel that for most people, you could take all the best information in the world, and if you can't get the psychology down and you can't get the money management down, it's never going to work. And I think you guys would probably all agree. I mean, even the results of the poll was kind of indicating that, and I just wanted to make sure, because some of you, I don't know how you're doing on your trading, and I've found clients from day one, that's the big problems. They could learn the method, but they just couldn't. They had trouble with the control and the management. Let's see. Tom, you're asking, the CCI green gives you confirmation after you see the tape. It will typically be, I would say, 15 to 30 seconds after I've seen it on the tape. And it usually, on something like the S&P, will be 2 to 3 ticks higher price or lower price. If I see it at 7/2, the CCI is going to roll it at 8 even or quarters. So it will be slightly slower than what the tape does, but it still gives you the heads up long before you would see it off of a chart pattern or a typical indicator, like your stochastics or something of that sort. Yeah, Sean, that's what I was just addressing for Monday. We're going to go through some trade management, money management, psychology type information. So the market, Karen, looking at that, you made a comment that on the 5-minute chart you got a significant consolidation. I have shorted 3 times from last night on, and I got a point, an out, I got a stop, and then I got 2 targets and out. And the market is not rational right now. I definitely view it as a short, and if I wasn't talking right now, I would probably still be looking at that. I'm just thinking the thing in general, it hit 12s. I was expecting it to get through the 12s. I took a short right in front of 1200, got a target and out, and I just took it off full on, took the trade off. Paid my bills for the month off of it. The next one, I took a smaller position, and I had an order there. I took a smaller position, and I got stopped on it. As it ran through. I got in around 12:04, and it just ran straight on through. And I wasn't even watching it at the time. It was not a tape reading trade or anything of that sort. And then I took a short earlier this morning, before we came in here, got 2 targets on it and out. And yeah, I'm still interested in it, but I'm not. It's not real rational right now. I figured they had that close to 1200. They got to take a peek and try to get through it and hurt somebody, and I wouldn't be surprised to see it go crashing back down. But right now, I think we got PPT in there, kind of buying across the board, so no telling. Oh, consolidation like that, I see what you're saying. If you were looking at that, let's just switch it over so we can see what Karen is referring to. And does this the area you're consolidating up here near the high? When you're in a consolidation, there's a couple of things that I tend to look for on the S&P. One of them that makes me nervous with the S&P is a tendency to get up in a consolidation, go sideways, and it starts to break down, and then almost immediately it'll go down 3-4 ticks, and then immediately turn around and run right through the high. And it appears to me, and I've seen that pattern for years, it appears to me to be an effort to give the illusion of a breakdown, get everybody jumping in there short, and then they whip it around and start buying serious volume, and they know the stops are going to be right over the pivot, right over the high, and they'll go blazing right through those stops and use that to take their profit, and then it will turn around and break down. So I tend to be kind of cautious. Uh, Once it has consolidated, I tend to be pretty cautious about jumping in there and taking entries on it. I'm sorry, taking entries on it. Um, yeah, I get very suspicious and I start looking for games, and I would be watching this, uh, like on the dome. Are they stacking the offer? Let me just put a dome up again. This is something that, that you start watching in these scenarios, and big traders will come in and pad these levels, and they used to do it manually, and now apparently they're doing it. The HFTs are doing it, but they will pad these levels and make them look thick, and you'll see 3,000 contracts, 3,500 contracts a level on the offer, and it gives the impression to people that are watching the dome that the market is coming sell, and there's tremendous amount of supply there for guys that look at it as supply demand, or they look at it and say, boy, this looks like potential distribution now. I look at it and say, they're lying, and they're trying to convince you to step in front of them. We look at it and say, boy, there's 3,000 there. I'll never get filled unless I go hit the bid. So we go hit the bid and get short, and there's little size over here. And if you watch your time in sales when this is occurring, you might see print after print after print after print selling, and you realize you just watched 2,000 or 3,000 come over here and hit the bid, sell orders at the market, and yet your little 200 is still there. So when I get that kind of scenario, that's where I go back and I start trying to compare the dome and the tape to see if they're playing games, see if they're sitting there trying to fake me out. If I sense that they're playing games, I will go long here. That's the way I approach it. If I don't sense they're playing games, I'll try to get a little wiggle back up towards the top of the range and go short there. So that's, Karen, to me, the only way that I've ever done consolidations is I look for games and manipulators, and I'm not a very big I'm not a breakout trader. I would be more likely to have shorted the first move into 15 than I would to short something coming out of the consolidation, and that's just my personal preference. So when I come into it looking for games. If they're stacking the offer up and the offer's getting really thick and there's a little tiny bid out there and you watch print after print after print go off red, that means that's a market order hitting the bid, and we get thousands of contracts go through and yet it doesn't clear out this little bid. It means somebody very large is accumulating there with iceberg or bot orders, and they're just refreshing it and absorbing everything that's there. To me, that says it is absolutely going higher. So if we come down, we start testing 11, one thing you can look at, do you see a tremendous amount of buying coming in on the tape? Do you see big volume buying coming in on the tape? The first flurries of that, you get one flurry of buying, you have to say that could be some profit taking, because smart money, they're going to take those profits coming into resistance and support. They're not going to be entering positions unless they know something or they feel something is very true. So taking that first high, like you say, you do that on crude, you take that first test and then get messed over on it, and it doesn't break down. They get frustrating, and that's where, to me, the best money, you get that first hour and quit trading. You take that first move or two and be done with it, because when it starts to get into this kind of a market, unless you can just scalp a little range, to me has never been real beneficial. I guess if I had to do it, I would say I would be just as likely to put a sell stop out there and then don't watch. Put my OCO on there with that sell stop and then just don't even watch it, because it drives me crazy. Yeah, I would say if it's a range that you can trade, if you can scalp it and get 8-10 ticks out of it, if you can identify that consolidation, you see the tape slow down, you see it start to go sideways, you watch the numbers reoccur. If you're watching it on the dome, you see them get it to 1375 and back to 12, up to 1375, back to 12 even. As quickly as you can identify that, you make the assumption, okay, we've had a nice move, now we're consolidating. I'll scalp it once or twice and then I'm done. That would be about the most I would do with a consolidation like that. If you're a breakout trader, obviously you want to see when it starts to break. Um, as you come right into that level, are they buying or are they selling? What's actually happening coming into that price. And if you see that they're selling it coming into that, coming in pretty aggressively, selling it coming into that low, you may just take that breakdown and say, yeah, I'll go with it. Andrew, you asked if I'm going to cover that topic in terms of looking for ranges to scalp. Let me just write a note down real quickly, and I'll just comment on that at some point here. And I won't do it today. I want to go through one more thing here today, and then we'll end with some questions and call her a day. Here's what I'm going to do. I'm going to take this chart and I'm going to switch it back to my tick chart. Whoop, went to a 500-minute 500T. I don't want to look at it, and I'm going to come in here and some of you guys have seen me do this, and I want to use this just to make a point about what we're doing. I'm going to come back in and load 20 days so that we've got some time back there that we can't see. Maybe I'll load 20 days. S&P is always slow when we're doing ticks here. I'm going to go ahead and get, Andrew, I'll take that off of there. And here's what I'm going to do on this, because what I'm going to mention here for the next few minutes is really working with price levels. And I've shown this to some of you, so if you've seen it, it's not going to be anything new. But the point that I'm going to try to make with this is how important price levels can be to us and why that is such a beautiful thing to look at in our trading. So to do this, I'm going to just compress my price scale here. And we know that we just broke into the 1200s a day ago, so we don't have a whole lot of price action. And so I'm going to just compress this down so that we can see down into the 11s. And now it chooses to reload the data, so we'll let that reload the chart again. Okay, so anyhow, we're completely compressed here on the price, and I'm going to just come in and put some lines on here, some levels on here, and let's just, if you guys want to call numbers out, I'll put them where you do it, but otherwise I'm going to just put some numbers out here, and I'm not doing it for any particular reason. At any given price, I'm going to just randomly click 1235. We need to be something where the market has traded through in the last 20 days. So it needs to be something below 1200. Sorry. So we got 1165. We'll put a line there. I mean, we can just populate them random, but anybody that wants to put a number out there, that's fine. I'll put a line there. Otherwise, I'm going to just put random numbers. We got 1190. Someone says. If nobody else has preferences, I'll just do it. 1182. I'm just going to eyeball it, so give or take, it'll be within a point. 1174. Let's get, I'm going to just put a couple more randomly. I'm just going to click and put them there. I'm going to scroll down. I'm going to compress it again. And I'm going to just randomly come in here and I'm spread a couple around because we're going to go back to what we can't see, where we can't play with this. We can't say there's any reason that those numbers are there. You guys know the numbers you called out there here, and I added a few more. And we have to say, all of us could probably agree this is random. Um, as we get, there may be a reason you guys picked 1182. I have no idea. There may be a reason Pete said 1190 or Brian said 1165. I don't know. So for whatever reason, let's just assume that we've got some random lines on here. And the little F on this chart on version 7, that will just redo the scale and bring the scale back to price. And so all I'm going to do is scroll all the way back, and we're just going to go back 20 days. And we're going to start working our way through this to see if these lines could be used for support and resistance. Now, interestingly, if I would have left the CCI on here, you could look for confirmation on the CCI to see if there's rotation there. Or you could look at it on the basis of a chart and say, if you came down into this level and you were watching this level to go long, could you develop some type of criteria to make that trade work? And then could you use another random level up here as a target? Now, when you look at this, to me, in some ways, it kind of shows the error in trusting point of control or value area high, value area low, virgin point of control, floor pivots, support and resistance. In a sense, to me, this would indicate that it's all a crock, or it's all a coincidence, because we're going to put these levels here, which are completely random, and we're going to trust them. And yet you have to say we're probably the only person in the world that drew a line at 1165 and 1174 and said, those are numbers I want to watch. So we're going to go forward from here into what we can't see, and we're going to take just a simple couple of rules with this. If we come into a level from up above, we're going to view it as support. If we come into a level from down below, we're going to view it as resistance. When we come into that level, we want to make a determination, can we short against it or can we buy against it? If it goes through the level and it doesn't stop, it just goes through the level like it didn't exist, then when we come back up into it from below, can we take a short? If we go through a level to the upside like it doesn't exist, as we pull back into it, can we take a long? Now, if you think about what I'm laying out here, essentially it's creating a scenario where only two things can happen. It either comes to the level and it reverses, or it goes through it. Does everybody follow me at this point? So we can do that and say, going to the upside, we've got two possibilities. If price moves to the upside, we're going to either hit the level and reverse, or we're going to go through it and buy it on a pullback. Or two scenarios to the downside. It goes down, it's going to bounce off of our support line, or it's going to go through it and we're going to short it when it rallies back up into it. Now, in any of these scenarios, we have to say, can we use the tape with it? Could we make random lines a trading plan and make money with it? And so actually, I am going to do something here. I took it off, but I'm going to put the CCI back on here. I should have saved it and told it to set it up that way. Bear with me for just a minute while I get this set up. I apologize. I should have just left it on there in the first place. The reason I'm excuse me. The reason that I'm going to do this is that by using the CCI, we can kind of get an indication of whether the tape showed it rolling right there or not. And that's why I'm just putting these things back on there. We'll just set it back up real quickly and see if it crossed through. And if it crossed through there, that would give us the indication. I could tell you based on the chart whether it did or not, but let's just do it, and that way we've got something that we can be in agreement. If that tracks tape fairly well, we'll let that determine whether tape would have given us an entry there. So let's just start walking forward from where we're at. We're kind of bobbling back and forth down one of these lines. We're going to let it get moved away from it, and we're going to say for right now the 65. If we run into 65, we'll buy it, and we're going to put our plan together. And if we break through this, we'll buy it when it comes back. Well, we'll expand out here and watch what happens as this broke through. We had a comeback and we have a rotation down here on our CCI. We come back into that line again. We have a rotation on our CCI. Now we're going to view 74 as support. We're going to buy 74s. The next line up above us, we don't even know where it is, but that's our target, or that's going to be where we're going to reverse. So we're just going to keep stepping forward here. We're back down to 74s. We get a rotation on our CCI that says yes, there were buyers. If we saw that coming in at 74.5, something on the tape, we're already traveling 6 ticks, 8 ticks. Would we have had a trade there? Is there anything magic about 74? Whoever called out 74, Jim? I don't know if that was a number that you traded and got stopped over the month. I couldn't say. But why is 74 acting as resistance when we're beneath it, and why is it now acting as support when we're above it? Was there something magical about that number? I don't know. I don't know why you picked it. We come back down into it. It goes sideways, gives a rotation. Taking the trade with a couple points stop, what happens? We get a couple points positive. A couple points negative. It tries to bounce and it fails. So we look at it and say, did we get a scratch? Did we get a stop? Yeah, we did. Now we're beneath it. We're breaking down. We rally back up. Do we get a short signal? Can we take that on a short now when it hits it? And you see what's happening with it? Every time you come back in here, it seems like this is a line. If I told you that this was something that I calculated with the computer, you guys would want to buy that formula. If I told you this was something that I had a precise method on fib retracements, you would want to buy my tool. But it's just random lines. But here's the beauty of doing this. If you have something on the chart, some sort of level, whatever it is, if you gauge the reaction around that level, you will always see one of two things. Either you get the reversal or you go through it. Occasionally it will go sideways down it, but bottom line, it's either going to go through it or it's going to reverse. And if it goes through it, you have a method of dealing with that. And if it reverses, you have a method for dealing with that. Then we have to stop and think, is that, would I just do this? Would I just trade random lines? I'll tell you the God's honest truth. I would trade random lines in front of anybody with real money. Because at that point in time, I'm going to be focused on the tape. I'm going to be trying to make a determination whether they're reversing it or whether they're going through. And I don't care whether it's a pivot point. I don't care whether it's a point of control. I would trade it with real money in front of anybody. Because at that point, I can judge what the price action is doing. I've got something to compare it to. So if that's the case, is it more important, do you think, to focus on levels, or is it more important to focus on gauging the reaction around certain levels? We can continue going through this, but you guys will see the same thing time and time and time again, that it will seem to pivot and rotate and stop just within a couple ticks of these levels. If you compress this back down and look at that, if you're taking a 10-point move down, and you come in there and you buy this with a couple point stop, you're getting a 10-point move back up. It comes up literally to the tick, to the 74 line. To the tick, it rolls over again and drops 5 points, 8 points. I look at that and say, what's the most important thing? The floor pivots. I don't know if he's still in here. No, he's not. Let's scroll down and see. No, he's not here. He wasn't going to be able to make a whole lot of it. He's been in and out a couple times, but we've got a trader that's been in here with us, that was a pit trader. He was one of the locals for many years, and he's trying to transition to the screen and can't do it. I've asked him, and I've asked half a dozen other locals that I've worked with about the floor pivots. No, there's nothing to them. It's a stupid mathematical calculation, but it lets you go in there with a number in your head, and you can gauge reaction around those numbers and take a trade. There's nothing magical about adding the high, low, and close together and averaging it. Divide it by 3, and then subtracting something from that. There was nothing ever magical about that, but it gave them a level, and then they could judge the reaction. So we say, well, if we like levels that come from floor pivots, is there anything wrong with it? No, but we have to realize it's no more effective than a random line. What it's going to come down to, like Karen is saying, it's the reaction when it gets there. So if that's the case, we may feel more comfortable saying, I'm going to look at yesterday's high or yesterday's low. We may feel more comfortable saying, I prefer swing highs and swing lows. I'm going to take my levels off of things that just happened. Nothing wrong with that. But, bottom line, it is a very viable plan if we can gauge the reaction around those levels. And I have always felt that is the most beautiful thing we can have, is something that focuses our attention, something that says, here is a place, and I'm going to judge what's happening right at this price, and I'm either going to go long or go short based on how I read it. We have a stop, we have a take profit, we know exactly what we're going to do, and we sit down and implement that when it comes into our level. Now, just in case anybody's wondering, did I deliberately cheat and pick 65 and 74? Brian, I guess you'll be the only one that knows you typed out 65. Jim, you're going to be the only one that knows you typed in 74. Let's move away from it, and we'll just keep watching it. Here it turns ding on the nose on the line I drew at 82. That was Gary threw out 82. So Gary, that was your number. We're back down to our 65. See, when you go through there, it appears almost uncanny that you will find a reversal around these lines. We're down to our 57s. I don't know. I think 57 was one I just punched in there when I started filling some in down below. Here's the type of scenario that it just goes straight through, pulls back into it. You get your long entry. So keep that in mind as you trade, that one of the most important things is going to be choosing some levels. Don't kill yourself trying to find some magic level. Take something that's comfortable, but where you want to really apply yourself is engaging the reaction, however you choose to do it. So, final thing, and I'm going to just spend about 5 minutes on it, because that's about what I would spend on it in the morning, is the action plan when I sit down in the morning. I'm going to just scroll through here. I'll scroll back a screen and let it load to you guys, so you can see all of these numbers that were called out there. You'll see these numbers in play, and every time you're going to find reversals at those numbers. You've either got reversals or you go through and you've got a trade either way. I guess we're back on the 27th, so we still got a few more days to go. Anyhow, I think it kind of makes the point. It's not, I don't completely subscribe to the random walk theory of the market, because I do think that it's fairly manipulated. But I have to say there's a lot of things like that are just almost bizarre how random it is when you look at it and you say it just comes down to your reaction. Let's do this. I'll show you guys. I'm going to just clear off on the drawing. I'm going to clear off these lines. A couple things that I would suggest looking at when you're getting ready to set up for the morning. For some people, they definitely want to look at a bigger time frame or a bigger perspective. And so I'm going to bring in a couple other charts here real quickly. You guys will notice this is ES pound dash pound, and that is on version 7. That is how you would do a continuous chart. And then when you open up your platform, not only do you log on to your Zenfire feed, but you would log on to your Kinetic end of day feed, and that will allow you to go back quite a distance into the past. I mean, that gets us back into week 14 of 2009 on this one without my Kinetic being turned on. But some people would call this kind of a top-down approach to developing a trading plan. In my mind, I always kind of have an impression of where we are as far as a daily picture goes. And I'm not necessarily going to take levels off of it, but I want to know, are we trending up? Are we trending down? If we came in and said, hey, I'm going to draw some lines, if we drew some trend lines on it, where are we relative to that trend? Have we pulled back into an uptrend line, or are we pushing the top side of it? You know, exactly what are we doing? And you know, when that happens, and actually I may need to reload this. I was going to say this for some reason isn't showing today on it. But anyways, I would take just a couple of minutes and I would look at that chart and I would say, where are we at? If we're coming up into an area that I would consider resistance, then I'm going to have to be careful and not be real optimistic about going to the upside. If we're down in an area where I would anticipate a reversal, you know, that's going to figure me out. You know, kind of a basic plan. No, that's in the middle of the pound. That's just a dash, not a dot. If you go into your control panel, you're going to click on Tools, and then you're going to click on Instrument Manager, and then on your instruments, you're going to take ES, you're going to select that out of the list of contracts, and then on your little drop down at the bottom, where it gives you all the different months to choose from, you'll see pound dash pound. And you can do that with any of the contracts here. If I wanted a continuous crude contract, I've got CL pound dash pound, and so on. I could put a continuous contract up on just about anything I wanted to watch. So you have to load that in through your instrument manager first. You can't trade it, but you can chart it and look at a little bit more history there. Anyhow, so you get just an overall viewpoint. So if I sat down this morning and I looked at this, I would say that's extended far enough that I don't want to be buying up there. We're coming up into this high. We've had nearly 40 days up. You know, by anybody's definition, yeah, sorry. Let me get this junk off of here. I'm trying to draw something on here. We'll just pull this back down. By anybody's definition, we've got 48 days up with no pullback of any sort, of any means, any importance. So I look at that and I file that away when I'm setting my action plan for the day. Is where are we at? Are we right in the middle of a recent range? We pushing the highs of a range? What exactly are we doing? So I say in a situation like this, I would definitely be very careful looking for long trades, and I would be taking long trades at certain points, but I'm not expecting it to run to new highs. And so if I don't have a pretty good distance between my entry long and the high of day, I wouldn't even entertain it on a day like today. And that's the situation where I have friends call me and they say, you know, Dow was up 200 points, you must have killed it today. And I said, no, I didn't take any trades. Those are the days where I've looked at it. It's not at a level where I feel comfortable going long, and it runs and runs and runs and runs, and I never took any trades. So that would be step one, and I would just encourage you to get a feel for that. Kind of recognize whether you're in a daily range, are you in a daily trend of some sort, and where you're at in the trend. Once you've decided that, then I'm going to come in here, and normally what I would look at, I want to see a little bit more history on my chart than what's visible right here. So I may come back in and say, instead of 500 ticks, show me 3,500 ticks. That way I should be able to see 4 or 5 days of trading activity, and I could decide what levels are interesting to me, what levels are relevant to me today. So once this loads up, I look at it and say, over the last few days, again, these are levels that to me would be our immediate support and resistance. Is we could take, off of our highs here where we saw it test a couple of times. We could take some prominent lows, and we could pick a few levels there that were noteworthy. The overnight high, we come in and say, okay, this could be a level of interest. We're going to take that, whatever's visible for the last 4 or 5 days, and try to say what things are relevant. Well, I would say your immediate support and resistance that's most notable is always going to be yesterday's high and yesterday's low. If they couldn't get above it yesterday, what are they going to be able to do with it today? Will they get rejected there? So I want to watch those levels. So this is starting to fill in some numbers for me where I can say I want to watch reactions around 1209. I want to watch reactions if we break down. I might be looking to take some profits into the 1196, 1197 area. If we really broke down, I would be putting targets out there at 1180 and taking something off in front of 1180. So I sit down in the morning. I don't look at news. I don't look at what's going on in China or Europe or anything else. I am interested just in some basic price levels. Is where did price trade yesterday? Where are we relative to that? What do I want to do with it? So I get that out of the way, and then I can go back to my little immediate chart. And again, if we were doing that for this morning, there's not a whole lot of levels because it ran so far after the news and overnight. It really didn't give us a whole lot of levels. But frequently you'll come into that on a day like this, and you'll say, boy, we had some levels here, and we had some levels here that it really tested. And then I have to just wait for it to open, and I'm going to watch the reaction coming into those levels. But as I do that, remember, I've always got two scenarios below me, and I've got two scenarios above me. And until I see one of those come into play, I'm just going to sit there. So if I was doing this and I didn't have the ability to remember it, I would use, Karen developed a nice alert system here and had shared that and said actually that could be shared with you guys as well. Whoop, got to add it. Put some numbers in there. I could come in and say just as easily that I want some type of alert when we get to 1196, and I want some type of alert when we get down here to 1180, and I could say I want an alert when we get into 1186. I could say I want an alert when we get into 1189, and I could just load those levels in, and that will play off an alert. I created my own sound file for it. I tweaked it a little bit after Karen gave it to me, but I put in my own sound file to let me know that I'm talking about the euro, and I've got one for the crude, and I've got one for the 6E. And then I can come in and just take a nap or sleep or do whatever I want to do, and this will fire off and wake me up. Well, I look at that as a tape reader, and this is something I love about what Karen did here. As a tape reader, I want to know before it gets there so I can watch the reaction coming in. So up above, she put the option in here to alert you a certain distance away, and on the ES, I just have that alert me 1 point away. So when that gets within 1 point of those lines, it fires off an audible alert, lets me know to start paying attention to the chart. And I could change that if I wanted to, and I could say at the high of day, let me know 8 ticks ahead, and at the at the low of day, whatever I wanted to do, let me know 8 ticks ahead, and in the middle, just warn me 4 ticks before we get there. And so at that point, I don't have to sit there and get a headache trying to memorize the tape, trying to figure out every little move. Frequently, that is just noise anyways. So I just watch my relevant levels. When I sit down at that point, and let me just put this on here, and I'm going to get rid of all the let's see, drawing tools, remove drawing objects. We'll get rid of all of that. This gives me something that I actually don't mind looking at. And Karen, I think you can turn that off, can't you, where it doesn't even print the line? I can't remember. It seems like there was something in there where you could tell it draw or don't draw the line. Maybe I'm thinking the labels so that it won't draw the labels if you want. But anyhow, I can sit there and now my plan is in place for the morning. Oh, that's true, Brian. You could just make them transparent. Good point. Gotta love the transparent color on there so you don't have to look at stuff. When we're sitting here, I can say safely I have a trading plan when the market opens, before the market opens. And I say I'm going to watch it come into 89s. I'm going to watch it come into 96s. And in the meantime, I'm not going to do anything. Those may be the levels I'm watching for the day. When we come into that, we have a reaction. At that point, I'm going to be taking a trade. Now beyond that, if I see that it starts to form some type of little trend line, it starts to form some type of a channel, I may very well take a trade on that channel or that trend line. But at least when I sit down, I know what I'm going to do. I know I've got two possibilities above me, two possibilities below me, and I can just simply wait for it to happen. So to me, in having a plan like that, that is different than your full-on trading plan. But at least this lets you have something that for sure you're going to do when you sit down. You know levels that you're going to really pay attention to. And then once you go forward from that, you may see double bottoms, you may see swing highs and lows, you may see other things in play. So I tend to take that once we start running, my mentality, and I'm not going to draw it all out, just because time-wise we're starting to get pretty late over there for some across the pond. But I would say when I look at yesterday's range, I would be interested primarily in buying down in this area. And when I look at yesterday's high, the top third of that range, I would be primarily interested in selling if we get up into that area. And in the middle, then at that point, I would have to be seeing something compelling, whether it was a fib retracement or a little double top, double bottom, something that said, okay, off of current price action so far this morning, here's a trade, but don't get out of line with it. Don't put on a 50 lot. You may want a 5 lot. And so I sit down and I've got a fairly decent plan in place. All I have to do is just wait for price to get there and then judge the reaction. And so when we talk about developing a trading plan, and we'll do this, next day or next week, we'll get a couple days where we'll trade live. We'll do this pre-market real quickly, just 4 or 5 minutes, pick a couple levels and say this is what we're going to watch. And when it gets there, we'll make a decision on it. I think realistically that's all that I need. And I don't know, some people want to look at the overnight news and the overnight moves, and they want to see the pre-market, what the releases said, and they're trying to take into account all of these things. I personally have never found it necessary. Just a simple plan. Here's a couple levels to watch. Let's wait for it to get there. So if we're a scalper, we may still keep those things in mind. We may look at that for targets or so forth, but we're going to be reacting more to the little moves, these the little thrusts, and we short it, and a little thrust and we short it, and so forth. But for the type of trading that I do, where I would be trying to get from 96 down to 82, down to 80, what can I get beneath me there? I tend to make a plan this way. So as I've worked with clients, I've encouraged every one of them, when they sit down, if they don't know what they're going to do, they better not do anything. Don't start placing trades. Don't start fiddling around, because that's where you just get destroyed and you don't even know why. You look at the trades at the end of the day and go, I don't even know why I took it. I could tell you any trade I take, I could tell you in advance exactly what I'm doing, exactly why I'm taking it. And if I can't define that reason very clearly, it's no good. So I will quit talking there. If anybody has any questions about that, I'll address that. If you've got a question, throw your question out there. Otherwise, we'll break and call it good. Pete, you're probably going to be up the rest of the night now if you've been drinking coffee. Yeah, you'll lay down and the baby will be screaming and waking you right back up, huh? Karen just put a comment out here. Um, she said that if anybody wants that alert indicator, that I am welcome to send it to anyone, but she does ask that you don't pass it around. Karen doesn't mind sharing that with the people that are in here. So, question here: when are you going to talk about the HFTs? Are you talking about in terms of actually tracking them through a live market? Because we already discussed them fairly in depth. I'm going to have to change something here for some reason. Apologize. I'm getting some twitchiness in the questions, and it's not refreshing. It keeps showing Brian saying geeks, 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 and it's not. I don't know what it's doing here. So let me close that and reopen it. I'm assuming you must have asked a question about something to do with geeks, Brian. You're not calling everybody geeks, so. Andrew, on uh, your question, you asked something. Will you be able to share the indicator of price levels? I guess I answered that. I didn't see that question there because it was kind of spazzing out on me. I'm trying to clear out some of the questions. Apparently, it only wants to let it hold so many up in the memory unanswered, and at this point, it was showing I've got 115 unanswered questions, and it doesn't want to let me do any more. So let's see if this clears it. Okay. So we've answered your question, Andrew. You know, Karen said she's willing to share that. Anybody that wants it, just send me an email, um, joel@priceactionroom.com, and I will be happy to reply and put that in there. Brian is asking, he was not sure if anyone was a computer geek. He was having some problems this morning where his computer crashed, and then when he tries to re-download Ninja, Brian, you said that crashed off a Windows update. The after he did the Windows update, everything crashed on him, and so he's trying to go in and install Ninja over again. And when he tries to download it, it tells him that he can't connect to the server. And it's doing this off of a couple computers there. He's got a laptop with Windows 7, and he's got his older trading computer with XP on it, and it's doing it off of both of them. So he was just wondering if there was anybody that might have suggestions that's run into trouble getting that Ninja's execution file to download. If anybody has any thoughts on it, post it out there, and I'll. And so you're trying to install that on a new drive other than the one that crashed. That's strange. I don't know. I've not seen that where you try to go to a web page across other computers. Unless is that something you're trying to install it on like a portable hard drive, Brian, or so the one that crashed is still dead. And then are you trying to install that on a portable drive, or is it another drive mounted in there connected through SATA? On a second boot drive, okay. So that would be like when you say second boot drive, is that like a partition on your primary drive? Guys, just for anybody that's not wanting to hang out, we may talk about this for a sec, see if I can help Brian get his thing fixed. But as far as the presentation goes, I don't have any other questions that I can see here that I missed. Marty, I think I got your question, but I guess I see down below a Y from you. The HFTs, when we start going to the live trading, we're going to look for them, if that's what you were referring to. We went through all I'm going to say about what they're doing, but then we'll start looking for them. Well, I'm going to go ahead and shut things down here as far as the broadcast goes. Well, welcome to day 5 of the tape reading mini mentorship. We have once again had a little bit of problem with the recording here this morning, and the first little piece of this morning's session did not save correctly. So I'm going to just go back through real briefly a couple of questions, and then we'll get into today's primary topics. First of all, the disclaimer again, as we look at the trading that we're going to be talking about here today, it is hypothetical. I'm not making any claim that I took the trade or was in the trade. We're talking about hypothetical ways of looking at things, and obviously you guys will recognize that as you watch the video. We're going to take a look at some topics for today. First of all, the questions. I do have a couple of questions that I want to address real briefly this morning. And then we've had a number of questions from you guys, in fact, even before we got the workshop started, about which markets would be reasonable to look at or reasonable to trade for a person who cannot trade the US open hours. And then we're going to take a pretty intensive look at tape and price action together and take some price action setups. We'll get some input from everybody here. And then as we look at those price action setups, we're going to try to determine, as a price action trader, how can we go back and put tape to work with the price action setup. And then related to that is the thought of a continuation entry versus a reversal entry. And you no doubt recall that we were talking earlier about reversals. Many of you favored trading reversals, but many people do like continuation type entries, and so we're going to talk about both of those. But before we get to going into the other topics, we're going to take a look at a couple of questions that have arisen and see if we can get a reasonable answer for those questions. First of all, some of the questions that we were asked about was scalping ranges and how I would go about that. And I'm going to kind of detail out a little setup that is very common in the Forex currency world, and show you how I kind of adapt that to the futures markets in terms of trying to locate ranges to scalp. And in answering this question, I think it's going to be easiest to just put a chart up and identify an area on a chart. And so we're going to just take a look at the YM, and I'll show you just kind of a setup or a basis for the trade, and then show you how I try to use that. Now, this trade setup is something that is referred to as a box trade, and it's a little different. This isn't the Vargas boxes that were made popular many years ago, but it's actually just a simple setup based on the price action. And let me show you how this is traded in the currency world, and I'm going to just take this little piece of chart here in the pre-market, and I'll show this to you. But what this is based on is essentially I guess for lack of a better word, this is kind of a continuation pattern or a consolidation pattern, depending on how you term it, or a base. And individuals look at these consolidations and bases and they wonder, how do you play that? So I'm going to just get this over to an area where I can kind of demonstrate what the box setup is. And we'll just diagram it out. Essentially, the box trade that a lot of currency players trade is they look for a point where price pulls back and subsequently rallies right back to a prior high. And they look for this to pull back again to within a tick or two of the same level and then rally back up once again. And a box setup, let's just assume that we came from up here somewhere. The box setup essentially looks for 4 points. You would have 2 touches to the bottom, and you would have 2 touches to the top. And when it made those touches, they would consider that the box. They would wait for the price to pull back into the middle of the range, and then they would place a sell stop entry down here. If it goes through the bottom, they're going to get swept into a short. They would place a buy stop entry up here. If it breaks to the upside, they would have an entry to the upside. The target, they would simply look at the height of the box, and they would say, we'll go for 100% of that, or if it broke to the upside, 100% of whatever the height of this box was. Now, frequently this is done on Forex. It may be 100, 150 pip boxes or tick boxes for you futures traders. The stop would essentially be on the other side. So in the Forex world, what they'll do, if it breaks to the downside, they've got their entry. The existing order, which sits up to the upside, that acts as their stop. And then they'll just put a target down here, and one or the other will get hit. Essentially, they're creating a 1-to-1 risk-reward ratio. Well, I've always said it can be a practical thing for us when we're trying to scalp ranges. It can be kind of a practical trade setup to do the same thing, but we're going to kind of assume that the box is forming when we see 3 touches. We're not going to require a touch 1 and 2 down here and up here. We're simply going to say, let's take a move where we've got 1 touch to the bottom as it comes down. We've got the 2nd touch up at the top. We've got the 3rd touch here at the bottom. And we're going to call it a range and say, at this point, can we assume that we can get back up here to our 4th touch? If we can, and we've got a decent target, there's our trade. We're going to be watching this area down in here, looking at our tape, trying to see if that's a range that we can take advantage of. So you can see, obviously, on the chart up above, it started out a little higher, but we had a pullback here, and we had a subsequent rally, and we had a pullback, and it never quite made it back up here for a 4th touch. But even if we would have been trading this, watching this area right here, you can see, it's still got 10, 12 ticks up there before it went ahead and started going sideways. Now, if we were waiting on this as a traditional box play, it would not have formed at this point because we never got our additional touch up to the high side, and eventually we would blow that off. But we might start looking at this again, saying, okay, we got a touch and a touch. We have a pullback. We have a touch. We have a touch up here. And in the meantime, as this goes sideways, we're able to try to scalp these turns, pick up 10, 15 points out of it. So when I see these type of patterns forming, again, I just make an assumption. If we get 3 of them, there's a good likelihood that it's going to get back up to the high again. I'm going to come down in this area, look for buyers on the tape, and I'm going to try to get in and get back up to that high side. Now, it doesn't matter whether that box is formed straight sideways or whether it comes off on an angle. You can do the same thing, what we would call a channel. Forex guys will still call a box. But we might look at the same exact setup and say, well, that's just a channel that price has gotten into. And so we may come in and say, we had a pullback here, we had a pullback here, we connect those, we touch up here, we make a parallel, and then we're going to play the moves back and forth in this. Well, obviously this isn't a picture perfect example, but it's just done to kind of illustrate the point that if you see those things forming, you can almost make a presumptive guess, hey, this is going to rally back up, this is where it's going to run into trouble, this is where it's going to get sold. So a couple of things I would look at if I was normally going to be trading this. I'm going to just get a trend line here on my chart, and I like to look for situations where this is rallying up pretty steep. It's something that you have to say is probably not sustainable. And then I like to see that start rolling over. And so you can see that as price moved, it was losing the ability to rally straight back up. That could be kind of a warning to us that price is starting to roll over, and subsequently we can expect a turn. If that's the case, we could just start watching this arbitrarily as it's sold. We could start looking for a short, or we could continue to connect our highs. And as an example, when we come into this area and start to break down and rally back up to it, we would be looking for the short, assuming that we're going to come back down to the low side and make a touch. Now that personally, when I look at trying to scalp a range, that's one of the things that I look at. I do use a little trend line to try to define where that range might form. But the thing that I don't like to do, whether I'm talking about a channel or I'm talking about a trend line, after it's touched it 3 times, I'm not going to keep buying that bounce, because the more that it touches it, the greater the likelihood that this is going to go ahead and dump over on me. And here I am buying my new touch, and I can't get to my target, and it rolls over and dies. And so it is just a caution when you're looking with a trend line or you're looking at a channel, is after it's touched it 3-4 times, be careful. The first couple, great, but then you've got to really be careful, kind of back off of that. Now, Andrew had asked a question about this, and Andrew's question was not necessarily dealing with the trend lines or looking at that. That is one method I tend to kind of eyeball that, and I'm looking for those kind of rollover moves where it starts to lack the ability to get back up to the high, and then I'm coming in trying to short that on a subsequent retracement. But what he was wondering more specifically, um, how can you do this on the time and sales? Is there a way to spot the range? And we're going to touch on this in a little more detail. In fact, we'll touch on it today, but in a way, it's the same methodology that would be used to trade the YM without having the benefit of a chart. Let's just say we have some levels in mind from reading the time and sales. And so let me just get a blank screen here. I'll just end this show. That'll give me a blank screen to draw on. And we're going to, like I say, we're going to touch on this a little bit later today. But if we were trying to spot the range just on the basis of time and sales, what would it look like? Well, there's a couple things that we could do on the time and sales. One of them is just looking at the level, and let's say that we see prints of 90 and we see prints of 89, we see prints of 88, we see prints of 87, we see prints at 86, and then we work our way back up. We go back up to 88, we go back up to 90, and so forth. Well, essentially, if you get into a range and you're trying to find a little scalping range, you're trying very quickly to find points that it keeps gravitating back to. So we see some prints at 90, it starts working its way back down. We come back down, we're printing 86s, printing 84s, printing 82s. In our mind, we kind of start forming what I would refer to as a bracket. And that bracket, we would be looking at this as 90 high, and we look at our lows, we've got 82 lows. If we're doing this, for example, on the YM, we want to get a bracket at least 10, 15 ticks, but we'd like to see a number that keeps coming up, and when that number comes up, it sells off again. Well, if that's the case, as we rally back up 88, 89s, can we safely at that point, could we come in here and short prints, like if we're seeing 88s or 89s? Is that a viable short? Well, if we're in a little bracket there and we keep seeing those numbers and it keeps rotating back and forth from 90s to 82s, back to 90, back to 82, then yeah, we have to say, do we have enough room? 16, 18 ticks, can I get 8 or 10 out of the middle? Absolutely. And so when we see that ratchet back up, we're going to take the short and then take it, and we just know we want to be out of that by 82 if we're scalping. We want to be out in front of that a couple, 3 points, if we're scalping that. Well, you might imagine what we're looking at here on the flow of the tape if it was a tick chart. So let's just imagine that we had a candle, started at 90 and it traded down, and we traded down to 86, turned green, kind of ran back up here, printed 90 again, sellers came back onto it, we run back down here, we get back down to 82. Essentially what we would be looking at would be almost like a fib retracement. As we're retracing back up, somewhere up in this area, we're saying, let's see if the sellers hit it again, and if the sellers hit it again, we'll go short. Or if we rally back up into this, we'll go short, and then we'll just give it a stop off over the high. To do what Andrew's asking, can you do this just on the time and sales? Absolutely you can, and this is how you trade without a chart. You're kind of building that chart in your head, and you're just memorizing those numbers. But the important thing in being able to do this is we have to see a bracket. Now, for some individuals, that will be a lot easier to see on the dome. And what you're going to look at on the dome, you look at your dome and you've got your bid over here, and you've got your offer over here, and in the middle, you're going to have your last price. Here's your bid-ask spread, here's the last price, and that's wiggling up and down, printing off against the bid or the ask, bid or the ask. Well, it's very easy to see this ratchet up the dome and then work its way back down the dome, go back down, and it works back up and it works back down. And we can see that ratcheting up and down, up and down, up and down on the dome. And for some people, it's a lot easier way to do it than actually coming over here and trying to memorize this string of numbers and somehow come up that our range is 90, down to 82. Over here, you can just kind of mark it off and say, okay, 90, 82, 90, 82. You're looking at that range, and if the range gets big enough, you go ahead and take your trade. So hopefully that makes sense and answers that question in terms of looking for some ranges to scalp. You can do it straight off the tape, definitely more difficult than using a little chart. When you see that on your tick chart and it works its way down and it comes back up and it works its way down and it comes back up, if that range is slowly working its way down, you're just looking at that at the fib retracement. If it's going sideways, you real quickly see the range on your chart. You move up into here, you take a little short on it. So I like to see it break a tick or two higher and then take a short on it, back down to the downside. And I'm just looking at the tape. I'm looking up in here for the sellers to hit it, or I'm looking down in here for the buyers to start nibbling at it again. And when I see that, then I will go ahead and run back and forth through that range once again. So hopefully that takes care of that question. The question on the channels, I think the most dangerous thing with channels, let me just keep drawing here because it might be easier to do this. If we have let's just say we have us a trend line here, and we've been working our way back and forth up this channel. And we see price work up to the high side. It sells back off to the low side. Buyers come back onto it. We work back up here. Here's the danger, again, which I mentioned a minute ago, in this kind of trading. I look at this and I tend to be kind of, I guess my mentality on it, I don't want to be too presumptuous with it, but I do like to assume if we have two levels, we get a high and we've got a low here and a low here, I will draw this line and make a parallel line up here, and I'm going to assume this touch up here, which essentially is going to be touch number 4. We start here 1, 2, 3, 4. Some people call it an ABCD, some people call it a 1, 2, 3, 4, some people call it a box, some people call it a channel. It's all similar ideology there. But I'm going to come in and I'm going to assume this touch right here if I have a parallel. And so if I see buyers come back in here and start turning it higher, I'm going to assume that we're getting up here. So if I'm quick and I read that on the tape, I see the buyers come in, I may get an entry in here and I may be out of this right up here before we get to the top. If I can't do that and I either chicken out or I don't see it, or whatever happens, I will come up into this when we get our second touch to the top, and I will still anticipate it pulling back. If I see the sellers come in right up in here, I will take a short, and I'm going to have this as an ultimate target. But here's where you have to be very cautious. When you come in here and you've touched this now 3 times, and you've touched this up here 3 times, we're continuing to work our way up, and we got 3 touches on each side, and we pull back down into this, and it's going to be the 4th touch on the bottom, or we move back up to the top and we get another touch at the top. It becomes increasingly dangerous to play the channel, because what's likely to happen at some point is we're going to come in here, we're going to take our little rally back up, we're going to go long thinking that we're going to be able to make it back up to 0.8, and the sellers are going to come in and it's going to get swatted down fast. So I am very cautious. I would rather assume the 4th point up here than keep trading it after we've touched it 3-4 times on a side. I will trade the 2nd touch up here, I will trade the 3rd touch down here, I might trade the 3rd touch up here, but I'm not going to trade the 4th touch, the 5th touch, the 6th touch. The thing that I realize in that type of trading is that by the time it's done that, everybody sees it. And when everybody sees it, and you got your newbies are coming in going, woohoo, we got a channel, that's usually when they're going to yank the rug out from underneath you. That's time to trap everybody. And so you'll get that appearance that it's going one way, and then the thing is going to whip over on you and you're in trouble. So just keep that in mind with any kind of channel. I really do like channels. I tend to see them visually, just in my mind. I don't necessarily draw it out touch by touch by touch. I prefer just to see it, have my chart relatively clean, and take, my third touch, fourth touch, fifth touch. Um, and by that, I'm referring to, the beginning point sets the trade up. Second point kind of gives us a range. Third point, we can't trade those. But then I would say, when we come up in here, I'm going to trade here, I'm going to trade here, I'm possibly going to trade here. And from that, I'm all done. So 3 touches will give me the setup, and I might trade 3 touches, and then I'm done. At that point, when we come back down in to this level, I'm not going to touch it. Let it go. And I don't care if it continues to go 15 more times. It just increases the likelihood that I'm going to get spanked at the end. So that's kind of what I do with the channels. Now we're talking as well about the difference in time and sales, and this is the final question that I'm going to address. The difference in the time and sales when we see the market orders come in. And so what I would suggest doing, let's get rid of this, and I'm going to just write a little bit of criteria out here for you to do, because it's going to be a lot easier for you just to write this out and do this on your chart. Here's what you want to do. You want to take 2 time and sales windows. And both of those, you're going to do those on the same instrument. So let's just say we're going to do the S&P. On time and sales over here, we're going to come in to our properties, and we're going to put if we're trading on version 6.5, we're going to say timer refresh. Remember, we've got that. That's what actually sets a 250 millisecond delay. We're going to take that timer refresh, that we're going to set to true. And on the other time and sales, we're going to take that timer refresh and we're going to set that to false. Now what that's going to do is one of them is going to come in full on live. This is going to be our second time and sales. This one is going to be absolutely raw, unfiltered, no compression. Both of them, no filters on it. You don't want to filter out 20 lots. They're both going to be a filter of 0. One is going to have timer refresh true. One is going to have timer refresh false. The false, that is going to be raw. This is going to be over here. This is going to be a 250 millisecond time compression. Now, if you're on Ninja version 7, put that in there. Can't write real good with this, but Ninja 7. What you're going to do is you're going to come in, and on your properties, you're going to have, we'll basically set it up the same way, but on version 7, you've got the ability to set the delay wherever you want it. So come in on version 7. If you're using that, open up your 2 time and sales. On one version, you're going to come in here, and let's just put a more drastic interval. This is going to be a setting called a display update interval on version 7. And over here, we're going to set that to 3, just to 3. That's going to give a 3-second delay. And this one here, we're going to put to 0. Again, this will leave us a raw, unfiltered, uncompressed time and sales over here. And over on this side, it's going to take all of the prints that come in 3 seconds, and they're just going to drop into place in one shot. And so you're going to see a movement, and then nothing for 3 seconds, movement, nothing for 3 seconds, a movement, nothing for 3 seconds. When you have these 2 time and sales set up side by side, what you need to do then is go back and look at the way the prints drop in when you've got your timer refresh on, or when you've got your display interval set to 3 seconds. That is what it looks like when you're running on a market and a large market order comes in. You're going to just see all of the prints drop into place at once. Now, if you're doing this during the doldrums, later in the afternoon, some point when the market has slowed down, you're not going to see near as much difference. But if you're watching it first thing in the morning, your raw tape, it's going to be streaming by, and that tape will be streaming by very fluid. So if you come in here on this side, it will just move, nice linear move. And you come over here on this side and it drops and it drops and it drops and it waits and it drops and it waits and it drops. So when you see like half a screen or a full screen or 3/4 of a screen that just goes click and it drops into place, that's what we're referring to when we say this is the appearance of a bot, but it's actually the execution engine. It just, when a large market order goes off and the guys that were waiting in the queue to be filled, when they were small, it just drops into place, everything moves at once, and all of a sudden you're sitting there going, okay, that was a large market order. How big was it? If we know our time and sales window was 100 ticks tall, and it just dropped 3/4 of the way down and it was mostly ones and twos, we can look at that and say, well, I guess at this point I'll assume that was somewhere around 75. If it was all one lots and then half of them were two lots, so I'm going to call it $110, 125 market order dropped in. If we see mixed in with that a few 20s and 30s and a 50 and a 73, then we know that was a pretty sizable order. That might have been 400 or 500 lot market order that just dropped into view. So there's definitely a difference. And one of the things I'm going to do here as I put this together tonight, I am going to take a little piece of video showing the time and sales from a year ago, and I'm going to let you look at that time and sales compared to what it is today. And you'll notice that when you do this, when you look at this, and this is not something that I can show the workshop participants essentially because I can't stream video back to you, so it will just be here in the recording. But when you look at the difference in this recording, you're going to see very clearly, first of all, how tape used to come in, and then what it's doing today. And the reason you're going to see the difference is because of those tick reporting changes. You're going to notice a lot of big size coming in. And I'm going to just do this from a couple of recorded trades from a year ago, year and a half ago, when I was making the original tape reading made simple. So I'm going to quit there with the sketching. I'm going to stop the recording here. I'm going to go ahead and just insert into this video this segment from a year ago. I'm going to then insert in a little bit of tape from here today, just recently, and we'll let you see those side by side. So it's just taking a quick recording of a recording from 1 year ago. I guess this would have probably been in September of 2009. This is the unfiltered tape, and this is the filtered side of the tape. And you notice the size of the prints that are coming through. This is a 50 lot filter, but you look at these 347s, 198, 200, 495s, 292s. You scan down through here, 749s, 334s, some tremendous size, and you don't really see that anymore like you used to. When you watch the tape that's moving down here, you don't see the big blast where it just drops in half your screen at once. And the comforting thing about this, I guess, is that the CME group is talking about and thinking about going back to this arrangement. I mean, I miss seeing 800, 600 lot prints, 315 lot prints. Nowadays, you see that and it's half your screen drops, quarter of your screen drops over here in one shot. But this was just a trade that I took. Like I said, it's just been a little over a year ago. It is a recorded trade that is from the tape reading made simple video, and was able to get 3 targets out of the 5. If anybody's wondering what it did, I could just fast forward in the recording, but it is something that you'll notice those tapes, that tape on the filtered side, there is just not that much size anymore. I mean, you look at these contracts, 325s, 998 or 988s, 459, 703, just huge prints coming through, and that's kind of a thing of the past, unless they change back. I am kind of contemplating having someone make me a time and sales that will run in Excel that will put these orders back together and take things that have the same exact timestamp, put it back together into the original market orders. As you can tell, it's a lot easier. I mean, this is just right at the open. 6-7 minutes into the market, 8 minutes into the market, and the tape is fairly easy to keep an eye on, fairly easy to track. Huge size coming in. This definitely made tape reading a lot easier. And man, if the CME group goes back, I'll definitely be cheering them on. It will be a lot easier for you guys as well. We don't have to kind of watch it drop into place and guess at how much went off. We can just look at the size that went off and know that was the size of the orders that were placed. So I can fast forward through that little bit here on the video. It printed and kept on down and so forth. Got a couple targets off, and I had my chart traders on. The contract, I got 3 targets and stopped back out. So anyways, like I said, you might find it interesting to go back and review what it used to be. You look at all these 600, 800, 400, 300s, and it just that was a year ago. And of course, you guys know what it looks like today. So I'm recording just a little bit of tape here, kind of get an idea of how the tape looks today compared to how it looked a year ago. And you'll notice on the time and sales as you look down at, there's just not a lot of real big prints compared to what it was a year ago. We've got a 200 lot and a 261 and a 269, 250, but we're not seeing like the other tape showed, where there was a lot of 300, 400, 500, 600, 700, 800 lot, 1,000 lot prints. I've got it filtered to 50s, and it's, there's a lot of prints in there that are just double-digit prints. They're not even getting up into the triple digits very much. When you look at the tape from a year ago, there were more triple digits than there were double digits, and now the bulk of these are smaller. So it's definitely changed to a degree. Things are not moving real fast right now. They're moving about the same speed as they were then. And, we're seeing more of that activity where it just drops into view. But definitely the big size is changed in the way that it's being transmitted to us because of those tick reporting changes. So I thought I would just put those there kind of side by side and contrast them so you guys can take a look at it. So anyways, let's get back to things here. We'll get going again. I apologize for the delay there in trying to salvage that recording. Tom, your question, are both tapes the same? Tom, all I was doing with these is just demonstrating the difference in the way the prints are coming in. There was nothing here for setup that you would use in your normal trading. It's just to show the appearance. It was answering a question to show the appearance of orders that are just dropping into place, taking half your screen. By putting a time compression there, it causes those to just automatically take every order that was placed in the last 3 seconds, and it drops it in all at the same time. So it has nothing to do with setup. And no, I don't use a 50 block. I don't use any block size on the S&P. I don't want to see blocks. I don't even have them turned on. As far as a filter, if you're talking about a filter as opposed to a block, the filter would be on the S&P. I would normally have a filter set to 20, and that way it would just give a little bit more of a historical perspective, or allow you to see just a little bit further back into the past with it. But as far as the block size, I don't even turn blocks on. So if you look at the properties here, the block alert trade size I've got at 1,000. The filter size, if I was going to just filter it on the S&P, I would have that at a 20, and I would have my display update interval at 0. Marty, I actually would not filter crude, and the reason I wouldn't filter crude, it just doesn't have enough big prints to make it worth running 2 time and sales. You will see prints come through occasionally, but by far the vast majority of the prints are smaller than 10 lots. So to me, it's just not even beneficial. All I look for on the crude, I would actually be looking for double-digit row as it flies by. And if I see there's a double-digit row, I just, I realize there was a large print there, because anything in a crude, any double-digit print is a big print. So, you don't see your normal little Joe trader, like us. Don't place 10 lot orders in crude. I mean, they'll get their head tore off in seconds. So the update interval in Ninja NT7, that would be, let's see, in your question, yeah, that would be 0 in version 7. And then in 6.5, that would probably have to be set to true. That would be timer refresh, though, is what it would be called in version 6.5, Sean. And the difference in those is that 6.5, you can't use threading, so it will only use one processor core. And if you set that to false, which would be essentially like putting it to 0, you probably will find that your CPU will not keep up with it. Okay, so let's go. We've talked about scalping the ranges. We've talked about the boxes. We've talked a little bit about the channels, and we've covered the difference in the time and sales with having a bit of a delay there. So I want to get into, let's get our presentation back open here. We'll get rid of these. Next thing that I was going to address, and I was actually asked this in advance by about half a dozen people, and what they were wondering was, either because of their work schedule or because they live overseas, they're not able to trade the US Open. And so they're wondering in the middle of the night, is there anything you can read tape on? Is there anything that's active enough to do any kind of scalping, and so forth? If you look during the middle of the night, especially at the London Open, you're going to find some of the instruments are extremely active. And that's rough on guys because you're trading in the middle of the night and then you're trying to hold down a day job. For some of the guys overseas, like in Israel, probably even for you, Pete, it's a little easier because you can come back into the U.S. markets in the evening. But for some people, it's just either they're at work or whatever, they can't do it. So the 6E and the 6B, that would be the euro currency future and the pound currency future. They will be pretty active at the London Open. Forex is always having liquidity, but Forex will kind of die off. You've got your U.S. market where it's busy, and then in the afternoon, Forex slows down. When you come into the Pacific Rim and the Pacific Rim banks start opening, you'll see it pick up a little bit, but it's still not real active. And then when you come into the broader European Open, you'll see it start to pick up a bit. And then when London opens, you'll see great deal of activity. For you guys that are interested in this, the London banks will transact more volume for currency exchange than the United States and Japan put together. London, by far, is the world's financial center when it comes to currency exchanges. So there is a tremendous amount of volume at the London Open, and therefore the 6E and the 6B will usually be active there. A couple questions. What time does London banks open? Here's kind of the thing that you'll run into. For Forex, there is not a hard and fast opening. If the banks, a lot of the banks tend to open up around 8 a.m. their time, local time. But it doesn't mean that a guy doesn't wander in at 7:50 and turn on his console and start making market. It doesn't mean that he's late one day and doesn't come in until 8:10. It's with the currency exchange for the big banks on the interbank, there's not a specific open. It's just when the bank comes in, they set their stuff down, they start looking at their business for the day, and then they start putting quotes out. So it's a lot different than the market over here, where you've got your opening bell and it's literally to the second you know when it's going to open. So as far as London goes, on the currencies, it's roughly going to be 8 o'clock London time. So when we come into the other markets, for example, which are going to trade on Eurex or Life that I have listed here, you're going to see, I guess for Eastern time, which that's probably the easiest for most people to correlate to, 3 a.m. Eastern time is going to be your London Open, and 2 a.m. Eastern time is going to be your broader European Open. So you'll notice, like the first two that I have mentioned here, I don't know if anybody's traded them before or not, but they're symbols FESX and FDAX. That's the Euro Stoxx 50 and the DAX. those two indexes, they start trading at 3 a.m. I'm sorry, at 2 a.m. Eastern, but they don't get really busy until 3 a.m. Eastern when London opens. And you just bear in mind with these times, London does not change daylight savings at the same time we do here in the States. So you'll have about 2 or 3 weeks where that's messed up in the spring, and you'll have 2 or 3 weeks where that's different in the fall, coming up with this weekend with our time change this weekend. But generally, 3 a.m. Eastern, 2 a.m. Eastern for broader European Open. So that can be tough if a guy's working a job. I have talked with clients who, they work their day job, they come home, sleep for a couple hours, get up, trade London Open, sleep for another 3, 4 hours, and then they go about their day job, and are trying to make allowances so that they can continue to trade. But of these two contracts here, the Eurostoxx 50 and the DAX, the Eurostoxx 50 would compare pretty comparably to the S&P in terms of volume. A lot of big prints going through there, a lot of size going through there, a lot of spoofing on the dome and manipulation on the dome. And the DAX, if you could put crude on steroids and then double the tick value, that would be the DAX. Very violent, very dangerous contract for most small traders to trade. In fact, the Eurex puts a 25,000 euro margin on the DAX, and they do it for good reason. You're trading that and you're making money in euro. You convert that back over. So you're talking right now somewhere around $37 a point, and there's 2 ticks to the point, and it's the kind of market that can put down 40, 50 points about as fast as the S&P will put down 4. So it can be a very dangerous contract for small accounts to trade. If you're right, you can make a boatload of money, and if you're wrong, you can blow your account out on a couple trades. FGBL, which is the Bund, FGBM, the Bobble, FGBS, which is the Schatz. Those are the German treasuries. They are very, very liquid, very thick, very slow trading. Tremendous volume overnight in those. No problem at all trading in and out of those. And they're going to open up same hours as your Eurostoxx 50 and your DAX. And then you've got the FTSE, which is FTSE. That index, that trades on life, and your broker may or may not allow you access to it. My personal opinion, that is probably one of the funnest instruments to trade. I like it better than just about anything I've ever traded. But the firm where I do my primary trading and many other U.S. firms stopped allowing access to it because their reporting requirements got so strenuous. It was so frustrating for the brokers to deal with that they just said, forget it, we're not even going to offer it to our customers. My broker called me and says, you're about the only guy we have that even trades it, so sorry, we're not allowing access anymore. You'll have to find something else to trade in the middle of the night. And I thought, well, that just stinks. So some places, I think if you clear through Rosenthal Collins, you'll probably still be able to get it. But a lot of clearing firms just said it's not worth dealing with all of their reporting requirements. But and Tom, I saw you just came in. I think you were the one that had asked about this, about at night the trading, and that's kind of what we were addressing here. Some of the instruments. So these are ones that are thick and liquid, and that you can trade in and out of, kind of in off hours. If you go beyond that, like if you were trying to find something at 7, 8 o'clock at night here in the U.S. Eastern time, not going to be a whole lot there. You've got Forex, not really good for scalping. At that point, the Pacific Rim banks just don't do enough volume, and you can come in and trade it, but it's not. I don't know. It's like one notch above watching your paint dry. To me, it's just not real active. Your S&P, there will be a little bit of activity, but that is a really dead spot for us in the evening over here, where there's just not a whole lot of stuff that's really decent to trade. You can still go in there and place swing trades, and for you guys that have asked about this, I had a number of guys ask about this. The swing trading in the currencies can be extremely lucrative because they trend so well. And if you've got an account where you can be protected even over the weekend, like at a Wanda, you can put swing trades on and just forget about them. Even in that mess, like I talked about a couple days ago, even in that mess where I placed the silver trade and got stopped out uh, during the spike on FOMC. I mean, that spike guaranteed would have cost me a couple $1,000 slippage on the futures market, on the currency market. It filled at my price. It not a zero slippage on it. So those markets can be very good, and it is kind of nice for guys that have to work. They can come in, they can place their smaller trades, let these swing trades work for them. You saw what I did with the little euro trade the other day, 200 pips profit on it. You come in and just put even just a little micro lot on it. Make $20. You put a mini lot on it. You're making $200 on it for a trade that was open 12, 13 hours. Where these start getting active, guys, we've got a couple of you asking about this. They're going to start getting active at 2 a.m. Eastern. That's when broader Europe opens, and they're going to get really active when London opens at 3 a.m. Eastern. This would be for the 6E, 6B, Eurostoxx 50, the DAX, the Bund, the Bobble, the Schatz. They open at 2 a.m. I shouldn't say the 6E and 6B are open in the evening, but they get active coming into 2 a.m. and they'll die back down for a little bit, and at 3 a.m. they go nuts. The question about the bonds, what do you think of 10-year bonds? I have never liked trading, and I'm assuming you're talking the 10-year note. I have never liked trading the bond or the notes. I do not like instruments where you have really thick levels in the book and you just sit there and watch thousands and thousands of lots go off and your order still never got filled, and it's just like, come on. It drives me crazy. I would be more inclined to go trade the DAX. I either want to get stopped out or I want to make money, and I hate sitting there watching it. For guys that like to trade it, it has gone to a degree the same way the market has, where you have to be looking at price levels and you have to be willing to feel like you're stepping in front of a train, I think, to be effective at it. I know guys that try to scalp it for 2 ticks with a 1 tick stop, and their version of scalping may take them 40, 50 minutes to get in and out. And I look at it and say, I'm not even remotely interested in that. If you like it, I mean, the tick value is higher. They're not necessarily real jumpy. The shorter notes are jumpier, obviously, than the longer most of the time. But I personally didn't care for it. There's definitely enough volume there, and you got to realize when you're watching these trade, you're going to see tremendous size on the prints. It's the same way in the German treasuries. It's not unusual to see. I've watched at times on the treasuries where it seemed like you had as many 200 lots as you had 2 lots. So, Tom, you asked, do I watch it for a rudder on how the markets are doing? Absolutely not. It's completely irrelevant to my trading. So, I'm trading price action on a very short-term basis, and I could care less what the consensus is in the treasuries. It has absolutely no impact on me. So, I try to take absolutely nothing like that into consideration, and if by accident I read an article or am exposed to something, I try to forget it as fast as I can, usually, because I don't want that to give me an opinion. Tom, there's the reason I say that, a little bit of history. When I started trading years ago, trading equities, prevailing wisdom then as it is now is that if you're trading equities, you need to be looking at the S&P futures for an indication of where the markets are going to go. So I would analyze the S&P futures, and I got a good feel for what the S&P futures were going to do, and I've got a stock that I want to trade, and everything breaks at the same time, and I take the position in my stop based on what the S&P futures was doing and thinking that they were going to be in agreement, and I would end up getting stopped out on the trade, but the S&P futures did exactly what I thought it was going to do. And I came to the conclusion that if I was going to sit there and watch that, and then trade something completely different, it was never going to work. So I started trading the S&P futures. The analysis was right, and I was right. The difference in that and what I was telling you guys about the 6E and then executing in the spot, the difference in that is that they are arbed together, and so they will always move in unison. If one ticks up, the other's going to tick up within a second. So, when you start looking at the, I guess, things that are negatively correlated or things that you're hoping, if this and this happens in the bond and the notes, then that means the market should do that. Guess what? The market may not care. The broader market may be looking at Cisco Systems, and the bonds may be looking at what the Fed's doing. So to me, it's a big waste of brain cell trying to figure out how they're going to interact with each other for the most part. So I do not look at them. Anyways, this gives a few instruments there. If any of you guys have traded other things that you find are active and decent at evening hours, throw it out there. I don't trade that time a whole lot. I always would come in the evening. I would trade on the euro, US dollar, and that was about all I traded in the evening over here in the US. There just wasn't much that I could see moving. The S&P moves up and down a bit, but it is fairly thin at that point in the day. If you guys have some experiences with something else somewhere that you like to trade, feel free to throw it out there, and I'll relay that into the recording because somebody else may be able to look at that market and find the same thing in their case. So far, I'm not seeing any comments, so you guys may have arrived at the same conclusion that there's not a whole lot that would be going off in the evening here in the U.S. that you could scalp or bang in and out of. So let's spend a bit of time here on the tape and the price action and putting those things together. And this is something that maybe it belongs somewhere else, but reading tape is a form of price action trading if you define it the way I do. I tend to look at price action and say price action would be any form of trading where you're primarily relying on the movement of price for your entry signals and for your analysis. That price could be historical, looking at a chart, or it could be right here, right now, 65 milliseconds ago in Chicago. But one way or the other, we're allowing that price action to determine our trades. So here's what I'm going to do. I'm going to throw a trade setup out here and just explain it to you guys. And with this trade setup, we would essentially have two potential scenarios develop. And I like trades like that. I like trades where two things can happen, because then it gives me an easy way to make a choice. This gives me an action plan. So I'm going to get rid of this for a moment. And let's put up a chart. If I can find my charts. And we'll start off with this on a 5-minute chart of the S&P. And what I'm going to do, I'm going to show you two ways to set it up. And then I'm going to reset this, and then we'll talk about bringing the tape into it. I don't want to let this happen again, losing a session. I've got to get something figured out with Camtasia, because they're aware of the problem, and I don't know if I can roll back to an earlier version. But let's go through this real quickly for setup. I've got a 5-minute chart. My chart is set here where I'm printing a session break line. And that's done in the properties. You can tell it to have a session break line or not. And where I have my session break line is at 6:30 a.m. Pacific, which would be 9:30 a.m. or the broader market open Eastern. That session break line, that session template is a 24-hour template. So it runs from 6:30 in the morning to 6:30 in the morning. So that's giving me a continuous 24-hour chart, and it prints a break line at the broader market open. The overnight action doesn't come into play as much on this, but the reason that I use it is that adding a moving average to this to give me kind of a dynamic price to watch for a reaction, it will take you the first 20 minutes before you have an accurate moving average if you don't have the overnight session on there. So the pre-market is pretty active. It's fairly active. And the pre-market will have my moving average in play. And then if I want to take a trade the first 10 minutes, I can take a trade the first 10 minutes. But I'm going to show you guys two ways of going about this. One way of looking at this would be pure price action and looking for candlestick patterns that would show someone an indication that there's a reversal coming. So I'm going to throw that out there to you guys. What do you see for you price action guys? What would you be looking at to indicate that price was about to reverse? In fact, let's do this. I'm going to reset the recording right now, and you guys go ahead and throw out your comments on that. What do you think when you're looking at a 2-minute or a 3-minute or a 5-minute chart? What do you use as far as price action to show you that it's reversing? And then I'll stop this and be back in 2 minutes and we'll talk about it. Okay, so we're back, and at least that one saved correctly. Here's what we got for answers. We've got topping tail and bottoming tails are out there multiple times. For you guys who are not familiar with with candlestick charting and the terminology here, when you see a big long a wick on a candle or a tail, it shows you that at one point that was red all the way down to the bottom. Looks like it's a big sell-off, and yet the buyers came back in and pushed it up and were able to close it all the way back up here. So that's what we're talking about when we're talking about tails. Now, just for purposes of putting it out here in the tape, most Japanese candlestick guys would tell you the tail needs to be significant. Having a little short thing like this here with a body that big would be absolutely, kind of, I guess you'd say, just ridiculous. Like this little tail right here. It's irrelevant to the size of the body. So you're going to be looking more at the tails like this one here. Those are relevant, and let me keep that in draw mode. Those are relevant because they had pushed so far down. They pushed down a couple points, and yet they were able to close it back up 6-7 ticks of that. So we've got topping and bottoming tails. We've got a hammer or a doji. I think most of you guys probably know what that is. If anybody is not sure what a doji is, put a no out there, and I'll explain what it is. We also have a comment. We see a different color candle with a good sized tail and a close at or near the opposite extreme, like the red bar at 8:30. I'm assuming we're talking about the 8:30 up here, where it came up. You got a good body. I don't know if this is the one. Tom, let me know. Is this the candle you're referring to? Okay, so let's draw an arrow here. So this is what we're talking about. We've been in an uptrend. We've got green, 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 green. Now we've got a big red candle. Got a topping tail. The close is at the extreme. So you're looking at that, essentially as a method of going short. We see some signs up in this area, obviously, on a 5-minute. We've got topping tails coming up into here. We've got a doji up in here. Doji, not necessarily. I think dojis get a lot more emphasis than they should, because a doji essentially is just showing you that there's indecision. It can keep right on going higher. We've got another comment. We've got, let's see where I'm at. Okay, looking at trend lines broken with high volume would be one. Current candle closing below the previous low, or closing below 2 previous lows. So you get, I'm assuming like that would be a situation like this candle right here, where your candle's closing down below 2 previous lows, except you're going to be doing that in the context of an uptrend. We've got I like this one, Gary. A long wicked candle. I suppose that would be something like this. That would probably qualify as a long wicked candle. Uh, let's see. Ken, you've got yours thought out pretty well as a system. You want to see price at a level like it is now at the 1221 area, where you've got multiple topping action, multiple tails, stuff of that sort going on up here where we are right now. So here's some things that, as you can tell, as we've reviewed these things, any of you guys that are trading price action are probably looking at all of these same things. Would that be a safe bet? You're looking at topping tails, you're looking at dojis, you're looking at engulfing bars, you're looking at breaking down below prior lows. Those are price action triggers. We're looking at the price, we're looking at the way the candle formed, and then that's causing us to take a trade. So I have to say, for me, I do the same exact thing. It makes a lot of sense to me, and I've done that for many years. That's what price action trading is. You're analyzing this, and you're coming to the conclusion based on where price is going that this gives you a probabilities for a trade. The thing that we can do with this is we can look at this as a contrarian, or we can look at this as a pattern that's going to happen over and over and over, and we can either trade it as a contrarian or we can trade it as a pattern that's going to happen. I came to the conclusion in looking at price action trading, candlestick patterns. I spent a lot of time and effort on all the Japanese candlestick terminology and came to the conclusion that it really didn't matter. I spent a lot of time on opening and closing above and below candles, and I found that it worked very well for trapping people, for finding people on the wrong side of the market. If there was a large trader there who was running the same mentality that I was, where he was going to take advantage of their stops. And to illustrate that, we're going to just look at current price as we sit here right now. We have the criteria that most people would look at to say it's reversing. We've got some topping tails. We've got multiple candles up. We've got dojis showing indecision. We've turned red. We fought. We're coming back down. We're trading lower. If that's the case, a lot of people are thinking short right here. Where are they going to put their stops? Would you agree you would put your stop right over this high? Says the ones that are putting comments in, most are agreeing, yes, you would put your stop right over that high. So how does that create a problem for us, do you suppose? If I could just guess and draw a line there where everybody's going to put their stops, do you suppose that a quant firm could look at that same place and say, let's run it through there? They look at the volume, and they're coming in here on these candles, and they're saying for every person that bought right here, somebody sold. For every person that sold, somebody bought. So we could look at the volume that's here and say we've got 17,000, 6,000, 4,000, that's 27,000, 32,000, 35,000, 42,000 contracts roughly that went off in this area. So how does that become appealing to a large trader if he realizes that at this point there were people that were going short in here, and there might be 25 or 30,000 of those traders had initiated a short position right there? See, that's a place for them. If the market is slow, things are under control, they can come in with their bot and they can run it right through that level, or they can come in manually and run it right through that level. So, when we look at the typical price action, I guess that puts a conundrum there in our minds. Are they going to trap us here, or is it going to work this time? Their position is a lot easier as a large trader because they simply know there's stops here. Should we take them out or not? If they say no, let's just take it down this time, then they just take it down. right? They don't have to try to wonder what the market's going to do. In a position like this, they could make the market do something for a period of 15, 20 minutes. They can push the market around. They can't do it long term. No one can long term. But short term, they can push it around enough to get your stops. But they've got the luxury, and you would have the same luxury if you were running a hedge fund, and let's say that you had $500 million in your fund. If you sat down right here, you could say people are expecting this to get back up off the high based on this pattern. Um, I think people are going to be going long right here on the pullback, and I'm going to trap them and roll it over. Or you could say, we got 40,000 contracts went short up here. Let's run it through and get their stops, and then I'm going to lunch. See, you've got the luxury of doing whatever you want to do. You're looking at it. You don't see any other big boys messing around. Market's quiet, and yet people have a position where they could easily be tripped up. And yet, according to price action rules, all the criteria is in place. But here's the problem with price action is frequently you're getting a fill. Like if you're waiting, we had one of the comments was you wait for it to close below 2 candles prior. Let me just delete this stuff off of here real quick. And let's just take this at the top where we know it reversed. But we're coming in and we've got one method of doing this that says when it closes below the prior 2 candles. So we've got this right here as our close. That shows up okay. And we're getting in that position down here, and yet the high is clear up here, almost 2 points above us now. So if we wait that long, we do get confirmation, but what do we have to do with our stop? So we have to jack the size of our stop back out there. Now we may need a 3-tick or a 4-tick stop. So we have to do the math and say, okay, if we get to the low, do I have, I shouldn't say a 3-tick or 4-tick, a 3-point or 4-point stop. And then we have to look at this and say, do the math, do I have that much room for a target? If this is just a fib pullback, if this is just a retracement in this ongoing uptrend, and I get short right here, do I have room to get out of the trade at a 1-to-1 or better risk reward before I run into some possibility of a bounce? And we have to say, no, it's going to be tougher to do. If we get a bounce at the 38.2, this uptrend has been strong. If we get a bounce at the 38.2, we've only got a point there, and yet we need a 3-point stop. So at times we can create problems for ourselves because of some of these strategies, even though there's validity there. I do think in those kind of situations, you almost have to take it with faith that there is a valid target down here, and just walk away and let it work, because you'll manage yourself into trouble. But what I want to address with this specifically is there a way that we could use the tape to clean this up and get in there quicker? We come in and look at the indications that we've seen on the chart, and we might be watching this level now because we've looked at it on our chart and we've spotted an area where it appears that they're trying to hold it. And we watch it on the tape and it breaks to the high. Would this be a very valid place to come back in and start watching the tape as it breaks? And I say yes, it is. For you guys that have traded with me, you probably see me take that trade more than any other trade, is breaking to a new high. And the S&P, more times than not, is a faders market. You come and break to a new high, you get your new high, 3, 4, 5 ticks, and the sellers jump on it and knock it right back down. There will be days when it just runs all day and you get a couple stops, you identify pretty quickly that's the kind of day it is and leave it alone. But you take that breakout and you watch that 3, 4 tick new high and you see sellers start jumping it, your position could be right up here in the top part of this tail. You may be getting a fill right in here instead of getting a fill down here when you've closed below the prior 2 candles. Yeah, with your question there, we're referring to multiple things. Essentially, I'm talking about the one that said close below 2 prior candles, But we've got an engulfing candle here. Several of the criteria that was laid out is all present in this bar. We've got topping tails over here. We've got a doji, which some said they look at. Up here, we started higher and then whipped around and sold off. So we've got probably half a dozen different criteria on a price action basis to take this trade, but it comes down to finding a trigger. If you're aggressive and you take it on the first candle, you're going to take it on the close. I shouldn't say the close, but you could take it on the break of a prior candle. That would have got you in over here and you probably would have stopped out. So some people say, well, I won't be that aggressive then. If that happens frequently and I get stopped out on this little break lower, so I'll wait for it to close lower. Well, here, this candle, you got your close lower. So if you go in at the market, you're going to be, a fill. Let's see where this one opened at 23 quarters and this was closed out at 23s. So you're going to get a fill at that point of 23s. That's where your bid-ask spread would have been at that point when it closed. But could you have gotten in at 24? Could you have seen that coming on the breakout? And that is what I do trade after trade after trade after trade. I tend to sit there and wait a lot for it to get up into these highs and get a 3-4 tick new high on the S&P and then jump on that. So what does that do for me if I can see that off of the tape? The benefit, one, I picked it up at a level where a retracement isn't going to come back out or the wiggle isn't going to come back up and kill me. Two, it gives me extra target. If it does only go to the 38% retracement, I can be at a 1-to-1 risk reward. If I come into that high and I get 3-4 ticks on the high and I see sellers jumping it, I only need 3-4 tick stop. I don't need to worry about a 10 tick stop, and I can adjust my stop down. And I can be coming in here about the time most price action traders are taking their position. I'm actually coming in and closing out my first targets. So if that's the case, is that something that's going to be beneficial to come in at that point on the tape? And again, we're looking, remember the criteria that we set out. We start seeing the small guys speeding up. We see the large buyers disappearing. We see the tape perhaps slowing down after that flurry, when people are tricked into that breakout and then it slows down real quick. We come back in there and see large sell orders dropping in, and we immediately have the confirmation we need for the trade. We hit it. To me, when I trade that, I find very frequently getting entries 2 or 3 ticks or 4 ticks off the high, and frequently out of that where I don't get wiggled out. Now we think about what you would be going through if you sat here through this section of the trade. If you got in this trade on the close down here at 22, is you're having this thing go against you a point, and it's going sideways for 15, 20, 25 minutes before you finally get more than 1 tick into the profit. What does that do to you psychologically? You get in a trade, immediately you're upside down a point. You gave it a 2-point stop, and immediately you're halfway to your stop, and then you go sideways for 15, 20 minutes. And as you watch that, you're just sitting there sick to your stomach. You start thinking about whether you should kill it or let it go. Do I kill it? What should I do? And what I've observed, you guys can speak for yourselves. Some of you are already saying this is what happens to you. What I've observed people do, eventually, they take profit right here. Close the trade out 2-3 ticks. They work themselves to the point that they can't stand it anymore. They take the profit, get 2-3 ticks on it when originally they were going to go back down into this low. Now stop and think about how that affects a person psychologically. I mean, it's just devastating psychologically. You sit there and you were right. Your entry perhaps wasn't timed the best, and you bail out, and immediately you're relieved. See, the trade's gone, the pressure's gone, and you made money. You made 37 bucks. And then you watch the thing fall 5-6 points and go, I did it again. I made 37 bucks, and my goal was to make 350 bucks, and it went right down to my goal. and I never got it. And see, that's where I look at things and say, does it take more guts to step in front of it up here? If I see the sellers hitting it, if I see it happening, yeah, it takes more guts to do that. But bottom line, once you're in it and it immediately moves positive, and then you get a little wiggle and it moves, back up against you. You come back down and you're positive again, and you've never had 2 ticks of heat. Are you going to be able to hold it as it breaks? Heck yeah. You're excited now. You've been in profit for 25 minutes, and you're starting to lick your lips because now you see the momentum coming in, and now you're saying, now all I got to do is move my stop down here, and I can still lock away a point even if it comes back now. And you can let the thing go. You can start trailing it down. When we talk of management strategies, start trailing it down over the high of these 5-minute candles. You're getting down to your target, take the thing off and start looking for the next trade. See, I look at the comments that are out here, and obviously you guys are experiencing that. Um, that is what happens to me, one says. I fall into that class. Sickening. I am not seeing the price action early enough. I think that is what I told you the other day. I'm worn out by that. So you're getting in there, and it's just, by the time things go, you're in trouble. So when we look at price action, then, can you take the same thing you're using right now and then apply the tape to that? So you're still gonna come back to those same factors that we've been going through for a couple days now. That coming up into these points on the chart, it doesn't mean don't watch a chart. You're going to be a tape reader. You're going to be better off watching the chart, taking what you're looking at, taking what you're understanding, and then taking the tape to make the decision. So we think of this then, at any point in here, could we be doing the same thing? Well, I would say by now I would have very little interest in it. I'm interested in it that first hour of the day. That's where the money is for me. And the end of the day is busy, but I don't really like coming in the afternoon, especially if I made my goal in the morning, or 1.5 times my goal. There's no way in the world I'm coming back in the afternoon. And if I had a rough morning and I got beat up, I'm not going to come back in the afternoon and add to it. I tend to be a trader that just goes into the next day and say, screw it. I'm not going to dig myself a hole so deep that I can't get out of it in one trade or 2 trades. So if I have a rough morning, I'm done. I take the good part of the market. Could we still do it right here, right now? Yeah, you could. You could still be looking at your same factors. You see it going sideways, trying to determine whether it's something you should do. The problem is it's slowed down to the point that you're going to think you see things that aren't there. I do feel that even though the tape is going faster and it's more violent early on in the morning, ultimately you're still going to get better signals off of that than when it just starts chopping sideways and you're moving up and down 3-4 ticks and looking like you're just going to drift. But let's expound on this a little bit further. A 5-minute candle, nothing wrong with using that. 5-minute candles have been used for many years for intraday traders with success. Do you need an indicator, moving average? No, you should be able to read that on price action by itself. You will get some false signals at times. You will get in early at times. You might have come in over here as you broke up again here. And you might have got into a short there and went through the same thing where you were a little positive and it moved up through and then pulled back. You might get in a little early, but bottom line, you're still up there high enough that even a reasonable little 6-tick stop would keep you in the trade. So I look at that kind of stuff. I think that's very powerful. Some people need a little bit of extra help to see it. So let's look at something we could do for a little bit of extra help. Find my drawing tools, get rid of the drawing. We're going to come in on an indicator and we're going to add a simple moving average. There is a reason, if I can find it, SMA. There is a reason that I look at this and put a 20-period simple moving average on. If I look at what other people are teaching, there are dozens and dozens of educators over the years that have told people trade a 5-minute chart with a 20-period moving average And if you need more trades, go down to a 2 or 3 minute chart with a 20 period moving average, and you play this with a rubber band theory. I don't know if that trade makes sense to people, but some call it a snapback trade, some call it a rubber band trade, and essentially what they're looking at is a move that moves up, extended away from the moving average. At some point, it's going to snap back to it. If they see that at this point in time, their mentality, and I should say at this point in time, their mentality or their strategy is to buy it. Now, why would they buy it there? Price action trader who understands a moving average looks at that and says, chances are it's going higher. We've got our pullback. It's pulled back to a moving average. People are going to buy it here. We have a different mentality of trader that looks at the move off the low, the move up to the high. They happen to notice that it coincides with a fib retracement. What are they going to do? You've got a definite uptrend through the pre-market, through the morning session. Now you're getting your first pullback of this morning's session, and you're pulling back to a moving average, which happens to coincide with a fib retracement. Does that make a guy look like he wants to go long? If you're a trend trader, you're licking your lips right there. So what is going to be their signal? See, they're going to do the same exact thing that we were just talking about. They're going to be looking at bottoming tails. They're going to be looking at engulfing candles. They're going to be looking at trade above a prior candle, and that's going to trigger them into their trade. Yeah, Gerardo, I'm sitting at 25 minutes right now on this piece. I appreciate your reminder there. I'm like, I don't want this to happen again. It's really frustrating. I'm going to let it go a couple more minutes, and then we'll go back and look at some examples on 2 and 3 minute charts. I seem to be able to get away with it at about 35 or 36 minutes, and the last one went 42, and it killed me. But I look at this pattern right here, and you got to bear in mind, if we were watching this at one point in this candle, this was a big, tall green candle right here. And individuals that subscribe to that theory are looking at that and they're saying, go long, get long, we're going for new highs. Now, when I look at this, I go back around 15 years. Pristine was one of the biggest educators at that point, and they have traded literally tens of thousands of traders to play a 5-minute chart with a 20 period moving average. Exactly this strategy. Pull back into the moving average, you trade above the prior candle, there's your long. So anybody that was traded that way tends to think that way. It's a valid setup. They're going to enter it. Barry Bonds, Top Dog Trading, same thing. Play the rubber band, play the snapback. Everybody seems to gravitate towards that. Your moving averages, they're either looking at it like this or they're looking like moving average crossovers or rollovers. So if that's the case, at any given point that this happens, we may have thousands of orders coming in long from traders that are trading this philosophy. Well, again, we can look at it and say, if we're a contrarian trader and we missed our short entry up above, can we get anything out of this? Can we use the same methodology to track this down and find out who's going long, who's going short? Well, we simply come in here at the time that it breaks this candle, right here, this little red candle. Actually, let me draw that somewhere else, because that's the time that it breaks this little red candle. And we're watching the tape to see what happens. We start trading higher. Do we see one lots accelerate? Do we see one lot buyers coming into it? You know, who is that? These are traders that are probably trading it for a snapback. For a rebound off of this moving average. We've reverted to the mean. Now we're going to head back up again. So if that's the case and we see the one lot guys accelerate, all we need to see is somebody come in and start selling it. Do we have a second entry there? We see some big sellers immediately hit it again. We've got another opportunity to go short. when that happens, again, we don't need a huge stop to take advantage of this. When we get our breakdown, very quickly we can get to a break-even status on the trade, start trailing the trade down. What's happened is anybody who had that expectation, who started going long here, we know that, and I shouldn't say we know, statistics have shown from brokers that most day traders on the S&P are placing a 5-tick stop. That's their comfort range. 5-tick, 6-tick, that's about all they want to give it. So for guys that came in here and bought this, we look at this little candle right here. High and low of that candle is 3 ticks. If they took an entry when they broke the top of that, they fill safely then 1 tick below this. That would give them their 5-tick stop. And they may go 2 ticks below it just to give it a little wiggle room, and they go long. Did a lot of people jump in there? You know, that candle, 12,000 lots traded off. Is there enough people there that are trapped that when you come down, you're going to see acceleration of stops as it blows through it? You have to say, yeah, it happens day after day after day. So there can be some real distinct advantages to taking this right here and thinking about it. If you miss the trade and you chickened out the first time, what do you have to see to get back into it? Do you get back into it on a retracement? Do you get back into it when you come back into the moving average and you see people that are trapped? So either way, it allows you to pick it up. And again, you're looking for the same thing when the trade sets up. Do we have little guys rushing in and big guys selling? Short it with the big guys. You know, do we see big guys buying, big prints coming through, big pushes of prints coming through simultaneously on our tape that indicate that everybody's buying? Go with the long. But see, what happens is in a 5-minute chart, we have all the time in the world to develop a scenario and say, okay, plan 1, when I see the evidence of topping, I'm going to let this thing break to another new high, and if sellers hit it, I'm going short. If sellers don't hit it, I'll let it go. If I miss that, and it does become evident that it's starting to roll, plan 2 or plan B, I'll take a retracement. What do I do on the retracement? Let's get a 50% retracement, and if I see sellers hitting it, I'm going to go short. That fails. I chickened out then. I wait again. Plan C. Well, let's get it into the moving average, and if we come into the moving average, and the moving average is still sloping up, and I see 1 lot buyers buying it, and I see big sellers hitting it, I'm going to short it with them. See, in a sense, we've taken one setup that we're watching. We could chicken out 2-3 times, and yet we can still come back in, put the thing together, make it work, and find an entry that's going to be safe. But each time we do this using price action, we're going to take the tape and we're going to look for the same factors. Are the little guys rushing in the wrong way and the big guys going the other way? Go with the big guys. How do we identify it? On the S&P, we're going to see the big guys as a flurry. Where it becomes apparent that this was a market order that executed off, we want to see maybe 10 or 12 lines drop into place on our filtered time and sales, where you know somebody just put a 300-400 lot sell market order, and we're going in. That's all the confirmation we need. At that point, we can put a reasonable stop, and we've got a reasonable expectation of a target. We break through the low, we see acceleration as it hits stops, we move our stop in to break even. If they get stops, and that's all that's there, and they give up, they're going to turn it back higher. We're at break even, and we gave it a chance. And then we can just start trailing it down over our 5-minute candle. The same thing will happen on a tick chart, except on the tick chart, we're going to see the little, get my pin back on here. On a tick chart, you know, as we're watching it, it's going to be the little swings where it comes back up, and it comes back and narrows, and then it breaks. So there's going to be a little more wiggle where this may be 1 5-minute candle, and this may be 1 5-minute candle, and this may be 1 5-minute candle, and so on. We're going to have all the little swing highs and swing lows in the moves. And so each of us, you know, we have to determine for ourselves what makes more sense. If I'm watching a 5-minute candle and I'm simply looking at where it moves and where it closes, or does it make more sense to watch a tick chart and watch the swing highs and the swing lows, and when I see evidence on the tick chart that it's rolling over, then I'm going to come back in and short the next retracement if sellers are there. See, however we do it, just get comfortable with it. Time frames don't matter as much as our interpretation of the time frames. I do it on a tick chart because I just want the bars uniform in the overnight session. Somebody else likes it on a 5 minute because that gives them patience. I did it off a 5 minute to force myself to do it on a 5 minute. I had to set a little egg timer for 5 minutes. And then that timer, as soon as it fired off, I would immediately reset it. I would look at the chart and then I would not watch. Let it go until I had my setup there, but I had to force myself to keep looking at it. A tick chart, I can watch it form, and it's more interesting to me than watching a 5 minute chart. So it's just personal preference. I'm going to stop there, reset the tape, and then I'll be back in 2 minutes, and then we're going to switch this over to a little shorter time frame, look at some other things that we can do with it here. If you guys have any questions about this, go ahead and print them out here right now while I reset the tape. Okay, so we got that one saved away. Let's see if we've got some questions here. There was one earlier, but I wanted to wait to address that question. Sean, you had asked earlier if I could explain whether that can be applied to the 6E as effectively. For the most part, Sean, price action is price action is price action. You can come in and look at this, on crude. You can come in and look at this on the 6E. You could come in and look at this on the, on the S&P or the Dow or the Nasdaq. And all you have to do as you're doing this is you take your particular market, in this case the 6E, you chart that out, and then you try to observe what the tendencies of that market are. That's where I've always encouraged guys to try to trade one market. If you can force yourself to do it, you'll be a better trader. If you can sit there and watch the 6E over time, and you see the tendencies of that market are to trend and to run, what would that tell you your odds of success are when it comes to price action trading? See, essentially what that would tell me is if it tends to run, I would be better off buying retracements or selling retracements. So you take the market that you trade and you look at the tendencies of that market and then say, okay, I'm going to apply all of the same things, but this is my trading style. This is my plan here because this is a trending market. If you want to scalp the 6E, you will see frequently the bottoming tails or the topping tails, and these tails may push in here 10, 15, 18 ticks in the height of a candle. These tails may be 7, 8, 9, 10 ticks of that, and the next 5-minute candle will push right down to the same level and pull right back up. Next candle, right down to the same level, pull right back up. And you'll frequently get that where it will base a while, and then it will take off and keep right on going the original direction. I have always looked, and I would say it's probably a safe thing to do, is you look at consolidations as a continuation pattern the majority of the time. Unless you're proven wrong, a consolidation pattern usually will lead to continuation. But even for a scalper on the 6E, you will see that drop to a level. It looks like it wants to be a reversal. It will push down and come right back, push down, come right back, push down, come right back. And you can't get through the highs. You watch as it moves up into the highs of the candle, and it comes back to the middle. Gets up into the highs, comes back. You get up into the highs and the sellers hit it. So when you start looking at the 6E, you have to get kind of familiar with how it moves. Is it something that just keeps going and going and going, or does it tend to establish a range for the day and then work back and forth in that range? And each of us needs to do that on our instruments that we're trading. So if that's the case, I guess that hopefully gives you enough of an answer as to whether that can be applied there. But those principles, people tend to trade charts and patterns, and they will go trade it across any market. It's human behavior. That behavior repeats over and over. And so you'll see those things very frequently that just keep on going, keep on happening. Another question here. Let's see. Yeah, I will review the drills at the end of the session, Karen, no problem. See, when you mentioned picking the high and low print, as watching tape to see if you can visualize what a candle might look like. I am not sure what I am doing. That kind of goes back to what we were talking about earlier with bracketing trades, or excuse me, bracketing on our tape. And we're trying to remember two numbers on our tape. We come in and we see on our tape, remember we had this sequence of prints, and hopefully this is what you're asking, but we see a sequence of prints go by, and in this sequence of prints we have prints as high as 90 and as low as 70. And we're sitting here watching our screens, and you know, we can do this because we're sitting in our little room, our little closet by ourselves, and we can just say 90, 70, 90, 70 as we watch this bracket build. Well, if we were to look at that as a candle, you know, we would just imagine a candle, and here's where our current price is, and here's where we started watching it. This is our high at 90, and then we realized that it got down as low as 70, and right now we're sitting at 80. And so in a sense, as we're watching that tape, if you're going to do that just off of the tape, we're kind of just drawing that in our head. We've got a high at 90, we got a low of 70, and here's where we're at right now. It's more like your you know, if you had to compare it to a style of charting. Actually, let me just change this. You imagine what it would look like is just a high-low bar. You simply have a high and a low of each period. And then where we would slightly differ from that would be that in this candle, like where we are on whatever current candle it is we would just know here's where price is right now. So if we're watching that, you can see why that becomes very fatiguing to do that without having the chart. The chart is there, and it can give us perfect recall. We don't have to memorize it. And if we need to look back over, we can say, hey, this came up to 3/4, drop back down to 19/4. If we get a push back up into here, I'm going to short it. You know, if I see sellers coming onto it. It's definitely going to be easier to use your chart than to try to build the chart in your head. Not everyone can do that. So where you say you can get kind of confused doing that, um, you know, or tired, I think you've mentioned before you get a headache doing that sometimes. If it's affecting you that way, then don't try to memorize the numbers. Simply look for the vital things that will help your trading. Now, you mentioned also in your comment here, that sometimes you see large block of buyers and then a large block of sellers and get a little confused with it. I tend to agree with you, but I don't let that stop me from getting into the trade. I realize that at any given point, there are people with opinions both ways on the market. And if you look at the tape, it's going to go red, green all day long. And in that sense, it can be just simple noise. There's always people that think it's going up and they're going to buy. There's always people thinking it's going to go down and they're going to sell. But what I'm interested in is identifying some type of pattern or some type of uh, logical level where at that point I have an advantage. But the advantage that I have, or that I want, you know, I want to see that at least some big traders are on my side. If we come up into a level and there's no interest, you know, I'm thinking like in this scenario, let's say that we're sitting right here, and as this starts to break higher, there are very, very few sellers hitting it. See, it's always kind of comparing that back and forth. In a sense, it would be looking at the delta, but you're looking at the delta in your head. And remember, the delta again would be taking all of the trades, all the buy market orders, and then they're subtracting all the sell market orders. So if I come up into this point and I see 4 or 5 screens of buy market orders and 10 lines of sell market orders, then why would I go short? You know, if everybody is buying it here, why would I go short? But I turn that around, and very quickly as I come up into the top of the candle, price may have gotten dear enough that that delta instantly rotates on the tape. Now, we won't see the delta rotate like on your indicator. That delta won't finish off until the candle's done. But on the tape, you can see that rotation, and those are the times I'm most interested. If I don't see the rotation, then I'm not taking the trade. But when I see the rotation in interest, where in my mind the instant delta has gone to all selling, even if there's some buy orders coming in, it is dominantly turned to selling. Very quickly I will trigger into the trade. And I want to do that before the waterfall, before the cascade, before it gets the stops. I just want to see a shot comes in which indicates large market seller, and I'm in the trade. There's one caution, and I will emphasize this to you guys. Note this point down. If you're doing this and you're coming up trying to whack the highs, if you get the new high, the first sell prints that you see when you punch to the new high, the first flurry I look at and say that could be profit taking, because smart money will take that. They realize that this can punch and then roll right over, and so they get that high and they're going to take some money off the table. So the first flurry, as we break a high, I would say that first flurry of sell orders is very possibly taking profits. And if it reoccurs, it happens again immediately, that's new positions being initiated. So, just keep that thought in mind. You when you comment, you don't know where the best place to get in when you're at an entry level. This is essentially, to me, a grit your teeth and pull the trigger kind of trading. We laugh about it in a room. It's the pucker factor. Those trades are you could stand up and your butt cheeks are clenched so tight you pick your chair up. This is not, this is something where it really does require you to be decisive if you're going to do it picking reversals. If you're picking continuation, I'll discuss in a minute some of the things we can look at for continuation trades as well. But again, most of what we're talking about right here is looking for reversals. So if you're looking for reversals, you have to remember it takes some iron constitution to come in there and trade this. I mean, when your next candle starts forming right here, and that candle opened at 24 and it's screaming up to 25, and you're thinking short, not an easy thing for everybody to do. So for some people, they would rather see it break, they would rather see it confirm, they see it move down, and you got to remember on a tick chart. Actually, let me just do this real quick. We'll add the same instrument in here, but I'm going to just put it in here on a tick chart. Make sure that I've got my settings the same on each of these. This will kind of compress the candles a little bit weird if you put two of them in here, but this will allow us to look at this and put a cursor on here. And we're talking about these two candles right up here when it started to sell. And let's say that we do wait for the confirmation. This lines up here, and we know that this green candle is going to be the little retracement down below right here. So let me get rid of the cursor because I can't stand it, and let's put this on here. If we do let it break and we wait for the little bit of extra confirmation, if we can't stomach that running into the high and just pulling the trigger, remember what we have on a tick chart, which may be easier to see, is that we started to move down. We broke this low back over here on that move, and now we've retraced halfway back up to the high. And again, at that point, we can see, do the sellers come in the same way that they just came in right over here? For some people, it will be easier to do that than it will be just to step in at the top. I think it gives you more confirmation, and in that sense it feels a little safer, but it also gives you a slightly lower entry point. In that case, you've got less target in front of you and you need a bigger stop. So I think it's kind of a double-edged sword. You get the confirmation, you need a little bigger stop, you need a little smaller target. If you're willing to step in there in front of it, you can do a smaller stop with a bigger target. So it just depends on what feels comfortable for you. But if we keep in mind there are multiple strategies for getting short there off of the same 5-minute chart. One of them is to be aggressive and just step into it as soon as we see sellers. If we chicken out, let it retrace, hit the retracement as soon as we see sellers. We chicken out again as soon as we see the guys trapped here that started going long off the moving average, hit it again. We got another short entry. And so each time you go through that, if you're confused, let it pass. You still got the same setup. Now you have to just ask yourself, what would be the next way of entering the same thing? To me, the first retracement is usually good. I wouldn't take the third retracement, but would I take the first one? Absolutely. And especially if I can filter that on the tape and say, did I see the same exact thing that I just saw the last time? So that's, we can talk about that a little more later. Hopefully that helps. Getting in late, it is dangerous, like you say, Karen. You take heat and you don't get as much out of it, and it makes you nervous. And I would say, yes, that's very true. And just the thing to remember, it is difficult to step in right at the high and see it. To me, the easiest one is the S&P, just because I like to see it break out to a 3-4 tick new high. Crude, would I do that on a 3-4 tick new high? No. As you know, with crude, that's a good way to get your head tore off, is short and 3-4 ticks off a new high. You may punch 20 or 25 through it before you pull back. So, you have to know your market, and you have to figure out where you can do it, what strategy works best in that given market that you decide you're going to trade. Let's just ask a question out here. I killed us today with that recording getting lost and having to sit there and wait for that to be processed. Does anyone have to go where they can't stick around a little longer? I know we're already past the 2 hours. If anybody has to go, we can always take back up Monday. We're running a little bit ahead. But if you have to leave, I won't keep going on other topics. But if everybody's able to stick around for another 15, 20 minutes, I'll finish it up and make sure we still get a good lesson here. I think for Pete, you're probably the latest in the evening of anybody in here. So Pete's problem, though, Tuba Tom is taunting you saying it's Friday, but the Pete's problem is he's got a little baby too that's going to be screaming and waking him up in an hour. So he may not have much fun, even though it's a day off tomorrow. So I'll leave that. It looks like everybody says they're okay with it if we can go for another 20 minutes. So let's go through this, and we'll change our time frame a little bit here on the chart we're looking at. And what I'm going to do is just go to a 2-minute. We're going to talk about kind of the same thing, but we're going to look at it more from the standpoint, again, of getting extended out away from the moving average. And we would essentially be looking for situations where it does get extended out away. Now, this is pre-market. We realize that was something that popped up on news. Yes, you're extended. Yes, you reverted back to it. So we're not going to do stuff that's there in the pre-market. We're going to try to come back over the last couple days and look for situations where we could take advantage of people who are taking positions and who are getting trapped in positions. When we look at this on a 2-minute chart, and this is yesterday at the open, your moving average is fairly flat. It's still sloping up a little bit. And one of the questions I always ask myself when we come into that moving average, do we see any indication that it's going to bounce? And if we say no, we don't have, and let's just put this over here. We'll try to just walk through it honestly. There was no indication on the chart that it was going to bounce. I mean, you had a doji, but the doji was not enough of itself to get people long. There were obviously some buyers there that came into it, and they pushed it to a neutral state essentially. But they continued right on down. So you never traded above a candle, and you'll see that that's usually a big trigger. You trade above a prior candle, that's where you see buyers start rushing back into it. So we push back up. Now we've come through the moving average. we push back up into it. If you subscribe to the theory of the 20-period moving average being support or resistance, would people start looking to short this? I mean, you've fell down back to the low of the day, you rally up, you saw this candle solid green at one point and they pushed it all the way back down, you've got topping tails. Would that be enough to cause a person to get short? I could see where it would cause most people to think short. They haven't rolled over, they haven't broken and gotten a downtrend yet, but it's looking weak. When that trades lower and the candle closes here, does that look like a short? I'll let you guys vote on that. There may be things that some people would look at that say, well, no, I would be cautious until we broke a prior low and we made a lower low. Some people aren't as cautious. Some people don't stop and look at those things. If they're looking at pre-market stuff here, you had a low and you broke it and then you made a high and then it couldn't get anywhere really when it pushed back up, and you obviously came sell up in here, and then when you rolled over, there was no bounce at the 38, there was no bounce at the 50, there was no bounce at the 61.8. You could look at that and say it's still in an uptrend, but it's starting to look weak. Some people will feel that. To me, I may be down in here looking to buy this, and somebody else is looking to short it up in here. But you look at that pattern that's there, you traded back higher into the moving average, you made a doji, and now it's traded lower and closed lower on a 2-minute candle. And there will be many people who look at that and say, short it, sell it. Where are they going to put their stop? We know the stop is going to be right up here, right about where the moving average is. Just get it up over that high. That'll prove to them that they're wrong. So I tend to look at those kind of scenarios and say, can you trap some people in those kind of scenarios? Well, obviously you can. And any large market maker, any large firm out there, any fund out there could very well trap people in that type of a scenario who are getting a little aggressive on their short. So what would be the trigger as a price action trader that shows me those guys are about to get trapped? That's when the next candle or the next 3 candles, I would give it as much as 3 2-minute candles. If it trades back higher and closes higher than a prior candle, these guys are trapped. You think about this candle right here, it's only a 2-minute bar, but you look at the volume, 9,300 people went off in that candle. It's a red candle, sold off. You have to say much of that was initiating shorts. Now, how are those people with those 10,000 contracts filling when they see this green candle form? So you have to say they've pretty much probably feel pooched right there, because now they're only a couple 3 ticks from their stop and they're just getting ready to lose their 6 ticks. So if that's the case, when you see these type of patterns, you could simply place a stop order, an entry order right above the high, and you could just let it sweep you in, or you could watch your tape. If you see evidence that people are getting short, small traders are getting short, and they're pushing it down, and then the buyers come right back after it and start pushing higher. So you may pick that up in here at 7.5, 7.75, and you say, no way, these guys are going. You don't need to let it close at 8.25 to say there's a chance they're going to whack these guys. So again, in any type of situation like this, when people think that it's breaking down and it starts to give all that appearance on the candlesticks and then whips around, those are the situations where frequently you get a very quick explosive move the other direction. You look at this again on a 2-minute chart. The reason you would go to a 2-minute instead of a 5 is on a 5-minute chart, you may get a couple 3 trades a day set up. On a 3-minute chart, you may get 5 or 6. On a 2-minute chart, you may get 8 or 10. So if a person wants to get more trades and they're trading one lot and they're trying to get a 6-tick stop and an 8 or 9-tick target, you're probably going to want to go to your 2-minute and have have more trades firing off than you would be going on your 5 minute and saying, well, I only get 2 trades a day and each one I'm going to make $50. So you guys have to evaluate that. But the interesting thing, you can take the moving average off and do the same thing, but you're just going to be looking at moves that appeared to be extreme moves that gave indications that it was reversing, and then it turns right around and does something different. That would be like a contrarian way of looking at it. When we start trending somewhere, if a person is looking for something to get into, and we'll mention this just for the continuation trade as opposed to the reversal trade, what would a guy need to look for in this type of a case for a continuation trade? If we had a few people comment and say that it's still in an uptrend, it still made a higher low. That can be your continuation trade entry if you're still viewing this as an uptrend. You're coming in here saying, well, it's still kept that low, and your continuation entry is going to, at that point, rotate into this candle again, just coming up above that high, whether the moving average is there or not. We take the moving average off, you still have the same pattern. You came up, made a new high, you pulled back, didn't break the low yet, started higher, it pulled back, you see buyers come back onto it, you say, okay, I'll go ahead and take it as a continuation move and go higher. So if anybody has questions or comments about this, I don't mind clarifying it or clarifying it more tomorrow, or I should say Monday. We can talk about it further, but the aspects of this that I would like you guys to take away is that you've already got some experience at candlestick trading, at price action trading. At any point where you would have your setup, you have to stop and say, where could I come back in and start looking at the tape? What would I need to see? You're looking for a short coming up into this high. You see a topping tail, it starts to pull back, and then it goes higher, and then it just immediately gets kicked back, and then it moves higher. Well, you know that there were aggressive sellers in here. And see, we can do this every day of the market. We know there were aggressive sellers in this candle. They hammered the thing back down, point and a half, 2 points in 2 minutes. They came back and tried to buy it again. What are we looking for? We come back in that. Do the sellers hit the tape again? As we push back up a second time, do sellers come onto it? We know they were just here. It happened 8 minutes ago. If we can't remember what happened, then we definitely probably don't want to be trading tape, because we're comparing what happened 8 minutes ago with what's going on right now. And if we can't tell the difference, or we can't see that it's similar, we're probably going to have trouble with this. So that's where we start studying that, and we look at those, we compare it to what just went off, and say, yes, now they are coming back in again in earnest. This time I'm going to go ahead and step on it. If you correlate that back to what you're seeing on a retracement, you had a move up, that move sold down, even though it was just one candle. Now you got a retracement back up into roughly the 61%, and you see sellers hitting it. You got to trade. It depends, and I would say for each person, as you evaluate your preferences, here's what you're going to have to look at. In any given scenario, a person who's looking for a reversal and a person who's looking for a continuation, they both can be looking at the same time frame, same chart, same price level, same instrument, and they're both looking at the tape to try to determine whether their trade is there. Let's say they both have an 8-tick stop and an 8-tick target. So everything's identical except one of them is expecting it to reverse and the other one is expecting it to continue higher. If both of them are watching the tape, they both should be able to see on the tape evidence that either it's going higher or it's reversing. Can a person successfully trade both? Can you come into that setup and say, boy, I could see it going higher or lower here, so I'm going to just watch the tape? Yeah, you can. But it's more difficult than just saying, I trade reversals or I trade continuation moves. For many of us, it's hard to get one trade down, let alone two. So we're both watching the tape. I'm watching it as a reversal trader. Ken's watching it as a continuation trader. We rally back up here, and Ken sees buyers coming in. He sees a pullback, and he sees buyers coming in, and he's able to hit this at 09 and push up to 10 very quickly and get to break even and say, okay, let's see if we can run for the highs. I don't do anything because I see it's all buying. So I was looking at it for a reversal, and it's still buying. But as it moves up into 10, and I see sellers start coming in, and I see sellers at 10 and 975 and 9.5, I'm saying, hey, that's enough confirmation for me. I've got sellers here, and unless they break off over the high, I've got to trade. Well, Ken's, his tape got him into something, and on this particular occasion, it allows him to move. He sees the buying coming back in down at a lower level, and he's taking it for that continuation, and he's probably at a break-even spot. It flip-flops, and now I'm right for a period of time. So at any given point, two traders using the same method of making a decision and yet trying to take opposite sides of the market, they can still get their job done. Doesn't necessarily create a problem. So for the lesson then that I want you guys to take into the weekend from that is you need to stop and think about whether you want to be a reversal trader or do you want to be a continuation trader. You want to be a breakout trader. What specifically do you like to trade? What feels the most comfortable? If you haven't traded enough to know yet, that's where you're going to have to experiment with it, and you'll find out. Some people cannot stand reversals, and all they want to do is trade a trend and take continuation moves, and they're going to either do that with buy stops or they're going to do that with pullbacks. Other people can't imagine. I can't imagine buying something out of the high. That's just so far out of my comfort level, and I'll do it occasionally. I'll do it to show people, and frequently I end up getting stopped out because I'm not comfortable, and I'm sitting here doing it, and I force myself to do it, and it gets stopped out, and I'm like, screw that, I'm never going to do that again in front of somebody. And then I get another guy that's like, yeah, but I really like breakouts, and I'm like, okay, I'll show you what you have to do. I personally don't like it. So as you guys think about your trading, if you haven't done that already, you really need to decide one style, because I don't think it's going to be real successful to come in and try to have three styles and hope that you're going to read tape fast enough and good enough to make all three of them work. You take one style and then you say, what do I have to see on the tape to trigger me into the trade with that style? See, now you've got a basic setup that may take 4, 5, 6, 7, 8 minutes to form. You're watching the tape as it forms. The only thing on your mind is, what do I need to see on the tape? I'm looking at this for a reversal. I want to see one lot buyers back up into the high, and then I want to see big sellers as soon as it gets up into the fib retracement. I look at this type of a scenario. Let me delete these. Just for you guys that want to know what I personally do with it. If I was looking to short this move on the retracement back up into the high a second time where it just got rejected, I would look at this and want it at least to the 50% retracement. And so as I expand this out, again, this is not a huge pivot, and maybe it's not the best example in the world. Maybe it would be better to find something else. If I want to short a high up in here, let me find one that's a little bit more of a normal top as opposed to one candle that poked up. I can't find anything without it being there. Let's just say that we saw this over here as it's pushing up into the high. And we started breaking down, and now we're looking at the retracement. When I look at that retracement, in my mind, I'm looking at the halfway point, and I want to see it get to the halfway point. I won't typically take a trade just getting to the 38. I want to see it get at least halfway. And somewhere between 50% and the 618, I want to see sellers come in. So if that's the case, at that point in this zone right here, I want to see sellers come onto the tape. So here's what I look at. What if price stays green and it rallies through the 618 and it gets all the way back up in here? Would I still do it? And I look at that, and my feeling on it is, if I come in here and I see sellers step in aggressively up here, and it would correlate back to the sellers that I just saw here, at this point, then I would still take that trade. And I would take that trade all the way up into the high. But if I got into the high at that point, I would say I have to see at least 3-4 ticks outside of this now, and then I have to see the sellers. This little zone here, I'm gonna stay out of. If I saw sellers come in at 1 tick, I'm going to be very, very reluctant to take that trade. 2 ticks, no. 3 ticks, I'm starting to think about it. 4 ticks, I see sellers hitting it. I know I got far enough through there to clean some stops out. 4 ticks, I'm starting to look at it and say, okay, now if I see the sellers, I'll try again and see if we get another push. So that's just personally how I tend to do it. I don't just automatically scrub the trade off if it didn't happen instantly. The markets do bang around a lot, and although I would like to have just a clean hit me and gone type trade, I realize that's not real likely. So I will set the criteria. I would say one of the most important things to my way of thinking would just be that the retracement that comes back up real clean in a fluid move, as opposed to working its way back up like this. Because if it's working its way up like this, I'm not going to take it. Yeah, Brian, on the crude, I want 10, 15 ticks, depending on how violent it is for the day. I want 10, 15 ticks through the high, 20 ticks through the high. Make sure we clear out the stops and then see the sellers hit it again. But I do on the retracements, I like to see a nice clean retracement that comes up. If that comes up and makes a swing high and another swing high and another swing high, what have we developed? We've developed a very short-term grinding uptrend. And if we've developed a short-term grinding uptrend, I have to respect that and be careful. Right, Karen, you nailed it. So I would prefer to see a nice fluid push back up at least to the 50, somewhere between the 50 and 60, see the sellers hit it again. And then I'm looking at this saying, does that give me enough room for a target? If we come down here and it turns into a box, does that give me enough room for a target? Can I get my 2 points, get to break even, and then see what else I can pull out of the trade? Andrew, your question, do you use the NYSE tick chart to determine extremes? I do not. I tend to look at the extremes more on the basis of the price going one direction without a pullback, as opposed to looking at the tick. And the reason that I don't look at the NYSE, at the tick, I guess I tend to think the price I know is arbed together. When they're taking the cash and the futures, the price is arbed together. And the tick is going to show me simply whether the stocks are going up or down. Are they ticking up or ticking down? And it can, to a degree, relate to extremes. And I know, like John Carter, he pushes that. That's one of his big, has to be on the chart, has to have 1,000 tick reading, and then he's just arbitrarily shorting it. I have never in the real world seen success with that. I have seen success with letting price moves go to an extreme, where we look at the S&P and say, to go 10 points without any pullback, it had to be some kind of news. It's not normal. There has to be some kind of wiggle, some kind of reversal. We may look at another market and say, hey, it's got to be 40, 50 ticks without any kind of reversal. That's getting to an extreme. I'm going to start looking for shorts. And then you need to have it up against something and so forth. You couple it with something else. But as far as using the NYSE tick, no. I used to years ago, and I came to the conclusion that it didn't do me any good, in the long run. The stocks were ticking up. I hear people all the time saying, it's the tick. Well, the tick, I got to get the tick doing this. Well, the tick isn't going to do that unless the stocks have already moved kind of to extremes. So if the price has moved to extremes, that's good enough. I wouldn't say that to talk somebody out of it, but I wouldn't, if you don't have access to it, I wouldn't go pay for it. Let's leave it that way. I wouldn't go pay for it, for the data feed. Let me reset this tape real quick. And for those of you that want to stick around, I'm going to run back through the drills again for Karen. I'm going to reset the tape and I'll be back in 2 minutes. Okay, got that one done too. Any questions on this, or can we put this topic away for right now as far as coupling price action with with the tape? I'll give 30 seconds here. Anybody that's got a question, put a Y out there, and then I'll wait. Otherwise, I'm going to take the chart down. Okay, so I'm going to take the chart down. Let's go back. We'll look at these drills again, and I'm going to just let me put the slide up here. Karen, the drills that I was mentioning for doing the tape, one was to identify the bid or the offer just from looking at the numbers going by. And remember, we went through this and then we touched on it again on some further questions that as we see the prints, remember what a red print indicates which price, the bid or the offer. Anybody want to throw that out there? Okay, Tom. Yeah. Yep. Now, Karen, that's still and this may be confusing you, but remember the red print, that is the bid. If we're color coded correctly, remember the market order, right? The market order coming in, if it's red, that's a sell order. And if it's a sell market order, that has to hit the bid. You can't sell market to the offer. So that may be confusing that issue just a little bit. If we see a red print, we know that the bid is at that price at that moment that it was executed. So we see a series of red 37s, we know that the bid is at 37. We see a series of green 37 quarters, we know the offer is at 37 quarters. So as you watch that then, back and forth, you're trying to figure out where your spread is. And if you identify where your spread is, this is just the way that I look at the tape. I know where the bid-ask spread is. I know where I could get executed within one tick on a market order. I can then start to see whether or not they're able to hold a level. And by holding a level, remember what I was talking about. Let's say that the bid was at 37 quarter and it dropped to 37, and then it went back to 37 quarter and the bid dropped again to 37, and they're not able to hold it at 37 quarter. Well, you will see that on the tape if you can identify the bid and the offer, and as you watch that flow coming in. Again, this is something that if you guys want to write it down, let me just let me grab my pen if I can find where my pen rolled off the desk here. If you guys want to write this down just on a sticky note as you're trying to do this, we're assuming here that we're talking about prints at the same price that come in right back to back. In other words, we got a red 37, and then the next print is a green 37 right on top of it. So we're talking about prints back to back at the same price. If you have a red print and the next print is green at the same price, green, man, I can't even write here. I do know how to spell, but I've got my arms crisscrossed over each other so I can write on my bamboo tablet. If it goes red to green, what that equates to, does anybody remember? You got a red print, green print. Let me put the other scenario down here. I'll let you guys put an answer out there. Exactly, down tick. So red print, green print at the same price is a down tick, and a green tick, red tick, that's going to be an uptick. So as you try to identify that, keep that in mind. If they come through at the same price, you're going to be able to tell whether or not they're holding a level bid or whether they're able to hold an offer. See, if they keep going, let's say that they do a series where it goes red 37, red 37, green 37, red 37, red 37, red 37, green 37, red 37, red 37, red 37, green 37. What does that tell you? See, they cannot get the bid to stay stuck at 37, and the offer keeps pushing it back down. Right, Brian, you can't hold it up. They're not able, the way that I usually refer to it is they can't keep it bid. They can't keep 37 bid. They keep losing it, and the offer steps back in there. So it's just a drill. I wouldn't try to do it for more than 5 minutes because you'd probably pass out, wake up on the floor wondering what happened. But try to get that down in your head to identify where the bid and offer is, and then, as you're looking at that, can they keep it at a certain level? The instruments that you're trading, Karen, like with the crude or the 6E, they will lose the level a lot more than you will on the S&P. The S&P, it frequently will take a lot of prints unless there's news or there's something out, you're at a level of interest. It will take a lot of prints to come in there and uptick, downtick. But you'll see that a lot on the crude. You'll see that a lot on the 6E. And, you're getting ready to take a position and you realize you've come to a point of equilibrium after a downtrend, and now neither side can hold a level, and you're just back and forth, back and forth, back and forth. Yeah, watch it on the YM. The YM is another good one that'll jump around for you. The next drill that we talked about was try to just keep a little bid-ask delta going in your head. Karen, if you're going to do that on your system, put yourself up like a 1-minute chart. And when the 1-minute candle starts forming, don't look at your delta indicator, but just try to get a rough idea in your head. And don't watch the candlestick, watch the tape. Try to get the rough idea in your head of where the delta is. Is it, and even if you just gave yourself 3 criteria, is it really positive, is it really negative, or is it neutral? Try to see off of the tape. So you see a screen flash by red and a screen flash by green and one flash by red and one flash by green, and you're going, okay, we've had one of each, it's neutral. If you're seeing 40 sell orders and 2 buy orders and 40 sell orders and 2 buy orders, you should be able to determine in your head when you look at the delta at the end of that 1 minute, that delta should be very negative, and vice versa. If you're tracking that positive. Holding the level, that's what we talked about. Where you're going to look at holding the level is what we were just addressing. When you're looking at where the bid and the offer is, are they able to hold on to that? And then the other one, constructing the tick chart in your head, I would say you start out first with this. First step you try to do is just try to get a candle in your head. And I would say start out with a high-low candle. Okay, does that make sense? You're watching the prints come in, you build a little bracket, you got the high, you got the low, and then you know where you are right now. So after you do that, you may choose to adjust your candle. Otherwise, you're going to end up with what Gary called the wicked big candle or something a while back. You may choose to see if you can remember that. Can you go back and say, okay, the candle was 90 by 70. I'm going to start again from 86, and we're going to start a new one from 86. But can you still remember the 90 by 70? Can you at least remember that 90 was resistance or that 70 was support? Yeah, if you want to look in 1-minute blocks or 2-minute blocks, it depends on how busy it is when you try to do it. If the market's moving, you may get a bracket very quickly, and if the market's real slow, it may take 20 minutes to get a 10-tick bracket. But you're just trying to train yourself to remember those numbers. If you have to write it down on a piece of paper, take a piece of paper and write down 90 by 70 and let that expand out. You'll find that writing it down will help you remember it. You got a 90 by 70, 90 by 70, and you say, okay, set a timer for 5 minutes, start a new one with where it's at. Let's say that it opened up at this point. Let's say that the candle opened up at 81, and it moves down and up and down and up and down and up, and you end up with an 87 by 63. Just write those numbers down or keep them in your head, because that's what you would have to be able to do in order to trade with no chart. You're just going strictly off the tape. Essentially, you're taking the stream of numbers and you're watching the move down and you're watching the move back up, and in your head you've got these numbers where the highs and lows are, and you're kind of gauging the speed that it goes up. You're looking at the speed when it comes back down, and you look at the speed when it goes up, and you're trying to determine where is that faster. I mentioned this on the full tape reading video. If you're watching those prints on the tape and you see it move down from 90 to 70, and it took you 10 minutes roughly to get there, and then you see it move back from 70 to 90 in 30 seconds, what does that tell you about where the pressure is? I mean, you take your move down. Let me just get rid of these last. You take your move down, and this move down was 10 minutes. And then it moved back up, same distance, but it did it in 30 seconds. Yeah, you have to say the buyers have grabbed that and they are in control of it. So as you're constructing that in your head, let's imagine what it would look like on a tick chart. Here's our 90 level up here, and we form a tick candle. Actually, let me do this. And we form candle after candle after candle after candle after candle. And let's say we get one little green one in there, and then we come back and we form candle after candle after candle after candle after candle. And finally, after all of that work, we're down to 70. And then at 70, we see some buyers come back into this. And in 3 candles, we're right back up to the high. Essentially, by judging that momentum and making that tick chart in your head and looking at how quickly it moves back and forth between those levels, in a sense, this is what we've seen on a tick chart. Now, what does that tell you then on the next pullback? Let's say that we do start getting a pullback again, and like yesterday, we were talking about that consolidation. Karen, remember on the 5-minute chart on the S&P you had asked about? And I was saying I don't like those kind of patterns because frequently you'll see it dip out of that consolidation to the downside and then go ripping off through the high. And what did it do? Dips down out of the consolidation, looks like it's going to sell off, and goes banging straight up through the high another 4 or 5 points. On a tick chart, we're going to see that type of behavior where you start forming all these candles again. And as soon as we see that go green and they start coming in aggressive, we're going long. We don't have to wait for it to break this high. We're going to come in here and say, look, this just happened. They just showed me that they're in control. And so the very next time I see them come back in and grab control of it, I'm going to trust that these guys are going to punch it. And as long as you can at least get a target out of this, you got to trade. If that's only 3 ticks away, you're not going to catch me doing it. But if that's 2 points away, yeah, I'll take that trade. So that's kind of the reason I say if you can construct the tick chart in your head, then you can really focus on the tape instead of focusing on the chart. If you can't do that, don't worry about it. It's not for everybody. You're going to go back and look for those type of scenarios on the chart. You're going to look for something that takes a lot of candles to get down and very quickly takes it back, or takes back half or 3/4 of it. And you get another little pullback, and you're just going to say, look, if the same thing repeats, if the same gusto, they come back in here just hammering this thing, I'm instantly going to be in the trade. You're just sitting there waiting with your finger on the buy button. So that was the drills. That was kind of the purpose behind the drills, was to get you prepared for to be able to focus on the tape when you need to focus on the tape, instead of feeling like at that point you still have to be staring at the chart, or that you still have to be staring at the dome. Bottom line, if the tape reading doesn't work out, I think you can take these same principles. If you understand what to look for on a tick chart, you can take the same principles on a tick chart and a dome and make money with it. It's showing you order flow. It's a little slower, and you don't get the sense of the momentum like you do, um, with other methods, but it still will work. And just keeping that in mind, I will show one more thing on a chart. If anybody has questions, put their questions out there. I'm going to throw one more thing up here on a chart. Let me see if I've got a tick chart here. And this is just a tool that is now available. This is in NinjaTrader 7. But let's say that we're looking at those kind of moves, and we've seen coming up into a high here. We see a move and it pulls back, and another move into a high. But here's what I want to show you, if I can remember what it is. I think it's Control F3. I'm going to take this to the bottom of this candle, click it, drag it up to the top of that move, and pull it up. And that shows me that it took 6 bars, took 1 minute and 10 seconds. They come back up in here. This also took 6 bars, took 59 seconds, but they weren't able to get it as far, and sellers come in. We see the next rally on that, and it's starting to look weak, and we can compare these rallies. Still took 6 candles, but it took 1 minute and 45 seconds. See, what is that telling us is happening? It's taking them longer and longer to push it back up. First time they pushed it 16 ticks in 1 minute 10, then they push it 11 ticks in 59, and then they push it 12 ticks, but it takes them 1 minute and 45 seconds. That is in your draw menu. That is called ruler. This is on version 3. That is the ruler, and it's a 3-tick, a 3-click indicator. You click it once at the bottom of the candle, you draw. You click it twice, that establishes your top point, and then you can drag the box anywhere you want to drag the box to get it out of your way. It's a very handy little tool for coming in there and just timing the moves. I suppose some of you guys that know how to program, you probably could program yourself a little automated timer that you take the indicator that shows your pivot points or your swing highs and lows, and you could just program that to calculate the time as well. But see, that's something that, to me, I'm looking at that on the tape and I'm saying, boy, it's a struggle. They're buying and buying and buying and buying and buying, but they can't make any headway with it, and they're having slow going, and they can't get back up into that. And then as it rolls over, I'm saying, sellers are coming in. Let's hit it. We got a short. Let's see, Gary. Yeah, the drills were on there on the second day, but I've expounded on that. Essentially, on the editing, I'm taking out some of the pauses where I've waited for you guys to answer questions, but I'm not cleaning much up in this. This presentation, your video is basically going to be this full thing. The exception to that, I had to redo Monday's session, and the first questions that I was addressing this morning, that tape did not save, and it's done the same thing. It's not recoverable. It saved an audio file. The end result, it ended up with a 1.4 gig audio file, which is absolute silence. And how it's 1.4 gig, I have no idea. So all you can do is just delete it. So I will redo the questions from this morning first thing. Go ahead and put this back together and then send it off to everybody. Yeah, Gary, you too. Have a good weekend, and we'll see you on Monday. Tom, when you say you got confused or twisted, so the offer is buying or green, Monday we'll come back in at the normal time. Let's do 12. A couple of the guys have kind of made their schedule around the 12 Eastern. So that they can be here, so we'll do 12 p.m. Eastern. The one exception to that, just a heads up for you guys, I'm going to kind of see where I'm at with this material that I wanted to cover, and then Monday we're going to go through some trade setups from you guys. We'll see where we're at. The real trading, the live trading, I probably will say at least Friday we will be in here at 9:30 Eastern and do some live trading on that. If we get some bits of time here and there, in between to do that, it's fine, but during the doldrums is not a good time to be in there trying to trade. So I'll just answer that in case you got to get out of here too. Tom, your comment, Tuba Tom, you say I got confused or twisted. I was going to clarify that because we got two Toms in here. You got confused or twisted when you say the offer is buying or green. When I talk about that, what I'm specifically referring to would be hitting the offer. Remember, and let's get our dome. Let me find a dome. Remember on our dome, here's our offer over here at 19.25, and these guys are offering to sell. And these guys, this is our bid. These guys are bidding. They're willing to pay. But nothing will happen unless a market order comes in. So if a market order comes in and it hits the offer, that meant it was a buy order, because these guys are trying to sell. So if somebody came over and hit them, the one who initiated the trade was a buyer. So he lifted the offer, is what they would say typically in the industry. He lifted the offer because he came over and directly smacked his order, market order, right into that price. The flip side of that, these guys are trying to buy, but nothing will happen unless a seller comes into them. So if a seller comes in, he's going to hit the bid. If you hit the bid, you're selling. So if a red print comes in, that means somebody came over here and hit this with a sell market order. And if somebody lifted the offer, the green print, they came over and hit this price with a market buy order. So if that helps your confusion, if not, let me know and I'll try to explain it a different way. Let's see, other comments up here. Oh, you know what, Brian? I appreciate that. Brian had put a comment up here and I absolutely missed it. And here's what Brian said. He says, I think some people get confused because on the dome you have the bid green and ask red. They don't realize that is just for yourself when placing a trade, that the red column is sell and the green column is buy. And absolutely correct, Brian. I appreciate your pointing that out. I don't tend to think about that stuff. Just for what Brian was saying here, I have this column colored green. It has nothing to do with the time and sales being green. And I have this column over here colored red, has nothing to do with the time and sales being colored red. That is simply for me because frequently I'm placing trades out of the corner of my eye. And if I'm placing those out of the corner of my eye, I want to be able, I'm either going to use a hot key to enter, or I want to just be able to come over and make sure my mouse is on green. That tells me I'm buying, or I put my mouse on red. That tells me I'm selling. This is the buy column. This is the sell column. If I colored that according to the dome, it would be the opposite of that. This would be red because that's where the market sellers come in. Did I say that? I didn't say that right. If I colored this according to the time and sales, this column would be red and this column would be green, because a market order to buy is going to hit this side and a market order to sell is going to hit that side. So don't get confused with what the dome is colored and what the time and sales is colored. You're a champion, Brian. Thank you. I've had a couple people say that they were confused because of that. I apologize to everyone. I thought when we colored it, I talked about it, that I colored this because that is the buy column. And if I want to place a market buy order, like right now, if I come up here, I can come clear up here to 22.25, and I'm going to just click a market buy order, and that executed me at 19. It just threw that order right into the offer. And so if I'm going to buy, I want to be able to know that I'm just coming in. I can click anywhere in here. I don't know how many of those will come through, but you'll see it on the tape when you watch the tape. I can click everywhere I want above that price and it will buy me at 19. You know, I just clicked at 5-6 different prices and every one of them was filled here at 19. Same thing on the sell side. If I want to come in here and sell, doesn't matter where I left click, it will sell it to 1875s. So that's why this is colored this way. And it's the opposite of what the time and sales is. On the time and sales, all I'm trying to do is track who initiated the trade. And on the dome, I'm trying to make sure I don't accidentally click in the sell column when I'm trying to click in the buy column. And I'm doing this out of the corner of my eye. So I just want to make sure my cursor's on green to buy or on red to sell. hopefully that clarifies that all for everybody. That's I've already gotten 4 or 5 comments that made it a lot clearer. So appreciate it, Brian. If you guys want, I'll color it the opposite way just for the rest of the presentation. But that's why the dome is just to keep me from making a mistake. The time and sales is to show me who initiated. So it's interesting how sometimes just a little simple thing like that can make everything click into place. Sean, your comment, simply put, more red means more filling at bid price, indicating selling pressure, which is correct. More green, this is on your time and sales. More green means more filling at ask, and that indicates buying pressure. Did I get that right? Yes. At that moment in time, if you're seeing the green, that is aggressive buyers who are going to the market. They are buying at the market. And if you see it red, that means the sellers are so aggressive that they're willing to go to the market. They're not going to put a limit order and hope they get filled. They're going to go to the market and get filled. So that's just letting us, you could refer to it any number of ways. Some people tend to refer to that as accumulation distribution. I don't like that definition because we have no idea whether it's accumulation or closing trades. Some people refer to that as buy pressure, sell pressure. Some people refer to that, just for what it is. We've got buyers coming in or we've got sellers coming in. However we refer to that, I tend to be simplistic. I say I see buyers on the tape. What I'm referring to is that the market buyers are getting aggressive. I say I see sellers on the tape. This market sellers are getting aggressive. I don't want to stop and waste brain power trying to figure out whether somebody's distributing a position that they've already had, or whether somebody's initiating a new short position. It's irrelevant. If they're aggressive and they're coming in at the market, that's what I want to know. I don't care why they're doing it. I don't care whether they're closing a position or starting a new one. If they're aggressive and they're going to keep hitting the bid and hammering the bid and hammering the bid, then I look at that as the valuable thing. There is an aggressive seller there who's not going to just offer it out and hope somebody hits him. So let's see. I don't see any other questions up here that I have not addressed. Looks like that's everything. Anybody else has a question, put me a quick yes out there. You guys may get an email over the weekend on for Saturday and Sunday. You may get a weekend message saying that the webinar or the workshop is getting ready to start. When you set the webinar up on here, it asks for your beginning date and your ending date, and it does not give you the option to say it's weekdays only. So because that doesn't give you the option to say it's weekdays only, it assumes we're going to have a session tomorrow and a session Sunday. But if you show up, have fun. I'm not going to be here with you. So go relax and enjoy a good weekend with your families and your friends. Karen, your question, did you send out the CCI indicator? I did. And what I did with that is the download message that you got yesterday from You Send It. That indicator is on there along with the instructions for installing that. So if anybody just deleted that message from yesterday that says yesterday's video was available for download, all you have to do is come back in there, either grab it out of your trash, or let me know that you don't have it and I can send it to you again. Actually, I'll put it on today's as well. I just figured rather than sending you guys 4 emails a day, if I could consolidate it. You'll see that when you go there to download the video from yesterday. It will also have a little notepad file showing how to install the CCI, and then the CCI indicator itself will be there. So, Andrew, let's see. Andrew, you mentioned that yesterday as well, didn't you? About sending out that price level alert indicator. I did not send that out. What happened? Karen sent me a fresh version to me, and I wanted to just make sure with Karen. And Karen, while we're talking about it, is that set up where they can install that either way, or will they have to go in and change the directory if they're going to install it on version 7? I don't know if that makes any sense, but you know how before if you did yours on 6.5 and I went to install it into mine on version 7, I had to go into the script and change the script. You had to go into the script. Does that, let's see, to do that, actually what I'm going to do before I send that out to the guys that wanted it, I'm going to just make a brief video showing them how to change the script then, and then I'll send that out. Because some people are comfortable with it and some aren't. And if you're using version 6.5 and it's coded for version 7, it's not going to work. And if you're using version, vice versa. So I will make just a very quick video showing you how to change that and put it into your file. And Andrew, it's the version 7, as you get ready to go into that, that's been the biggest obstacle with getting 7 to work, has been getting everybody's custom indicators to pull in. The trading functionality, the stability, everything's been there, but they've just had a horrible time getting people's indicators to sync up. The ones that people paid money for and so forth. So yeah, I'll show them, Karen. I'll just do that in the brief video. Actually, I think I already made a video about it and went through it at one point because I showed how I put the custom sound files in it. So I may already have that on screencast. Okay. I actually do. I think I already made the video for that when I went through it because I made custom files and then I had to change mine to a different drive because I've got a triple boot machine and I had to change it to my F drive, not my C drive. So one way or the other, I will send you guys over the weekend. I will send you a link to view a video to show you how to do it. And you won't download the video, you'll just watch that on my screencast account. And then I will put the download for the indicator there. And like I mentioned, just as Karen requested, please don't pass it around, post it on any forums or so forth. It's something she's graciously shared, and just honor her requests there. Alrighty, Karen, yes, to your question. That would be fine. So, well, guys, have a great weekend. I will get this up late tonight. I'm going to go ahead and redo that first 40-minute section, cover the basics and work the questions that were asked into it, and then I will get that edited and up, and then we'll have the first week's recordings all out to everybody. I will reattach that CCI indicator in this download as well. So if you were looking for that and you already deleted your other email, look at the email that you get from me today that says today's session is ready to download, and that CCI indicator will be there. Thanks, guys. Thanks for all the kind comments. Speaking of comments, for those of you, a few of you have had to step out. If you guys have any comments about the workshop and your viewpoint of it, I've already received some, but I would appreciate it if you send me an email. If you have any comments, if I make this offering available again, I would like to be able to have a few comments from people that attended and what they thought of it. So if you don't mind a little testimonial of some sort, and just be honest, I would like to know how you guys view it and whether you think it's beneficial, whether I need to change things, focus on different things. I would just appreciate some honest feedback and comments. So feel free to do that. Thanks, Ken. I appreciate that. You have a good weekend, everybody, and we'll talk to you guys Monday at 12 p.m. Eastern. Dang, Ken, I saw that UYP, and I'm trying to figure out what that was an abbreviation for. I thought it was up yours, Parker. And then you recorrected it, and it was yup. I'm like, what is he writing me bad messages for? We'll talk to you guys later. Good morning, everyone. Can I get a quick sound check here, and we'll make sure we've got sound. I've been having a little bit of problem this morning, so if you can put a yes out there if you have sound. Sounds okay to everybody? Not only do we have sound, but we can hear it, hopefully. Well, I apologize. I'm just a couple minutes late. I was sitting here talking away and realized I didn't have my headset plugged in, so I had to plug that in. But we'll get going with our second week here. Hopefully you guys had a good weekend and got rested up and ready to go again. I think for today's business, we're going to go through some things that were not necessarily planned in advance, because this part was up to you guys. So we're going to be looking at some of your questions and some of your setups and so forth on that. And we are going to go through some trade management discussions as well today and show you some examples and some things that I think in the past I've found beneficial for clients to consider when they're going through and trying to become a successful trader. Let me get a screen up here for you guys. We'll get this all functioning correctly there. And I'm trying to find one more window that I can't find here so I can tell where we're at. Okay, so we're going to take a look first of all, again as usual, at the disclaimer for the trades. Again, we're going to be talking, some of these trades we're going to talk about today were real trades, some of them were hypothetical things, and we're going to be talking kind of a mix of things of what other customers have done, and no one is advocating that because they trade a particular thing on the chart that you need to trade the same thing. Again, this is something where some of you guys are sharing trade setups or things that you're looking at, things that you've been experimenting with. And I want to thank you, first of all, for being willing to share that with the others. But we're also going to say, don't hold it against somebody if you decide to go do some of this stuff on your own chart and something doesn't work out for you. You're responsible for your own trades there. Just a brief overview for today. We're going to do some questions quickly, and we're going to look at some participant setups, and I'm going to do some of this together just for the sake of time. And then we're going to discuss at the end the trade management. So I know for some of you guys things changed considerably with daylight saving ending over here, and as that rolled off, it left some of you pretty late. I think, Pete, you're probably in the worst shape because it's midnight over there for you now. So we're gonna talk about your setup first of all and your thoughts here, and kind of address your issues first, and then that way if you need to crash, you can crash and catch the trade management later on the recording. So first of all, Pete, you had asked a question, and or you were kind of commenting on things, but you were looking at the CFDs, and the CFDs, because you are overseas, you're not a U.S. resident, you're able to take a look at those things that many of us over here aren't able to use. I'm not sure about you guys in Canada. I've got some in Central America that are in here, Portugal. So I don't know how things break out country by country. Some countries don't allow it, most do. And so you would have to look at that in your own particular country. But Pete, just a couple places that I'm going to give you the names of that you may want to take a look at too. When you were looking at the CFDs, you found that they were still ending up $10 a point. And there's a few places that are doing this at a lower value than that. One of them, it's going to be forex.com. And if you want to you can write that down. It's forex.com/UK. And that is Gain Capital. They're a fairly large forex firm, but their UK division allows the CFDs, and the US version does not. What that means on their accounts, if you open an account through the UK office, which should be no problem with you, since you're from Britain anyways, shouldn't matter. But what happens is you can come in there and you can trade crude, you can trade various energies, metals, and so forth. But just to give you an example of what they're doing on the crude contract, it is their CFD is a 100 barrel contract, so it's 1/10 the size of the CL contract over here. So you're looking at $1 per pip, and it trades in in 1 cent increments, just like the big contract, but it's only $1 per cent. And then they do have a bit of a spread. It's a 5 to 7 cent spread on it. But on crude, essentially, when you're looking at your commissions, you're looking at a $5 to $7 commission for a lot. But with crude, because so frequently you're finding moves that are running 40, 50, 60 cents on it, on the little swings, it's still something that might be worth looking at. They do have an SPX 500 contract that runs 10 cents per pip, and same thing, you can actually cut that down considerably lower. And just a couple others, I don't know if you looked at, and I don't know what their pricing is right now, but onecfd.com, it's onecfd.com, and then igmarkets.com. They in the past have offered smaller than a buck a tick. Some of them, it looks like IG Markets is doing a buck a tick now. But that gain at Forex, remember that's forex.com/UK. So that may be worth taking a look at. Now, Pete mentioned something as well here, and it's something for you guys to think about just based on your own situation. One of the things he was looking at was cutting the value down just a little bit so that he could take more of a position and scale in and out without taking 4 or 5 contracts and risking a tremendous amount of money. And he was also looking at the SPDR ETF, and that is something that I've had several people who were doing the same thing there. They took the SPDR as their actual execution instrument, but then they were tracking the chart and the dome and the time and sales on the S&P, and they just did the correlation, Pete, similar to what you did there, and they found that very successful. What I have seen with it, I traded with one gentleman who started doing this. He was risking $40 a trade for 200 shares of the SPDR, but the equivalent trade, if he was given it the equivalent risk with 2 contracts of the ES, he was looking essentially at a potential risk of $350, and by going to a couple hundred shares of the SPDR, he was able to get that risk down to $40 a trade, and he was still able to take it off in 2 positions. He was able to do a little bit of scaling. So for you guys that are looking at something like that, the one thing you have to keep in mind is that the account for the SPDRs has to be at $25,000 minimum. And Pete, you've already talked about that, so you're aware of that, and that you thinking that may work out for you as well. But for you guys, the pattern day trader rules come into play on the ETFs, and so you have to have that $25,000 minimum. And so if you don't, you can only take 4 trades a week that are in and out in the same day. It's not that you can't trade it with smaller size, but you're not going to be doing the intraday scalping day after day. In the course of the week, once you've taken your 4 trades where you were in and out on the same day, they freeze your account. You can't take any more entries. So just another instrument to keep in mind there for the size, to try to get something where a guy can come in and scale a little bit and so forth. So, Pete, the other thing that I wanted to mention, when you had asked about the trading setups, I don't know if you need to go through anything on your setup. If there's anything that you feel like you do, that's fine. But one of the things that you had observed on here was that consistently there was some money being left on the table. And so I'm going to go through a bit of that here in the next 20-30 minutes with the trade management. And so I don't really want to break that into 2 separate issues. But you also asked if we could look at that failure setup in the training videos. That I will put that back out there. But I think just because of time and what we're looking at today, it probably would fit better tomorrow. So as far as that part of your question goes, that failure setup, I will go through that tomorrow, and there's another setup I'm going to go through as kind of a training aid for guys that are trying to get this down, trying to get this price action trading and the scalping, and I think it's probably going to work best to go through both of those tomorrow. So if that's okay by you, I'll hold that part of your question, and then we'll go through those two setups because we do have a number of questions about scalping still. Okay, sounds good. So your trade setup, like I say, I think with the money management portion of that, we'll get to that in just a minute. And so I'm gonna stop there where you're concerned with your questions, and we'll address that in a few minutes, and then tomorrow. Second, let me see if he's in here, because I told him I was going to roast him for doing this, and he probably didn't show up because of that. Yeah, I don't see him in here. I got an email from one of the guys just for everybody's benefit, and he said he had a confession to make about the FOMC event last week, that he got enchanted with his demo account, and he was putting on 100 contract trades on his demo account. And he said he knew it was stupid, he knew it wasn't real, but when he was all done, he had enough money. He went out and bought a Sim Maserati, and he's planning on going out cruising and picking up Sim chicks apparently at some point in the future. So he did make a comment here, which I did want to relate. I thought it was funny what he said with it, but he did make a comment that I really appreciated, and that was the fact that he was putting some of this into play. And he was taking the, yeah, Petey's going to have a Sim midlife crisis if you don't watch it. He'd get a Sim divorce. But anyhow, he was putting this to work. He was taking this and he was applying what we've talked about here with the time and sales. And he put this into work on a couple of live trades and was able to make a couple $100 off of it. And he said, this was the calmest he's ever been. Now, he didn't change his setup, it doesn't sound like, from his email. He took his existing, what he was doing, he added the time and sales in there, was looking at that, took a couple trades, was very happy with it, felt like he understood it better. So I just wanted to mention that, and it doesn't look like Kevin is in today, so if you guys ever get a chance when he's back in here, we'll have to harass him about it or something. Let's see, I've got another question here. And this is from Alvin, and Alvin is not with us right now, but I'm going to address his question just so it's here in the record because he's taking the whole thing on a recording. He had two setups that he was using, and the setups that he was using, he wanted some comments on what he could do for the tape. So here's his first setup, and this is something that many people have tried in the past. He said when there is a big surge in price on a 1-minute candle after a news announcement, he tries to buy the retracement at a significant fib level. So he's specifically looking at the 38.2, the 50, the 618, and the 76.4. He says usually he will plot this fib retracement on a 1-minute chart, but sometimes drills down to a tick chart to speed things up. Anybody ever try that? News trading, trying to fade the move after the news? Got a yes, got a nope, no. The thing that you guys realize, for anybody that's watched a news release, one, yeah, Brian, you go into something like that, you get your head handed to you on a platter frequently. News release is a very dangerous time to be doing much of anything. And there are some who espouse a theory of doing that, of letting the news move the market. And let's get rid of this here, just so we can illustrate this a little bit for Alvin's sake. Essentially, what they're looking at is they're coming in saying on a given trade. When you come in on news and price moves one direction, when it retraces back against that at a fib level up here, which you've predetermined, that's where you're going to fade that fib and go back to the downside, for example. So essentially what they're looking at is they're taking this first move and saying that first move probably is going to set the direction They come over here and say the second move is going to be counter to that, and they want to play the third move. And a number of traders try to do that on both a 1-minute chart, on a tick chart, and they're trying to determine where that pressure ends. You can see it on the tape to a degree, but it is, again, you have to keep in mind it is very fast, it is very dangerous, and so you have to be decisive, and you have to be quick, and you have to be willing to get your rear end kicked. If a person is going to do that, Alvin, I would say what you need to do is like you're saying, let the first move go, and as you come back up, you're going to be paying a lot of attention on your time and sales to the flow of the tape, and you're not likely on the instruments that you're trading. By the way, he's looking at this on the 6E, 6B, and 6A, so that would be the euro currency future, the pound currency future, and the Aussie dollar currency future. Or he's doing this on the crude or the natural gas. So some pretty volatile, jumpy movements. The crude, I personally will fade. I don't mess around as much with the others. But anyhow, what you're going to have to realize at the point in time that you're trying to do this, that tape is going to be moving so quickly, it's not likely you're going to be able to see the numbers. It's just going to be a blur. And so you're going to have to take a look at the drills that we talked about, and one of the drills in particular, which would be seeing kind of a delta of the bid-ask, because you're going to have to do that based on the color of the prints. You're not going to be able to read the numbers. It's moving too quickly. So you're going to look at this and you're going to try to determine where that changes from like a negative bid-ask delta to positive, and you start your retracement. And as that runs back up, you're going to be looking for that to go back negative again. Another way of looking at that we talked about in the second day, I believe, which was who's in control. And you're going to see it go solid reds, and then it's going to go, solid greens as it comes back, and then it's going to go back to reds, and it's going to be watching for that rotation. Again, it's something very dangerous to do, but you're not going to be able to sit there and count off numbers in your head and go, okay, 68s, 69s, 70s. It's moving too fast. So don't even try to look at the numbers. If you do this, you're going to have to go off the color. Now, the one thing I will say about this for Alvin's sake, I do consider it a very dangerous strategy, not something that new traders should try to do, but at least he's going about it a little safer. That you take the, like Brian made a comment here, that he threw it out there, hits his target and stopped him out on both sides, kept running against him with a phantom contract showing on his dome, apparently. Took him a minute to figure out if he was long or short with one contract. He's moving so fast. And that frequently happens when someone tries to bracket things. You get out there and put a bracket out. Very common to get stopped both directions. So, if you at least let the first move get out of the way, get their steam off, pick a direction, it usually will suck back very quickly. If you guys try to go in and do this on Forex, you will get destroyed. So don't do it on the spot market. You have to wait, because for the first 20-30 seconds after a news release, they will not fill you until they feel that the price has moved to an extreme. The Forex brokers had to do this to protect themselves. So they would let price get completely out to an extreme, and then they would fill you, and then it would suck back against you and stop you out just within seconds. So very dangerous to do. Now the other setup, I'm going to just put a chart in here and show you kind of what he's looking at here. If I can find the chart. That's not it. That's not it. There it is. And this is his setup and what Alvin is saying about this. He's taking a 1-hour chart, again, on the euro currency, pound currency, and Aussie currency futures, or the crude. And he's using two 34 exponential moving averages. And you can see the settings in the upper left corner here. One of the 34s is based on the high. One of them is based on the low. Whoop, and I've got them messed up here. Let me change the one. This should be 34. tried to just add a couple moving averages real quick on here. What he's doing with this is he's creating a little channel, and then he's watching this when it goes through the channel from one side to the other. When it closes below the channel, then he's putting a short on. And if it comes from beneath the channel and trades through the channel to the upside, when he gets the close, then he's going to the upside, taking his long position. Now he's doing this on a 60-minute chart. So you guys may already be thinking, because he hasn't had the benefit of being here day by day, but you guys are probably already thinking the same thing I was thinking, is if you're trading a 1-minute chart, the reading of the tape is probably a little bit overkill. But I guess I'll address a couple things as well, because there's some management questions here. He's putting a fixed take profit of 30 ticks, and then the stop loss will be just outside of the most recent swing point. So let's take a look at this just so everybody understands his setup here, like in a case like this. And this is going to be one of our lessons on trade management, by the way, too. We're going to come in here on this chart. Let me get a color that will show up a little better. This, for example, would be his entry point. And that entry point would be because he came up above that moving average and closed above it on a 1-hour time frame. At that point, this is going to be his stop down here, and then he's putting a target up here of a plus 30. So if you look at the scale here, there's 50 ticks between each hash mark. So he's coming in here putting a target. So what would you see is that if we looked at this from a management standpoint, what do we see there that's probably going to be a problem? Anybody have a comment on that? Here's your stop down here. Here's your entry price right here. And here's your target. Exactly. Risk-reward ratio. Win-to-loss ratio. Win-to-loss ratio, the thing with the win-to-loss ratio that we got to realize, he could be right 95.9% of the time, and he could probably do okay with it, but he would have to have a really good win-to-loss ratio. But the risk-reward is what's key here. And so I'm gonna show you guys something that I did, and Alvin, I do this for your benefit here. I'm going to take a Fibonacci retracement on this chart, and I'm going to just draw this out, and this would just be my default Fibonacci, which would be showing your 3 primary levels in the middle. And I'm going to change this for the sake of managing money, just to give you a quick visual indication of whether this is something you really want to be doing or not. And here's what I'm going to do. I'm going to turn off the 382, the 50, and the 618, and I'm going to come in here and turn on these 3 down below. And I'm going to put here a 200%, and I'm going to put here a minus 100%, and we're going to come put in here a 300%, and we're going to come up here and we're going to put a minus 100%. Whoop, minus 200%. And the only reason I'm doing this is that gives me something symmetrical, that it doesn't matter whether I draw it correctly. If I need to draw it fast, it's not going to matter which direction I draw it, because it will print the same way on each side. And I'm going to check this and just make sure that I got it drawn correctly before I go any further. And you'll kind of see what happens when we do this. If we use the retracement to measure our move, you guys see where I'm going with this? If this is the stop that we have to use right here, the 2 black lines, then this would be a 1-to-1 risk-reward ratio. 200% would be a 1-to-1 risk-reward. 300% would give us a 2-to-1 risk-reward. Does that make any sense? And then, because I did the same thing with a negative 100 and a negative 200, we could turn that upside down even if we drew it wrong, and it still gives us the same ratios up above us. So, Alvin, here's what I would say. If you take this in and you draw this from your entry to where your stop is, this tells you that you have to be able to get up here to 39.37 just to get a 1-to-1 risk reward ratio. And that should be easy to do because you see where your stop is, and you may say, hey, I've got to give it I've got to give it 15 ticks underneath that, or whatever your stop is. This shows you where you have to be able to get to in order to get 1-to-1. Now let's take a look at this chart setup, and we'll compress this down a little bit. We've got a sideways range on the hourly. We've made a slightly a slightly higher low over here and started back up into the range. So if he's coming in at this point in time and he's taking that entry right in here, he has to be able to come in, and actually let's just get rid of this. He has to be able to come in at this point and say, is there any realistic chance of getting up here? So Alvin, when you think about that, at a 30 tick, if you were taking a 30 tick target, you're going to be getting out of that trade about right here. And yet look where it needs to be just to get you a reasonable risk reward. So if you start drawing that on your charts, because obviously you realize, one, you're leaving some money on the table, and two, you probably realize that it's upside down. You have to start saying, is this comfortable? Because your swing here on an hourly chart, you're going from 38.31 at your entry, you're over 100 ticks away to have a safe stop. Even if you go right to the prior low, you're still looking over 100 ticks just to have a reasonable stop on your trade setup. So if you have to leave that much of a stop, you cannot be going for a 30 tick target. It just, in the long run, it will never work out to get that upside down. And if you go back through the charts, you'll see that times like this where you went long and you had to give this monster stop here, and you only got a few ticks positive and rolled over. So I would say one thing to do in a situation like this for any of you guys that are looking at management is throw this out there and just see, can you get a 1-to-1? Can you get a 2-to-1 in the existing chart pattern? If you're in an uptrend and we had a pullback and it's finally rolled and it's come back through this, you should be fairly confident of getting up into these ranges. If you're in a sideways range and it's been a sideways range for 2 weeks, you got to be more cautious because it may be getting ready to break. But if you've been in that range for let's say you've been in that range for 3 days, 4 days, you could look at that and say there's a reasonable expectation of this. But that puts you 200 ticks away, 225 ticks away to get to your 2-to-1. So if you can't see the room for that target, what does that tell you about the trade? Probably better not to take it. Now, as far as using the tape there, you've asked 2 questions. Can the tape help you identify a higher probability entry? And can it help you identify when price will run further for the profitable trades? And I have to say, for that particular setup, Alvin, no, it won't. It's a exercise in futility. And the reason for that is you're looking at a time frame where on an hourly chart, a 30-40 ticks is just a little wiggle, a little small candle. So to try to go to the tape where we're trying to fine tune an entry by 3 or 4 ticks really doesn't matter. If you're giving it 100, 125 tick stop and a 200 tick target, there's no reason to try to fine tune the entry by 10, 15 ticks. And by the same token, if you look at how long this chops around before it finally gets up and runs through that upper price, let's just put our ruler on there from the entry to the time it finally broke it. That is 5 days and 12 hours. So really wouldn't make a whole lot of sense on a setup like that to try to come in and tweak it and watch the tape hoping it's going to help you get in there and stay in there longer time. So hopefully that, Alvin, when you watch this, if you have any questions, go ahead and ask me about it. If you were trying to fine tune that to get 30 ticks, maybe you could watch inside of that, but you're going to end up having to watch it once it closes, and you're going to have to see it coming up into that level when you think it's going to close there, and you would have to determine who's in control. Are they staying in control, and so forth? And then at that point, you may try to fine tune that and scalp for 30 ticks. But if you're going to scalp for 30 ticks, you would have to be very, very cautious about putting a stop down at the prior swings on a 1-hour chart. I'm going to stop here for just a moment. I'm going to reset the tape, and then we'll get into the next question. Okay, so got everything working there on the first shot this morning, which is a big relief. I love it when it just immediately says it's saving and you don't have that panic attack. That little Fibonacci, by the way, I have had many people say that completely changed their money management. And the reason was that they started realizing that they didn't have a remote chance or a remote expectation of getting to where they needed to get. And they started drawing that even on little shorter term trades and just leave one on the screen and drag it around. And it's kind of eye-opening when it comes to picking targets to think, man, I've got to get clear up here, just to get a 1-to-1 risk-reward ratio. Alvin, with this trade, the one thing I would say too, you're trading some instruments that definitely have the potential for these kind of moves. And so for any of you guys that are looking at this, it's another advantage of the little Forex account where you can take some side money even. You can trade that when you're not feeling 100% and you can still be trading real money, but you can do it on a small scale where it won't hurt you. But it also gives you the potential to take some moves like this and look at it a few times a day, put a price alert on it, do a little swing trading with it. Swing trading, when you're looking at those 2, 3, 4, 5 day holds, I have always considered that a wealth building style of trading, more so than an income producing trading. But if you have some extra money sitting there, even taking this at 50 cents a point, you come in there on a currency, in the spot market, it's $100, just a little trade that sits there and you don't even have to do anything. Put a stop, put a target, let the thing run. And, it can be a nice little chunk of change, even though you're trading it at a very small tick value. Let's see, the next one I wanted to address, Gerardo, I got your comments and charts there, and I really didn't see a specific question with it. So if there was a very specific question with it, let me know. You pointed to a couple of the indicators that you were using to try to help you see things, but I didn't see a real specific question there with that. So feel free, if there was, let me know and we'll address that later. We're going to address a couple things for Edith here. And Edith had a couple of questions that may have occurred. Okay, Gerardo, so yours was just how to let them run. We'll talk about that today a little bit more, so in the management. I wasn't sure if you had something specific that you wanted to go through as far as the entry was concerned or what you were looking at. But here's a question from Edith, and she's another one of our traders that's not able to be here, but we're putting her question into the record, into the recording, and I do think it's a good question for you guys to think about. Edith said, referring to your comment in the number 3 video where you said that you never used the tape for exiting the trade. This is basically what she's talking about, and that is a true statement. I cannot honestly think of a single trade where I ever used the tape to get out of the trade. So she says, my first question is, if we entered the trade, can we still use the tape from here on for confirmation? Or would we be better off relying on price action rules, charts, etc.? And then related to that, her second question, can the tape assist us in any way to stay longer in the trade? And if so, how? So here's how I would address those questions. First of all, the only person that I think could benefit from reading tape after they're in the trade would be a scalper who was scalping with momentum. Or in other words, let's say that this is a guy that's doing breakdown, breakout, coming out of a consolidation, and maybe taking an entry when it breaks a prior swing high and he's going long, hoping for some momentum. if he gets in on the break of that with a stop entry order, and let's just again, we'll just try to demonstrate this here. If a guy came in and he started looking at a point like this right here and saying, okay, here we've got a high, we've got a shallow pullback, we come back up again, we test that high again, I want to get into this trade if we break that high. And he comes in and puts a buy stop right above that high. He gets hit. Would he benefit by looking at the tape? And I would say that's about the only type of trader that would really benefit from it. He may come in up here just a few ticks away, and he may see a ton of big sellers coming onto it, very aggressive. He sees them grab control of the tape. He may decide just to pull his stop up to entry or kill the trade. And you could say, okay, if he was scalping it with that in mind, maybe that would be beneficial to try to read the tape at that point. But for anybody else that's trying to do this, here's the problem. If you come in and you start watching the tape, you're going to see a big burst of sellers at some point after you get in the trade, and you're going to think it's all over and you're going to get out. And you're going to look at it 20 minutes later and it's moved another 40, 50 ticks from where you got in. It will happen over and over and over. And you see the noise on the tape after you're in and after you've got a target and after you had your risk-reward ratio chosen. And then you come back in and you start trying to fiddle with it as it fluctuates back and forth, buyers to sellers, buyers to sellers, buyers to sellers. And you're going to find yourself leaving money on the table almost every single trade you do. Something will cause you to chicken out. You think you see something. And I've always said for myself, I can get the biggest targets if I just put these ridiculous targets out there and walk away. Put a close at time on Ninja, which just shuts the trade down right before the market close in the afternoon, and just walk away. I've got my stop, I've got my target. Come back and check on it every 20, 30 minutes, see if I need to adjust anything. If I was to turn around and sit there and start tweaking every little move and every little fluctuation on the tape, I would be out of those trades and I wouldn't be able to make any money. So unless you're scalping momentum, I would say don't think at all that tape will benefit you on the exits. It's very unlikely. You would come up, assuming this was a tick chart, not a 60-minute. We come up into an area like this and you say, well, this is resistance. You see some sellers hit the tape, you bail out of the trade. Pulls back, shallow pullback, fires right off to a new high. Pulls back, fires off to a new high. Get a deeper pullback, fires off to a new high. If you've set a target and you've got a stop down here and you're in the position and you've got a target clear up here, the only way you're going to get clear up here is to just leave it alone and let it work. So I would always tell people, don't go to the tape. Once you're in, you're in. If you need to do some type of management strategy, don't use the tape. And I'm going to go through a few things that I have found success with. A pivotal one to me is, in my mind, that Fibonacci saying, here's my stop. That means my target has to be all the way up here. And I'm looking at it saying, if I can take something off up here to 1-to-1, I'm going to take something off into this high, and I'll take something off into this high, and just let that work. To me, it's seeing it in advance and saying, this is where I want to go with it. If it breaks that way, this is where I'll be taking profits. So hopefully that will cover things good there for you, Edith. You asked as well, you said you've been watching the Russell lately, the last couple months. Do I have any comments on that market? The Russell, I really traded the Russell a lot before it went to ICE. And when it went over to ICE, the character of it changed, and I quit trading it. And then over time, the volume came back in, and the volatility came back in, and it improved definitely over what it had been. I don't trade it a whole lot. It moves quick. I would say, just for general comments on the Russell where you're asking, if you're going to trade the Russell, you need to be either a very skilled scalper or you need to let it have a considerably larger stop than you would use on the S&P or the Dow. You may take a trade on the S&P and be able to get by with a $75 per lot stop, but you come do that on the Russell and it's, 7-8 ticks is just a recipe to get whacked over and over and over. There's a lot of wiggle in that. It'd be like trying to trade crude with 7 or 8 tick stop. It's not that you can't do it, but it just decreases the likelihood that you're going to be successful with it. When I do trade the Russell, I usually give it 15 ticks at a minimum. I'm trying to pick up 30, 40 ticks out of it, on the move. And it's $150 a lot, so it's not for everybody. It can be even more costly to trade. Same goes for crude. I would not use less than a 20 tick stop on crude, but I also won't take less than a 20 tick profit on crude. So, yeah, Ken, that's your ex-wife is the Russell, right? Bleed you dry and take everything you got and come back wanting more. So, let's see. That is Edith's question. I think we've covered everything there for her. We've got Alvin covered. Jose, let's see, are you in here? Yeah, you're here. Jose has asked about scalping techniques, and I'm going to show a couple things with that tomorrow with the RSI fade, but I'm also going to show you just a couple things on that here, and let me just find the pictures. First of all, actually, I'm going to just put a chart back up here. I'm going to get rid of these moving averages. And I'm going to just change this to a 5-minute chart instead of the 60. Some instruments, and when we start talking about scalping, there's a couple ways that a guy can try to come in and scalp effectively. One of those would involve trading the pullbacks, the retracements, and the other one would involve, to me, what's a little more dangerous, which is just running with momentum. And there's a number of little strategies that a guy could look at. I'm going to go through just a couple of things that a guy could look at here on a scalp basis. A lot of times guys get in a situation like this here where they see this is a 5-minute chart. They see a big extended move and you don't really ever have a retracement in it. And it becomes very difficult to tell where you should get in, if you should get in, and you keep feeling like, man, I should just get in and scalp this, and it just keeps going and going, and the more it goes, you keep thinking, man, there's got to be a retracement. There's got to be a retracement here somewhere, and that retracement is going to really hurt me if I get in now. And you just wait, and next thing you know, it's moved 100 ticks, and you never got a single tick out of it. When you see that happening, it's one of the few times that I would ever, if I was trading that way, and I've done it many, many, many times in the past when I scalped more aggressively, is I would take situations like that and I would go to a tick chart, get a short-term tick chart. So instead of watching this on the 5-minute, and we're going to remember this run here, that this had this big sell-off from 40.70, basically sold off 100 ticks here. And we're just going to go to like a short-term tick chart. We'll just go to like 100 ticks. And let me just reload that so we've got the same thing expressed in ticks. So we'll come back over here, this sell-off from 40.70 that ran all the way down here. You can kind of see what I'm talking about, that even on a tick chart, there was not a whole lot of retracement. There was a couple times before it broke, and right as it broke the low, that you got a little bit of a retracement, and then it was just off to the races. One of the things that I've done, and I've demonstrated this to guys before in the room, is that if you see some serious momentum and you just broke the low, about the only thing that I ever found successful for getting in those kind of breakaway moves was to come in and look for a situation where it pulled back up just a few ticks. And if you look at this little move right here, for example, you hit this low and you pulled back just a few ticks. This only went up 5 ticks in that whole sideways consolidation before the selling came right back in. When I've looked at this as a scalping method, again, it is something that I used to do a lot of, and I never felt comfortable with it, but I always did it and it always worked out. is you identify that that momentum is there, going like crazy. You have to know, one, you're trading an instrument that will run. You have to know that you're trading an instrument that isn't a faders market. In other words, by a faders market, I would say like the S&P, the Dow, the Nasdaq. Those are more often a faders market than they are a break and run type of market. Frequently, when you come outside of a high, like you hit a new high of day up in here, if this was the S&P, you get that new high of day, and that's right where the sellers hit it and knock it back. So you get up a new high, 3, 4, 5 ticks, gets knocked back. Get 3, 4, 5 ticks, gets knocked back. If you're trading that type of a market, you don't want to use this kind of a strategy unless it's a serious, like a news-related, change the whole opinion of the market type of deal. But I would take, as price moved down, and it became clear to me that this was becoming a runaway or a breakaway type move, I would just come in and put a buy stop right below that. And if it did bounce, I never got the trade. If it got a retracement, I could take the entry, back up. Whoop, wrong tool. I could take an entry back up here. But if we never got the retracement, my order was sitting here waiting to get swept in. So I could have that order, right below the green candle. As soon as I saw it pull back, you could do it even intra-candle. You take a little candle like this. These candles are forming about 2 minutes apiece whenever this went off. So if you saw it tuck back up in a candle, you could still come in and put your buy stop order or your sell stop order right below or right above the market, depending on which way it's running, and just let it sweep you right back into the trade. But again, that Jose, for that type of scalping technique, you need to make sure that you're in a market that tends to run when it breaks. So you take something like crude, it can be a very effective entry strategy on crude, because crude, Karen could attest to that, Brian could attest to that, Ken and Pete have seen me trading it. Crude is one that can flat out put them down. When that breaks and starts to run, it will run and run and run and run and run. And so when you see that run start, as long as you're not coming right into support or resistance, I personally feel the most successful thing is just to put a buy stop or a sell stop there, and you get a little 4 or 5 tick pullback. Put your buy stop, sell stop. If it retraces high enough that you want to take a shot at the scalp, do that, and then just let it sweep you in. But here's where, Jose, you're going to have to pay attention to this. If you know your market, let's say that you're taking crude as an example. You know that crude can go run 40, 50 cents like it's nothing. Little swings on a tick chart in crude will run 30 to 50 cents. If you are coming into this as a scalper using this type of method, and you're just trying to get 4 or 5 ticks, man, you're leaving a lot on the table, and you're taking all the risk of trading that type of an instrument, but you're not getting the reward of trading that type of an instrument. So while I would say that's a scalping technique, you will find yourself leaving so much money on the table. If you're able to do a couple lots of that, it becomes a lot easier, because then you can have one that you take off at like your 1-to-1 risk reward, and then you can have another one that you could come down and say, boy, we'll let this run down another 30 cent, 40 cent on crude, and we'll take that one off down there. And I have found over the years, I start scaling out at 1-to-1 every trade. And it's interesting because when I go back in and look at the risk reward, I usually am very close to a 2-to-1, all said and done. And that's despite the fact that a lot of my runners get stopped out at break even, get stopped out, trail stopped out far before their real potential would have done. But I frequently have trades where I put a trade on, I start scaling out at 1-to-1, and yet I may end up at a 7 or 8-to-1 on the trade overall because of just sitting on it and letting it run. So when you come into something like crude or the euro, where it can really extend itself, and like you take, maybe you guys remember FOMC, you look at the move the euro made, 200 ticks, no pullbacks. How do you get into something like that? Well, this is about the only way you can. but you've got so much potential there that you don't want to cut yourself short by viewing it as a scalp only type technique. Now, a couple other things that I like for scalping, and I'm going to get rid of this and I'm going to switch this over to the YM. And the YM has always been one of my favorite markets for this trade, and I like it. I think in many ways, one of the reasons I like it so much is just because I can come into the YM and I can get in and out, and I'm not sitting there with a limit order that never gets filled. I can put a limit order out there and I can get hit on it. But I look at the YM, and one of the things that I like to see on the YM are retracements when we have a change of trend. And by a change of trend, the way that I would define that would be that, you know, for example, we broke down here, and when we rallied back up, you know, we still never got free and clear. You might have gotten into a trade here. I would say probably not if you were watching the tape. But we were breaking down, and finally you gave some evidence of strength, and I would say that evidence of strength came when it was able to finally rally all the way back up here. And it's at that point that I like to come in and draw a Fibonacci in my mind, and I start watching that when it gets between the 50 and the 618. And I have to look at this, and my way of addressing the, I guess, the risk-reward ratios is at the point in time when I come in down here and I see this, you know, kind of in my zone. Let me get this. I see this down in here in my zone, is I'm measuring the distance from that entry back up here to the high and saying, how much room is that? If it's 10 ticks, then I'm looking at the distance between my entry and where I would be proven wrong, which would be a new low. Can I pull that off safely? If I'm down into the 618, yes, I can pull that off. So one of my favorite methods is looking at that zone, that 50 to 618% retracement, and doing that as soon as we see a trend change. Now, if a guy's doing this with one lot, and you can get 10 ticks with an 8 tick stop, you take your money, let the thing move, take your next retracement. You don't necessarily want to assume that it's a new high unless that trend continues, but you take your next retracement, look for the same thing as it starts to retrace against you. So I'm going to just put up a chart to kind of demonstrate this, because these patterns, I've been trading this, and I was talking with someone about this going back, this goes back into 2008. Oh, I got to turn the screen door off. I was going to say what's happening. This was something that I was showing him back in 2008. It had just been a day that I was looking at, and very typical day is taking these fib retracements, and I just drew the little green box in between the fib retracement to show that would kind of be the buy zone where I was watching for it. So you get a move like this, you have no retracement, you just sit on your hands, you're watching it. But frequently on the YM, when that finally changes, you finally go over a prior pivot, you will see move after move after move that runs up, pulls back into your buy zone. Scalp it back up, get out of it, let it pull back into your buy zone. Scalp it back up, let it pull back. And see, that's something that I don't know. I'm not superstitious about fib numbers. I think enough people look at them that it's effective. But it does frequently lend itself to some good setups. There will be some days where it's just a one-sided move, one direction. You never get down to the 618. And if you see that, like these kind of big, long breakaway moves between 0.4 and 0.5, that's where the only thing you can do is get your little shallow retracement, put your sell stop underneath it, and just get swept in. But if you start seeing that stair-stepping pattern, especially after it's just changed from downtrend and it finally broke above a prior swing high, you start looking at that pullback. You will frequently get a series of trades there that can be beautiful scalping opportunities. I have traded this two different ways. I've traded it just putting the limit order at the 618, and it either hits me or it doesn't. And I've traded this reading the tape as it comes in and waiting to see the buyers rotate back in. If you do that, if you're able to read the tape, here's the advantage it gives you. If you just arbitrarily threw an order out here, for example, in this move from 7 to 7A, if you just put the order in, it goes through you a little bit, you feel a few ticks of heat, and then you see the sellers disappear and the buyers come back in and start pushing. Reading the tape, a lot of times you can eliminate a little bit of the heat that you feel when it just runs on through. But I tend to look at this kind of trade here and say, I would still take that on the basis of tape as long as it didn't break this low and get out of control. If I saw buyers come back in down here, I'll still take the entry down here. It gives me a little more room to my target and a little less room to my stop before I'm proven wrong. But that, Jose, that's one of the things that I did for many, many years. When you see those stair-step type patterns, it's a beautiful scalping market to take those pullbacks, run it right back up, get the next pullback, run it right back up. And after I've done that 4 or 5 times, where we've made, we've come in and we start making a series of new highs. And if you look at these highs and say, okay, there's 1, 2, 3, 4. Once we've made 4 new highs, 5 new highs, 6 new highs, you got to be careful. You start taking those pullbacks, and eventually you're going to get a lower high, and it's going to roll over and stop you out. So if you can identify that fairly quickly when you come in, whether you looked at this little move as a pivot or whether you looked at this here as a pivot, once you break that, you start watching that first pullback. Start watching your tape right down in this area. Andrew, I tend to look at, you ask how many ticks am I using? I tend to look at the distance from the 618 to the prior high. And I say if that prior high stopped it. Oh, tick period, this was probably an 89 tick. 2 years ago, yeah, I would guarantee it was an 89 tick 2 years ago. Sorry, I thought you were talking how many ticks for targets and stops, and what I was starting to say with that is I look at the distance from the fib to the high, and I say, that is where I'm going to run into resistance because that's where they just hit it a minute ago. So if I look at that and that's 42 ticks away and we're running these big, huge swings, then that's my target, and my stop is probably going to be 20, 25 to stay in it. If it's 10 ticks away, my stop is probably going to be 7 or 8 ticks, 9 ticks, and a 10 tick target, and then I'll have another lot if it breaks through that. But that has been for many, many years one of my favorite methods of scalping. And again, it's not there every day, but as fast as you can identify those pullbacks, then take the next 2, 3, 4 trades, and then step away from it. When it starts to rotate back over, take a couple trades to the downside. You kind of, sometimes you'll do that where you chop around a little bit, you make your big move, and then you work your way back up, and then you work your way back down, and it kind of chops back and forth. So you're taking 2, 3 moves here, 2, 3 moves here, and if it breaks the range and goes, you'll look at a different method of getting in. But Jose, for the question you asked as far as scalping techniques, that has always been one of my favorite. And what you have to make sure of, if you get into something like the S&P, the difficult thing is that you could put limit orders out there and it prints 1,000 lots at your price and you don't get filled. That's the tough thing about the S&P. The levels are so thick you frequently won't get your fill. Let's see, Karen, you say you've been smacked a few times when ultimately it was a breakaway move and you were trying to trade reversals. It ends up not hitting your first target and you immediately get stopped. You try again and the same thing happens. And then you ask, is the pace of the tape a good indication of the breakaway type longer move? I would say, Karen, one of the things I try to file away, if I do that, I'll try it a couple times. And at that point, if I see them still grabbing the tape from the buyers, let's say, and knocking it back down again, it just says to me that, the buyers are trying, but they're getting no results. It comes back to results. And if they can't get results, I would frequently step away, because where I would see that would be coming down in here, picking a reversal, and we're down in the lower third of the day's range. I'm not the guy that's going to be coming in shorting the lower third of the day's range. It's just, for me, it's not as comfortable. So the uh, the trade goes against me a couple times. I'll just let it go. I don't want to dig a hole that I can't get out of with one trade tomorrow. And I'm not the kind of guy that's going to come in and short that. So I just, at that point, sit on my hands. But that's what I look at, is results. And they might get it if I got stubborn. They may sit there and 3, 4, 5 trades. I may finally get it right. But at that point, I've got myself a hole deep enough that I can't really get out of that easy. So I try to be pretty cautious about that. If I get a couple stops trying the same thing, I'm not going to try it a third and fourth and fifth time. I'll just forget it, reset, come back tomorrow. But I would say, the pace of the tape, if you get the pace of the tape, that's always going to give you right here, right now. You see the sellers rushing in there. The sellers are aggressively trying to sell the low, and you were looking to buy the reversal, and you see them just rushing in. Yeah, absolutely. I would say at that point, it's probably more to flag you out of losing trades than it is to get you in the reversal. You come in and you see that the sellers just will not let go of it. It's accelerating with sellers, bigger sellers coming in at the lows. Those are the situations that you really have to say, step back and don't even try the trade. Some instruments it's easier to see on others. You'll see the S&P. I think a lot easier than crude. You'll see the YM and the NQ a lot easier than crude from that standpoint. Crude, the bad thing about crude and tape, Karen, you look at the crude and the way that moves. Crude frequently moves because people pulled the offers, and I would say that crude on a blowout type move will frequently move as much because people pulled their offers as it did because there were lots of buyers. I mean, I've couldn't even begin to count how many times I've seen that on crude, where if you're watching your dome, you'll see the offer melt 4, 5, 6, 7 levels away. If you're using your level 2, you'll see it melt 7, 8, 9 levels away, and there's no market buy orders even printing, and the offers just melt and disappear, and price explodes up, and immediately the bid is filled in where the offer just disappeared, and you see it pop up 8, 10 ticks on 5 lots, where just a moment earlier you had 85 or 90 lots sitting there at your 5 levels on the book that you could see, and you look at that and go, how did it move that far on 5 lots? It's because everybody pulled their offers, and so that happens a lot there. So you got to be really cautious with that with crude, because I personally think crude moves more that way than any other market I've ever seen. The only instrument that is close to that would be your mini gold, and that thing will move all over creation without ever printing. I've had stops out there. I've had customers ask about mini gold, and I've had stops sitting there where price went through my stop 20 and 30 ticks, and there was never a print, not one print that went off to trigger my stop. And then it came back through my stop again and went 20, 30 ticks positive. And it's just basically people pulling their orders out of the way. And so when you start watching crude, you're gonna see that. You mentioned you haven't noticed that or thought about it in that sense or registering in that way. But you will see that crude frequently, the big explosions in crude is not a huge blast of orders necessarily, as much as it is people just yanking all the orders out of the way and the bid stepping up into it. So, Tom, appreciate the comment. I'm going to reset the recorder here. I'll be back in 2 minutes. Any questions, throw them out there. Okay, so let's see. The other scalping techniques, I've talked some about that. Jose, the tape reading, looking for the little brackets and stuff of that sort, I've already addressed that in here. For trying to do it off of a chart, looking at a chart as an aid so that you don't have to remember all the numbers in your head. It's essentially the same exact thing that I would do on the YM if I was doing it without tape. I'm looking for a little bracket, looking for a little expansion one direction. I come back in, I see the numbers dropping. I'm going 8900, 8895, 8890s, 8885s. I know that my last lows was 75s. In my mind, I'm saying if I break 75s, this thing's reversing back to the downside. So, I can look at a situation like that and say, to me, in my mind, if I'm doing that in my mind, I'm creating this same exact pattern. Here, looking at it on a chart is a little easier to see. So we'll talk about that. Just comment on that on some live tape here at some point the next couple days. Andrew, your question: when are we planning to do a real-time demo? I've got a couple ideas I want to bounce off of you guys as far as that goes, and I'm going to mention that kind of some limitations that I'm running into. So I will address that. I think I probably will just address that when we're done today so we can keep going with the flow of what we're talking about. So I would just say short answer, likely Friday, but I want to give you guys a couple options. One of the problems that I have is just because there were a number of people who were planning this on a 12 p.m. Eastern start time, and that was what they based their whole schedules on. And so trying to come back in and start first thing in the morning, it would eliminate about a third of the group. I guess the changes that we'll look at, we'll just talk about later. Let's just leave it that way for now. Let's see. So I've got these questions all out of the way. Sorry, guys. I'm just trying to double check everybody here, make sure that I'm getting everybody's questions and trade setups that they were asking for comments on. I think I've got 2 left here. Karen, do you feel up to commenting on yours, or do you want me to go through? I've got one more I can go through, and then I'll let you kind of explain what you're doing because yours is a little more in depth. If you're set, I can try to get it loaded right now, but it might be easier just to let me get this other question first, and then we'll when I reset the tape, I'll go ahead and do that. Maybe that's what we'll just do. That'll probably be easier. I've got, let me get rid of this here, and let me find the charts. Oh, no, actually, this wasn't something that I had the charts for. And I will pronounce your name wrong, Abhijit. I probably slaughtered your name, so I apologize for that up front. Your situation, and I think your situation is probably, oh, I got it all right. I know I messed it up. I have friends from Lebanon that are out here, and she's like, no, you said it perfect. He's like, no, I didn't. It don't sound anything like the way you said it. So she's like, well, that's as good as a white man can say it. So I always kind of laugh about it. But anyways, a couple things here that you've done, and I think many in the group are kind of in the same point or the same place. And actually, let me just, I'm going to put something up here on the screen so that it's not just a black screen of death. You commented on things, and I think you're on the right track with this. You had a pretty complicated chart initially. You had a lot of things on it. And, you mentioned that you're trying to simplify the chart down, get rid of some of these indicators, get things cleaned up a little bit. And I have to say, it's definitely not the worst I've ever seen. When it comes time, for worst charts I've ever seen, I had a trader up in Canada once, and I tried and tried and tried and tried, and I could not. There was a couple of his charts I literally could not even find. I couldn't even find price on. I'm sitting there looking at it, and I honestly cannot find price candles, and I'm going, what in the world are you looking at here? And yet you say you're a price action trader. Just to me, I was kind of dumbfounded by it. Brian, you mentioned I ought to put the one up that I showed you guys. I was going to see if I could find it here real quick. I know I've got them on the computer here somewhere, but I can't remember where I have them at. But anyhow, you're trying to clean stuff off. You had a series of moving averages ranging from 6 to 330s, which kind of makes a wave if you guys can visualize that. Actually, let me just open that up. I'll put that up if you guys bear with me for 1 minute. I thought I had that chart saved and I didn't end up with it saved on my desktop. Yeah, Gerardo, I was just trying to get another chart open here real quick. Okay, so this first picture here, this was your original chart if I understood correctly on the emails. And you've got the series of moving averages which kind of widen out and come back together and show you where price is consolidating and so forth. And then you were simplifying that down, trying to clean it up a little bit. And here's what the comments were that he made. He says he realizes he's comfortable with trading price action, getting more comfortable with the clean chart, the scalping, but not just trying for 1 or 2 ticks, trying to get a little larger targets out of it, and then working with the money management there. But here's some of the things that he was trying to get out of this was to reduce the indicators even further, eventually getting to just a naked chart if possible, or potentially even no chart. Was also looking at trying to improve the stop locations if possible, to reduce the stop size, trying to gain the confidence to hold on to trades, trying to get the ability to enter breakout and momentum trades, and then improving entries, especially for the counter trend trades. I think when I look at this, to me, and this would just be some suggestions as you're trying to meet those goals. You're trying to get away from the indicators. I've always found it kind of interesting with indicators that we could have a series of red and green or red and blue candles up here, and yet we won't believe them or trust them, and we have to have another series of red and green down here before we trust the red and green up here, or the red and blue up here in this case. And I have always encouraged traders, if you're trying to clean this up and you're trying to get away from this type of stuff, this one definitely doesn't bug me visually as much as the other one does. For some reason, the other one visually was really distracting. Anytime I have stuff start printing over price, I have trouble with it. But I look at this and say, what do you gain from the moving averages beyond what's already there from the price? And this is something you're going to have to look at, because this is the charts you're watching, or this is the setup you're looking at. You have to be able to take each thing that's on that chart and say, what is this telling me that I can't tell from just looking at the price? Is it telling you that it's in an uptrend? Because if that's the case, can you just look at the price and say we've got higher highs and higher lows, it's in an uptrend? Is it a consolidation? Is it identified a consolidation when you see these come back together and narrow down? Some people like this multiple moving average for that, because they say, well, it helps me see where it's going sideways. But see, if you honestly start looking at that and look at the price itself tells you it's going sideways. And this is something that I've just encouraged people when they're trying to break away from that. If you're looking at the highs and lows, and the highs and lows have become fairly even, you're going sideways. And if you're going sideways there with price, your indicators are going to be sideways. Your moving averages, they're going to be moving up together, tightening down. So in a sense, looking at the highs and lows, the prior swing highs and the prior swing lows, you can pull just about anything you need out of there. You take one moving average, and I'm not sure on this moving average, I think you spelled out in there a couple things you were doing. You had some Murray math lines initially. You had this TC trending. Is this the indicator that's on the bottom? Is that the TC trending? Or which one is that's on the bottom? It doesn't. I apologize. It doesn't have a label on it, unless that was on the other chart. Yeah, that doesn't have a label there either. Oh, stochastic modified. Okay. But anyhow, I would say when you look at those, probably a key thing as you're trying to cut that stuff down is you have to say to yourself, what does this indicator tell me? And then secondary to that, is the price itself telling me the same thing? Now, for some guys, they're not going to be able to get away from this. Let's take a guy that does divergence. He looks for divergence on a MACD, or he looks for divergence on stochastics, or he looks for divergence on RSI. If you're looking for divergence, you're probably not going to see the divergence without having the indicator there. So in those kind of cases, a guy may say, no, I have to leave that there because it gives me something that I don't see elsewhere. I still think even with divergence, there's ways to see that in the price action, but that's another discussion. So I would take these things and narrow it down and say, what am I using it for? Is it the actual trigger for the trade, or does that just establish a condition for the trade that you have to see this condition before you start looking for your setup? And find out how critical it really is. One way of doing that, and I would just recommend this as a drill as you're trying to clean stuff off, put up just a clean chart with price, and then take this chart here, put that on another monitor, put that somewhere where you can't see it as easily, and look at price and try to figure out, as you look at price, what your indicator would be doing. Would it be spreading out? Would the wave be spreading out there, or is it tightening up? And then go check this chart here and see if you're right. And as you go back and forth, and you look at price only, and let that be the only thing on your chart, ask yourself, what would my stochastics indicator look like right here? What's it doing? What's my moving averages doing? Where would they be roughly? What would they look like? And you'll probably find very quickly that you could come back over and you'll be very accurate in guessing what your stuff would look like. So if you know what it would look like from price, can you then just in your head say, okay, this is what's going on with it? Now that's, like I say, it's not possible in every circumstance, but the majority of the time when people are trying to clean stuff off, you'll realize that you already know what's there just looking at the price candles, and it's just a matter of trusting it. That's where it traded, that's where it was executed. This is where I could buy it right now. Those are the things that really matter. So, that would be, like I say, probably the best drill you could do is just go straight to price, build the chart, nothing but candles, and go back and say, where would my other stuff be? Guys, I've thought the same thing looking at the tick and the ticky, people that use that for extremes. They're saying, well, the tick's been above zero most of the day. Well, guess what? Look at the price chart. The price has probably been moving up all day. Why do you need the tick or the ticky to tell you that it's been more buyers today acting aggressively than sellers acting aggressively? See, we can frequently fool ourselves into thinking we need 3 or 4 or 6 lines to tell us something that we already know. It just, we view it as confirmation, but in a way it's paralysis. We get so many things on there that we can't even figure it out, can't even see it. Now, as far as improved stop locations, your setup and what you're looking for, and the stop, the thing that you've got to be really careful with, you can get your stop tight enough or small enough that can become counterproductive, and you have to be very careful with that. I lost more money with little stops than anything else I did put together. I went through a period where I was determined that I could get the stops down, and I didn't need but 2 or 3 ticks. I would take stop after stop after stop, and I sit there looking at that going, that it was a $500 stop on a 20 lot doing 2 ticks, but I was like, well, I got to be able to pick that within 2 ticks, and there's no way I could allow a $2,000 stop on that same trade by moving my stop out here. And where I broke that cycle is I started putting the bigger stop, and bottom line, the million little paper cuts, bleeding to death from it, quit. And it was scary, when you sit there and convince yourself that you should be able to do this with 2 ticks or 3 ticks or 4 ticks. It's scary saying, no, realistically, I need to let it have 10. So you come in and you try to reduce the size of your stops. One of the things you're going to have to do is look at the instrument. You're charting the 6E here, and so I don't know if that's the one that you primarily trade. You mentioned that you're trading that. If you take a 5-minute candle chart and put up an average true range on that, look at the size of your average wiggles. And you kind of come to the conclusion that you're probably not going to be trading the 6E very effectively with the 4 or 5 tick stop. I mean, just an average wiggle in a candle You could be 12, 13, 14 ticks on a small candle, 20 ticks on an average candle. And so you try to come in and adjust things and tweak the stop down and tweak the stop down, and all of a sudden you've got a stop that's not realistically going to hold you through any kind of noise or wiggle. You could be right, but your stop is so tight that you're out of the trade when it takes off. And so, you're going to have to look at that very carefully based on the market you're trading, as to how much you can actually cut it. Is it enough to let you hold it through the wiggles that are there? Now, the flip side of that would be making your targets bigger. And again, I think the little Fibonacci, where it shows you where a 1-to-1 would be, shows you where a 2-to-1 would be, one of the most beneficial things you can do. If you throw that out there and say, well, this would get me a really good return, but is it realistic given the current chart for today? Is it realistic to get there? And if it is, then put your target there and let it work. I've always appreciated the analogy that when we take a trade, in a sense, that's like hiring an employee. And we tell the employee what we want it to do, and if it doesn't do it, we fire it. But, in a sense, when we put a target out there, we're telling that employee, this is what we want you to do. Would you tell the employee, we want you to work till 9:30 a.m. and then take the day off and go for lunch for 4 hours? No, you wouldn't do that. You put that employee out there and you get your money's worth out of him, and he works a fair amount of labor for you, and you give him a fair price. Well, the thing that I see frequently is we hire this to do a job, and then we cut it off or we let it go while it's doing the job. We have a guy out, we tell him dig a ditch from here over to that tree, and we come out there and he's halfway there and we fire him and send him home. So I think it's going to be more critical to start looking at the targets and saying, where is the target? Where realistically, given today's target, where can this run to? And if it's going that direction, let it do its job. Don't get wiggled out of that. And you're probably going to find in the long run that that's going to make you more money than trying to reduce your stop size down even further than where you already are. As far as the comment on the breakout and the momentum trades, that is something that some people can do. Some people don't feel comfortable with it. I never really liked it that much. When I sat there and looked at the breakouts, I've always been leery of the failed breakout, like we were talking with Karen the other day with the 5-minute consolidation, and it's like, it's so frequent. It drops out of there like it's going to sell off, and then it goes blasting off through the high. So if you don't feel comfortable with it, I wouldn't worry about it. I think it would be better to take one style of trading that feels comfortable. If you like buying pullbacks, buy the pullbacks. If you like momentum, do momentum. But if you like momentum and you hate pullbacks, I wouldn't beat yourself up trying to do pullbacks. Take what feels comfortable, what feels good to you, and as long as you can find a way to make it work, then do that over and over and over. One of the most successful traders I ever talked with had traded the bond, and he used one basic setup for his entire career. And he said there were times when he was tempted to walk over into the S&P pit, but he didn't. He just went and traded bonds, and he went home. And he had one setup, and he traded it over and over and over. And the guy pulled out many, many millions of dollars. One simple setup for his entire trading career. He found something that worked for him, and it was comfortable for him, and he said that's good enough. If I can make money with that 4 days out of 5, that's all I need. So maybe something to keep in mind. The other styles of trading, we've talked a little bit about the breakouts, a little bit about the momentum trades, and probably addressed that already. Your final comment, you wanted to improve the entries, especially on the counter trend trades. To me, the best way of going about that is looking where you've had a series of lower lows and lower highs, and when you finally break above that, take that next retracement. It is a counter trend trade. Take that next retracement as long as you see the buyers coming in on the tape. If you see the sellers just keep hammering it right down into the low, let it go. It's not time for the reversal yet. But when you've got that trend, that's going to be the quickest change, or the earliest thing you're going to see is take your tick chart, look at those swing highs and lows, and when it finally breaks above a prior swing high for the first time, then you've got your trade set up. When it comes down and you see your buyers come in, now you've got your trigger. That's your entry trigger. Hopefully that helps address some of your questions. If you want me to go further on anything else, feel free to send me an email. I can still address it either through email or here. It doesn't matter either way. And I appreciate your comment about the analogy. I've always thought that way. If you got him out there and he's digging the ditch and he's halfway there, why would you fire him? Let him keep digging the ditch. He'll get there. It's tough, but that's what we have to do. Let me reset this. This one's a little shorter, but Karen is going to go through a setup, and she's been doing this on the crude. She's working at some other markets with this. I think, Karen, you've mentioned you had done this with 6E. You were starting to look at this on the YM as well as a result of our discussions in here. And so I'm going to reset the tape, and then we'll take a look at this, and I'll give you guys a little background. And I'm going to let's just take till a quarter till. Take a few minutes here because I'm going to set Karen up, and she's going to kind of explain what she's doing. So I'm going to have to get her set up where she can talk. It's something that she's found works on any market. And I will tell you guys, I don't want to embarrass Karen or put additional pressure on her, but Karen has probably worked through more emotionally than any 10 of us put together. She hasn't had an easy situation, and she worked her way, fought her way to profitability. And not everyone has been able to do that, obviously. And so I wanted Karen just to speak for us for a few minutes and explain kind of what she's doing. And I don't want to embarrass her or put extra pressure on her, but I do want her, you guys need to view this with a little respect, because she's done something where she came to me initially more profitable than just about any student I've ever worked with. And she's still trying to improve and still trying to refine it. And trying to ask questions, and she's done the work. She's bled herself dry trying to understand this and trying to make it work. So I think it will be really beneficial to listen to what she has to say, what she's trying to do with things, and why she's trying to get something additional out of tape. So let's give it till a quarter of, and then I will start back up here, and we'll just allow Karen to kind of explain what she's doing there. I'm going to go ahead and start the recording back again here. We just did a brief sound check, make sure everything's working. And so we're listening to Karen. She's going to show us some charts. This is kind of a workspace that she has set up for crude. And you can see that with the 4 charts here, there's some different things showing on each one. And so she's going to give kind of a quick overview of what these are. So Karen, I'm going to mute my mic while you're talking, and then you tell me which, you want me to start with the 60-minute, or where do you want me to start?
We can start with the 6. Well, why don't we leave all of it up for a moment? And I think I'll just start, if I could, with some general comments, if I
Sure.
can spend a minute. And let me know roughly how much time you want me to spend. I'll make sure I don't go too long here.
Well, let me ask you guys here. If anyone is pressed for time, obviously you've got the recording, but does anyone have a problem if we take 20-30 minutes and talk this through? Because it's a different way of looking at things. It looks like nobody's got a problem with it. And if somebody's got to cut and run, we understand. We're going to go through this, and then we've talked a little bit about the money management things. And if it runs us a little bit late, it runs us a little bit late, and we'll finish up with the money management tomorrow. Looks like it's fine. So just go ahead and give just a brief overview of what you're doing, and then tell me when you want me to zoom in on a chart.
Sure. I guess first thing I want to do is thank Joel for what he said. I'm really touched. This has been a really interesting journey for me. It's been a number of years, and I don't know what possessed me. Over the weekend, I calculated how much money I had lost trading when I really didn't know what I was doing, and well, it can bring a tear to your eye. And but what I understand is that in some cases you have to get in and jump in and begin to feel all of the emotions and begin to understand your personal tolerance and threshold for pain, and for the things you need to work through in your trading. And I think for all traders, you need to find that for yourself. I sure wished I'd found Joel earlier, And what I found ironic is when I did find him, um, what I realized is I had what I thought were some pretty good setups. But what was my issue was at the moment that I was pulling the trigger, or within a minute or two before I would pull the trigger, I was looking to see if I could find some level of confirmation. And as much as we wish that indicators or some of these other things would do that for us, they don't, because what you need is something in the moment. And I really found in spending a lot of time online that Joel was probably one of the few people that really could share that information, and I also think he does a fabulous job doing that. What I've done over time was start to look at levels, and there is a similarity in how Joel looks at things and how I do. We clearly do it differently, but what I realized after I spent way too much time looking at indicators and oscillators and whatnot, I realized that they gave you information, but more importantly, price usually will turn, or the market will generally turn at a level. Now, Joel's talked about how there are lots of levels out there that where the price may turn. What I started to do was investigate where might be the highest probability places that the market can turn. And so I took virtually all, shall we just call them traditional indicators, off my chart. And by the way, I left one indicator on here because I wanted to make sure that folks knew that it was out there. And if you look at my 15-minute chart, there is an indicator that's called, it's a news event indicator, and it's on the 15-minute chart. And if anybody might be concerned about this, this will alert you to any news 24 hours a day. You can set it to how much time prior to the news release you want to be alerted. There's a couple of these on Ninja's forum that have been really helpful for me, because I get pretty focused on either price action or staring at my charts, and I forget. So just know that that stuff's out there, and I put that out just so you guys would know it's there if you didn't happen to know. And I think if you go to Ninja's forum, this one is for Ninja 6.5. I'm currently running 6.5 because I'm working on converting a couple of my tools here to Ninja 7. But there are those tools out there for both 6.5 and 7. So enough of that. It does take space on my chart, and I frankly have it off to the side, but because I'm more concerned about just the audible alerts. But I just wanted to let you know that was there. Okay, if we go back to maybe just the overall chart, it looks to you, it might look to you like there are a lot of levels on here. What I've started to do, I created a couple of tools, and this really emerged from some work I did with Carolyn Borodin, who is really focused on Fibonacci stuff. I decided to create a tool that would automatically put swings on my chart. And what it will do is look at pivot levels. And as you can see, it also prints the price where the pivot occurred. And it will, for example, Joel, can we kind of move to that 15-minute chart?
Yeah, Karen, let me zoom into that. I also made your drawing active, so you're going to be able to draw on my screen. So if you get talking about levels or something there, you'll be able to turn your pin on and draw. And I would say use the pin out of your control panel as opposed to using the highlighter. It will show up better.
Got it. What you'll see right here is a pivot level at 85.96. When I created this tool, I kind of wanted to be able to look to the left and see how much consistency there was with price. So I found there was a level here at 85.96. This move in crude, and again on this 15-minute chart, went up to 87.49. what my tool does is it will give me a 50%, this level right here is a 50% retrace or 50% pullback, call it 50% retracement, and a 618. I'm working at cleaning it up so they're more consistent in how they visually appear. And what it does for me is it is giving me significant levels as I look to the left, significant price levels. And on major swings, I can know what the 50 and the 618 is. And ironically, Joel was just talking about this. My tool that I built kind of does this for me. These other levels that are pink, I'll explain to you later, the two right here. So if we kind of go back, Joel, can we go back to all four charts? Excuse me, sorry about that. Water. The reason that I started to do this with multiple time frames was, for me, what I wanted to look at is, number one, what were prices that were significant on a long-term chart? So what I'll do is take my 60-minute chart or even go up to a 120 or a 240-minute chart, and I will look at what the key price levels were as I look back in time, because quite often those will be retested. They're just significant levels, and it's good to know where they are. That's what led me to create that constant lines indicator, where I would get alerted to those in advance, because clearly you can't watch all this stuff. Then what I would look for are, it's hard to see on this chart because it's compressed. I tried to get it so that Joel could show you these in sequence. But what I now also have is a 50% level on a major swing on a 60-minute chart. And that, again, is important for me to know, because you might find that that's a level that gets tested. And again, between the 50 and the 618 on a very long swing might be a very nice level to come in and re-enter a trade. So what I've done is I've sort of looked at sequences over time. For me, it's a 60-minute, a 15-minute. I go down to a 5-minute chart. And my 5-minute I put it in black just so it kind of jumps out at me. And I make sure that I know where those levels are, because what I want to also find are what I would call confluence. And maybe you would have a level that is approaching on a long-term chart, and then you would get confirmation on a shorter-term chart. And for me, that increases the probability of the trade. But it still didn't help me with the greatest level of confidence in being triggered into the trade. So now let's go to that 89 tick chart, Joel, if we could. Can you see? Yeah, can you see if you can get that? There we go. Well, Joel mentioned the other day that I had created a Delta tool. I have seen tools like this before. I sure as heck don't take credit for it. They've been out there. I know some folks have created some interesting tools like this. But what I realized was I wanted to try to know, excuse me, what was happening real time with regard to buyers and sellers. Whether you had net buyers, net sellers on a candle. And I also have this coded, color coded, so that I can see if it's pretty significant. If you look here, this negative 137 is a stronger down move than the candle before it. It's a little different color. And what you're able to do is begin to see the momentum building. And what you can also start to see is when the move changes. And I pulled a bunch of screenshots for Joel because I wanted to try to demonstrate this and show what I try to do. And what this tool has done, it was as close to reading tape as I think one might have of something that prints on your chart. And again, in most cases, you want to wait till the bar closes, but in some cases, you can watch that bar build and you can see when it changes from net sellers to net buyers. So what I did is I kind of built my sequence over time. I looked at the 60-minute, the 30, or the 15-minute, looked for significant levels, similar to what Joel does. Looked at my 5-minute chart to start looking at patterns where I'll see maybe a double top, or you'll look for a 50% retracement on a slightly smaller swing. And then what I've tried to do is trigger myself in using my delta indicator. I'm sort of always typing questions in, because what I have found is I believe that I have a fairly reasonable set of setups and I have some reasonable tools. But at times, what I find is that the market will play games with you. And I'm trying to find ways to be more aware of those situations when that can occur, because I have my head handed to me. Sometimes, as I typed in today, and I had this happen to me a couple times last week, when you have these monster moves in whether it's crude, the 6E, any of the instruments where you can get some really nice movement, because I've primarily been a counter trend trader, I'm looking for those places where it's likely to reverse. And I've maybe missed the fact that we are in a killer down move. And if I would have just gone short and stayed in my short the entire time, I could have just used Joel's tool and taken all this money off the table, and I could have Ken buy me one. But I sometimes miss those things. And so I am always trying to keep my charts cleaner. I'm looking to see if I can, in Ninja 7, overlay some of my stuff so that I can have really one chart that will have my significant levels on it, then my 5-minute chart and my delta that I can use along with tape. Now, what I've been doing is trying to teach myself to watch the tape and look at delta and see if I am able to train my brain to see what is happening on tape and peek over and see if what's happening is what I get from my delta indicator. So I guess in a very streamlined way, that's what I do. And what I'm learning from Joel, and I want to continue to learn, is levels that Joel sees, how he looks at the market, areas that he feels are high probability entries for him. I can learn from that, because my basic trade philosophy is to find high probability entry levels, get confirmation on a shorter term chart, and then the third level of confirmation is the tape. Or if you can't do the tape, it would be delta. So can anybody type in just to that point if what I've shared so far makes any sense, or if I could explain it any more to make it more clear?
Karen, one thing you might mention, were you looking in your overall trade strategy, are you looking for like continuation type
Joel, you
moves?
could probably let me know if there's any questions or people are throwing stuff at the screen yet.
Yeah, do you have sound there, Karen? Can you hear me? Yeah, I don't think she hears me. Let me just type her a note real quick.
I had a couple signals on my chart and I turned it off so it wouldn't interfere with.
Do you have sound there now, Karen?
Uh-huh.
Okay, I was trying to talk with you. I think you might have had your speakers off. So, what I was going to mention, just a couple questions. Andrew had asked what you were talking about when you were referring to using my tool. She was jokingly talking about the croupier stick that Ken bought me to rake the money off the table because he felt like where I had $1,000 open on a one lot on a trade. I needed to take the $1,000. That's Ken's motto. You see $1,000, you take 1,000. So she was referring to that croupier stick for pulling money in. Karen, I think something that you might address here, as far as your trading style, when you're looking in these levels, are you looking for momentum, like a continuation type trade, or are you looking at them more for reversals?
I primarily trade reversals, and what I would like to do to get better at continuations, because some of these moves, and I don't know if we can maybe go back to the full screen. I think continuation moves are they're pretty significant too. But I guess when I started working on this stuff, and a gentleman that I had worked with that taught me some things prior to working with Joel was really a counter trend trader, and I realized that I got pretty comfortable with looking at levels, high probability turning points, or levels that might be significant, and try to look at a reversal there. But again, what I'm finding is on some of the markets that I trade, if you can trade a continuation, some of these moves are significant. They are massive, and when it starts to move, it can move for a long time. And I am still timid in holding trades for a really long time, and that's one thing I really need to work on, is getting better at holding trades and being confident and not just taking money off the table. I think that's my demon, one of my current demons. I think that trading, building up here's something that I believe in. It's a part of my plan, and that is, the more consistent I become in what I'm doing, the more contracts I add, which then allows me to hold more runners. But I really don't want to add more contracts until I know that I have the price action piece and my consistency is solid to where I can add enough contracts to really capitalize on the longer moves. But
Okay.
if you now look at this level right here, let me also share one thing if I can. You'll also notice a pink line right here, and there's one right here. What I also learned in some of the fib stuff that I did is you will often get 100% projection on a move. And when I built this tool, or had this gentleman help me, he wrote it, I wrote part of it, and I really wasn't very good, so he finished it. It initially started for me to test some theories as to whether these levels really are significant and whether or not they're worth paying attention to. So one of the best ways for me to try to think about this was to build a tool and see what happens when price would come to those levels. What I found is, I think, as with 50% retracements and 618s, very often you will get 100% projection. And what that is, I will try to do this. I'll do it on this 15-minute chart. Joel, do you mind opening the 15-minute up? It might be the easiest way to do it. What you find is, let's start at this level right here, 86.21. You'll go up to here. This is probably coming back down to a 618. And what you will generally get is a move up. I'll kind of stop it there. It's probably about where it would go, of a equivalent length, this move to this move, from this 618 pullback, presumably, up to that level. And what my tool would do was print that on the chart. And what I very often found is, and sometimes I would smack my head and go, I don't know how they do this, but some of these levels, when you would see it on a long-term chart and then you would go look at the short-term chart, they would almost lay right on top of each other. And so what that's telling me is the big swings that occurred on a long-term chart were being mimicked in a smaller level on a shorter term chart, and somehow those levels became significant. Do I know why? Do I know how that happens? No. But it then increased the probability of me wanting to look at an entry. So to summarize, what I do is I start with my 60-minute chart. I look at significant levels. I use my constant lines with alerts tool to place those levels on the chart so I know when they're approaching. I then go down to my 5-minute chart to see if I have a level that would support that on a shorter term chart, and wait to get triggered in by my delta, which is on an 89 tick chart right now, and then price action. So Joel, does that do you feel like that was a clear explanation? I don't want to go too far into it.
Yeah, I think just the comments, there's a couple of guys have said that they appreciate what you're throwing out there about it. Gary said he's got to leave, which he's been leaving early every day. He has to get out of here. But he said to let you know that he really likes what you were showing there and appreciate your making the comment. And he's looking forward to seeing the rest of it when he watches the rest of the tape tonight. So several of the guys have said to please thank you on their behalf for doing this. Sounds good, Abhijit. We'll see you in tomorrow, hopefully. So a question here on the delta on the 89 tick. Tuba Tom was asking is how you're interpreting the numbers as far as the delta goes.
What that does is it, in that candle, it sums up the net bid, the net trades, as Joel's talked about, the ones that trade at bid versus the one that trade at ask, buyers versus sellers. It will sum all of them up and give you the net. So in a sense, and this was something I shared with Joel when I first talked with him, and I told him this was my initial attempt to try to learn price action. What I knew that you could see when a candle closes, whether it's red or whether it's green or whatever color it is, or whether it closes lower, you still never really knew whether inside that candle they were pushing it to a level. If you were looking at, I'm not sure.
Sorry, I don't know what happened here.
That's all right. I can.
Picture just shut off. So
what I realized was very often when you get to a place like down in here, and this is red, so it might be hard to see. You're coming down to probably a key level, and I wish my chart was a little bit scrunched down a bit. There's a line here, and that was a level that I was kind of watching. Comes down, and it's an area for potential reversal. But what I'm finding, and what I started to realize, is as you get down to an area where you're looking to take a trade, you still don't know when the buyers are starting to step in. I didn't know just by looking at candles, just candle action, whether you've got dojis or whether you have a gravestone doji, you don't really know yet when the buyers step in. And I kept thinking, I'm looking at candles, and candles are representative of price action at a point in time, but you still didn't know whether buyers or sellers were in control. I was trying to find a way to look at this, and I had looked at market delta before, but their candle patterns were pretty busy, and my brain could never process that much information. What I needed was a quick way to look at one number and go buyers or sellers, and it's some aspect of what you get in reading the tape, but just different. So I hope that answers your question, Tom. It is telling you at that point in time whether buyers or sellers are in control. And the way I color-coded them was how significant it was.
Tom answered back here that did answer his question. It's guys, one of the things that I've seen with this, because I looked at Karen's indicator here too. One of the things that I've seen with it is it does give you a bit of a historical perspective that you can't really take from the tape unless you've got a good memory. The tape is blurring by and screaming by, and you can't really remember that well. Then there's no way to recover it or recall it. And so with this, you could kind of look back and see what the net was on a very short-term level. You could go back and have some historical perspective, which is beneficial for that. And I have to say, as I mentioned to you guys when we were talking about this indicator earlier, compared to the market delta, like their volume footprint, this was, to me, very clean and easy to see because you still had your candlesticks there. You didn't have to come back in and try to interpret the way that they display it to you. But, I just want to kind of highlight something here, and if anybody has any questions about this, go ahead. But I wanted to highlight something as one of the reasons I kind of wanted Karen to go through. She's got a very specific method that she goes through things, very orderly in her mind, kind of a linear way of looking at it. And she's some people call that kind of a top-down approach, where they'll start out and they'll get a big overview of what the picture is. And that's kind of like I was telling you, start your day plan out first thing in the morning. You're looking at those longer term charts. What is our hourly trend? What is our daily trend? Where are we at in the big picture? And then she starts drilling down inside of that. But you notice probably the thing that she's coming back to, and this is something that I feel again is critical to her success as a trader, is she keeps coming back to levels. She's taking very similar things to what I do, and I tend, because I am so anal, I couldn't possibly trade off of this black chart. I tend to look at those levels and remember the number in my head, or I'll use her alert indicator and just set the price on it and try not to have lines. But I really think this is something, when you look at why Karen has succeeded as a trader, is she has got a definitive way of choosing levels, and she uses those levels and then has a trigger to get into the trade. Now, as far as the tape goes, as Karen progresses as a tape reader, she may get to the point she will see that delta in her mind and see the delta change in her mind and get the quicker confirmation in her mind, or she may use it this way. But bottom line, either way she does it, I think the key to her being successful with this is that she's got a very orderly approach to it, and she defines that criteria down, and then she just simply waits for the level. There's no reason to jump in the trade, not going to chase the momentum. She's going to wait for that level, and when that level gets there, she's making the decision based on what happens right there at that level. So she goes about it a lot more complicated than I would, but bottom line, she's essentially doing the same thing. It's a different way of going about it. Now, I have told Karen before, and Karen, do you mind if I just comment on your trading?
Oh no, go ahead. And then I was gonna share a few of the things that would probably make them laugh when I keep saying I'm waiting for it and I'm waiting for it, and then I jump in early, and I every once in a while I've been doing it lately. I don't know what it is. I've been jumping the gun. And when you're done, I'll tell you what I think happened.
No, go ahead and throw that out there.
Well, I thought about it, and I made no money trading for a really long time. And then I started making money, and I had sort of a plan, and I took money out each month, and I actually started to find that I started to believe in myself that I could really make it as a trader. And I also realized I came up with a thing that worked for me, that seemed to be logical because my brain works that way, and something that I could follow. But as I got successful, I think that what I realized, Joel, is I got sloppy. I got a little sloppy because it was working. And I thought, well, maybe I can jump in a little early, or maybe I can do this. And then I started getting stopped out. And I thought, you're not doing what you did that worked. And I realized that I was my own worst enemy because I do have a methodology that works for me. It had made me money, and I took my eye off the ball. And sometimes I also think that I got caught in shorter term price action and I lost sight of the longer, bigger trend and wanted to make, I have to work on that myself to make sure I'm not losing sight of what the overall trend of the market is. Because once you break out of an area where whether it was a consolidation area, and that's why I mentioned it to you that one day, once you break out of a consolidation area or an area that seemed to have been significant for a period of time, you're probably going to have a move that's pretty significant. It's going to move with momentum. And don't lose sight of those levels. And sometimes I think maybe I do. So it really got me thinking over the weekend about um, getting all of these tools, as I mentioned earlier, are in 6.5. I've got to get everything done in 7. And my goal is going to be to have basically 2 charts that I'm looking at, and that's it. Because I can get distracted, and I want to make sure that I stay very focused on the things that are important. And although I don't have a lot of indicators, I still have to kind of look at multiple levels and multiple charts and look for my confirmations. And I'd like to take advantage of what Ninja 7 has to see if I can have that help me refine that a bit. So I want to mention one other thing, Joel, if I could, and
Yeah,
then
go ahead.
so I don't forget. I kind of threw this on here because on this 5-minute chart, because I thought that it would be of interest to folks because, as Joel has said, lots of people trade different things. And so what I have on this chart, and forgive all the lines, I know what they all are, but I put them on there kind of for a reason. These levels right here, the dashed lines, it's a standard Ninja indicator, and it's high of the day, low of the day, and it has the open. Not sure how it calculates the open. I'm going to kind of ignore that for now. These lines right here are market profile lines. We've got value area high, value area low, point of control. If you look at these little purple dash lines, these are each the high and the low of the first 30 minutes of the market being open, 30-minute range. And I threw those on there because over time I've looked at each of those. But what I understand is for each trader, you can place those on your chart. You know they're there. Having maybe something else to correlate those levels with and being able to trigger it in, there are plenty of trades out there. And I guess I kind of did this as in response to what Joel had talked about before, that there are levels, there are lots of different levels to trade every day. And you can look at, market profile, you can look at opening range, you can look at all these things. But the most significant thing is, how does it fit in to the larger range of that instrument? And is there something that you can correlate it with to give it a little higher probability? And then how are you going to trigger in? So the reason there's a ton of those lines on there is I had indicators for each one of those things because I have looked at those things over time. And what I just wanted to do is show that if in fact you're a market profile person, which you're looking at value area high, and you maybe have something else that triggers you in, that you start to see it consolidate around here, whether it's delta or whether it's the tape, that's going to be your trigger. So I'm probably done with that, but I did want to clarify why there were so many lines on there.
Okay, no problem. Just a couple things, Karen. Lot size. You were just doing a couple lots on the crude. You were doing like I shouldn't say just, because a couple lots on the crude is like doing 10 or 12 on the S&P, but you were doing a couple lots, and then were you scaling? I think you had mentioned to me in the past you were taking one off and then trying to hold on to the other one a bit longer.
I try to take one off at between 5 and 7 ticks because I'm still at chicken because I get smacked around on crude a lot. Um, and then try to hold my longer one. And what I try to do is look for an area where I think it's going to stop. What you said today was really significant. If you watch the tape, there's so many things to scare you out of staying in a trade.
Yeah.
I tend to look at if in fact you had a big move, for example, maybe from here, this 87.49, you come down to here, of trying to look to see if it's going to come back up maybe to the 50% level. Maybe to take my second one off. You know, I don't trade size like Joel does. I've just still been, you know, getting my sea legs with this and continuing to make money. I know that as my size grows that you can take one off here, here, I'm just using these here, go back up to another level here. You have a lot more flexibility when you're trading more size. But the thing that I'm trying to do in this, oh, I do want to mention this, that has been really challenging for me, is I want to find the highest probability entry points. And Joel, do you mind getting rid of the writing? And I think this kind of goes to the stop thing that we've all been talking about. If you find an area that's maybe going to be a strong level of support or resistance, or you have something like what Joel has spoken of, where you have a double top and it takes it out by a little bit and it starts to turn. The sooner that I can find where that entry level is, the more reasonable my stop can be. If I have to wait to take my entry up here, as we talked about, I've got all that exposure down probably to somewhere, you know, level down in here. So part of what I'm trying to get out of the tape in conjunction with Delta is finding the best way to trigger myself in on a high probability entry level with a minimal stop. Again, on my dome, it's set, I actually have mine set at 17. I didn't have it right at 20. I have had it at 20. I've also had it at 22. It seems like quite often crude will move in 10-cent increments.
Yeah,
And
very true.
so sometimes when I had it right at 20, it would come down and clip me and then just turn. So I had it at 22. But again, stop out even with 2 contracts at 22 cents, that's $440 if you do that twice.
Yeah, it gets spendy quick, and
it gets spendy. And so what my goal is to get my confidence up to where I'm finding those points. My discipline is really in place. My discipline is the thing that I have to work on all the time, and that I'm executing the way I should be executing, and then I'll add more contracts. But minimizing if I have a level that feels to me like there's going to be good, solid support, I feel a little better about that stop will allow me to stay in the trade. If I'm at a level and I've been silly, I've kind of jumped in sometimes and done silly things. You know, this might have been an area that I might have thought it was going to turn right here. I might have gotten in right here, didn't get my first target filled, and it immediately went, you know, it turned. Some of those will happen. I can get out at break even, or I may get stopped. But I've realized that being very patient and waiting for those levels for me that seem to be higher probability has improved my confidence, which helps your emotions, and hopefully that helps you make money. So I'll kind of leave it with that.
yeah.
At that.
Well, let me ask you one other thing, Karen, just for the guys' benefit. You know, and if you don't mind, I'm going to just mention just my own experience with Karen. I have kind of gotten online with her, and I've talked with her on a number of occasions, probably going back to March or so. Karen, you know, you're sitting there doing this with a couple lots and you were running $500 to $1,000 a day profit, pretty consistent, what would
It
that
was.
be in terms of number of trades? I mean, would you
Um,
be doing 5 trades a day, 2 trades a day?
um, it kind of depended, maybe five, maybe a couple more, because I'm not I'm not gutsy enough yet, and I don't have enough contracts to hold them long enough,
Yeah,
which then means I have to get back in and risk my stop. Um, but yeah, it was maybe five. And then I would do a little, I'll do some little scalping stuff. Areas like this, I have kind of learned during certain times of day, that's not an appropriate time, on a chart. That's after the market closes. But there are times in that crude will trade, then it's usually, I'm in mountain time. It's usually maybe 9 to 10:30. Very often it'll just stay range bound. And what I can do, because what I will find is I might have one of my levels, like a 50% level, and a 618, maybe, down here, and it trades in here for an hour. And once I kind of see that that happens, I've realized there are times I can take those trades, and you're only making maybe sometimes 4 or 5 ticks on it, but that's $50.
yeah.
So
Well,
I
there's
will
a
do that. So have I made my number? I would say generally 4 to 10 trades a day.
yeah,
And sometimes I'll have a loss and sometimes I'll have a break even trade. And when I'm really at my peak discipline, um, if I've made my initial target of, I'll even leave it at $400. I'm going to drop it even now and work on some things. But um, once I have my first loss after I've made my target, I quit.
yeah,
Because what I have also found for me is then I get really frustrated and kind of aggravated that I gave that money back, and I'll try to make it back again. And I'm usually not taking an ideal setup. And what my goal has been is to try to be green most days or almost every day. And it builds on some really powerful positive emotional energy, even if it's $100 or $300 or $1,000. If you are green, you start building that confidence in your setup and in yourself. And like I said, I went from years of being unprofitable and struggling, and then I started making money. And then I realized what I did, I got a little sloppy. I probably thought, well, look, I'm making money. Why shouldn't I be able to do this and this and this? And that was not a good place to go.
yeah.
So I'm
Hey,
glad
hey,
I
Karen,
recognized it.
let me stop this here,
Sure.
if that's okay. And I need to
Oh,
reset
absolutely.
the I need to
Sure.
reset the tape. And then if you don't mind, I would like to make a couple comments. Um, Not necessarily to tell you things that you haven't already done, but things that I think the guys should think about just looking at this. And then uh,
And
we'll kind of
and
wrap
Joel,
up.
what I
But
will mention also, after we reset it, and I don't want to let this go too long, is a couple things about the indicator if the guys are interested on kind of what I'm thinking. Okay.
yeah, let me stop this here and reset that, and then I'll be back in just a couple minutes. Yeah, that's fine. And I've got a couple comments here. We've got Marty says, Karen, you're not as bad as Joel. And Marty's mad at me because I wrote him an email and I left the T out of his name and called him Mary. So he's in a huff at me. I assume still. It's been 2 weeks, but he's still not over
Ouch.
it. So
Ouch.
he doesn't like being called Mary. But a lot of positive comments here, and appreciate that, guys. That you're showing some appreciation for what
I really
Karen's
appreciate it,
doing.
and this has been really helpful for me. And I can't tell you guys how much I appreciate Joel. He is had, like I said, if I had met him a long time ago, I'd be in a different place in my trading. But better late than never. And I think we have a great asset here, and to be able to build your own methodology and and whatever that is, and take what he teaches you is what I think it will set people apart for those who are successful traders and those that aren't, because because I think that understanding what the market does at the time that you enter is critical, and the way he looks at things is so it's so powerful. Anyway, thanks guys for all of your comments, and if you do have questions for me, I don't know, we'll talk about it later. I get my email to people. I don't have a ton of time because I work on this and I do a couple other things, but if I can, help somebody for a few seconds or answer questions, I'm happy to do that. And if I can get this indicator to where it's clean and it will work efficiently on 7, let me just ask you guys to type in quickly. Would something like that help you? Do you think that would be of value, or is it more noise? My delta thing, would it be something that would be of value to you? I'm just going to shut off my mic, and I really want to thank you guys for taking the time to listen. And Mary, I'm glad you were able to join us.
That's pretty good, Karen. I've got some good comments here, and Karen, I don't think you can see the comments, but a number of the guys are thanking you for being willing to do this, and a number of the guys said they've got some interest in it. So for anybody that's got some interest in it, let me know, and I'll just forward your email along to Karen, and then she can talk with you directly there.
What I'm going to do is the constant lines that I did, as Joel said, he's more than happy to pass that one out. I think that's critical for the kind of trading we're doing. The one that does the pivots and the 50% levels can be pretty helpful if you're looking at charts and you want to know where those 50 and 618 levels are, and then the deltas. So
maybe what I can do.
Everybody.
Yeah, thanks again, Karen. If you've got your speakers on, appreciate it. So I think probably the easiest way of going about this, if you guys have interest in either one, I was changing a couple things in the video that I had in terms of how to use her constant lines alert, and I will get that out to everybody. And then, for the delta information, if you're interested in that, just send me an email and I'll forward that along to Karen, and then she'll be able to do that. Marty, you're asking, is that better than GOMI CD? I think the difference with what Karen has done here with her delta indicator, as you can tell, she just gives you a number and says this is where it is, and it's not trying to graph it or chart it. It just shows in each candle where the delta ended up. Where GOMI, to me, and it's kind of the weird thing with GOMI, it comes back into the same category that a lot of other indicators do, where you have essentially you've got your chart, but then you have to chart or graph something else to tell you what the chart is, and so it's kind of a different way of displaying the same information. You've got your indicators built in the Ninja that you can put a little bit of a delta up, and it doesn't give you the end result. It just lets you see the red compared to the green, and you've got to come in and say, okay, that's half, that's 2/3. This here actually just gives you a count for what the candle ended up. So it's definitely, Marty, when you're saying you're using GOMI for the same reason she's using the delta, you're basically extrapolating the same thing in a little different format. So I think the consensus here on this, is there's definitely some interest in that, Karen, and the comments there. And like I said, anybody that wants to email me, I'll just forward it directly on to Karen. A couple things I would mention that Karen, she's probably given this thought, and I don't want to insult anybody's intelligence by saying look at these type of things, but I've observed this working with people over the years. As people go back and forth between scaling out and all in, all out, it can be difficult transition to make. And you see some guys like John Carter, Hubert Sinners over at Trade the Markets, putting the trade on with three points stop, but they're scaling out half the position at a couple 3 ticks. It can really get dangerous. And I've looked at that over the years as I've gone back and forth from scaling, whether to scale, not to scale. and how to scale. And I've had more difficulty going from scaling going back to one lots. But I would encourage people to think about one thing if they are trying to scale, is look at that first contract that they're taking off. And you really got to ask yourself, is it adding anything to the bottom line? If it is not at a one-to-one risk reward when you scale out of your first lot, it is actually taking money. In most cases, it is taking money from your bottom line. And you could simply eliminate that first contract. Don't take that first contract's worth of risk. And see, we kind of like it because psychologically it lets us lock a little bit of money away. So when that happens, we've got to stop and look back over the course of 20 trades and say, how much money did I make off of the first lot? How much money did I make off of the second lot? Because in many situations, you'll find that scaling out at a real close target is not helping the bottom line. Psychologically, it may make us feel better, but it may not be putting $100 a week in our pocket for the risk we're taking. And so, I have kind of felt, and this is just a difference in the way Karen and I trade. If I took Karen's entries and ran my management on it, I really think we probably would be doing a couple thousand a day or 3,000 a day instead of 600, 700, 800, 1,000. And it is something that is very critical. And I think each of you, as you're trying to get successful with this, letting those trades work for you is going to be a critical thing. Karen's got all these steps. She had these things before she came to me, and she had her method in place, and she worked her way down linear and went through it all. Everything here was working and successful. And she's still trying to fine tune it, still trying to tweak it a little bit. And it may be that the way she takes them off early, that suits her best, and she's gone through that. And I wouldn't try to talk Karen out of doing it if that's what she needs to do for the trades. But it is something that we definitely have to give some thought to as we're trading back and forth. Is can we tweak this and fine tune it? And I'm going to give you just a quick reason why I say this. I've been profitable for 10 years trading through any type of market condition with this. Worked up to where I trade fairly decent size. I wouldn't call myself a big hitter. But here's what I started to kind of see. I started a project. Ken actually was kind of encouraging me to do this, and I started messing around, and I took a $1,000 account just to see, could a guy who comes in with all the odds stacked against him, could he take a little tiny account and trade it out? Well, my broker knows me, and he allowed me to trade actually $1,500 below where the threshold was for people even still being able to place a live trade. Went to one lot, and the first month, I didn't trade it every day, and I haven't traded it every day. I've traded it very sporadically. I might only trade it a couple, 3 days a month if I think about logging onto that account. But the first month, I had 19 winning trades out of 19 trades, and I only made $600. And I looked at that, and there were many of those trades that were up $200, $250, $300, and I got stopped out at break even. And the mentality going from somebody who can scale out in multiple places back to somebody that had to go all in, all out, I couldn't make money to save my life. I actually felt that there was a reasonable chance that I could easily make a couple thousand a month on that little $1,000 account. But the thing that killed me was going from scaling to not scaling. And you have to manage it different. And the same thing holds true when you go from one lot to two. You really have to manage it different. And so, I was going to get a little more into the management. Our questions obviously ran longer today than I was intending things to go, and hopefully we got everybody's questions addressed. We'll get into the management tomorrow and go through that, because I do think that's going to be pivotal. We're going to go through some additional suggestions for that. So if anybody has questions on the stuff that's out there, throw those questions out there. And again, I don't want to belittle Karen. Like I said, I've had a couple people that came to me that have literally taken millions out of the market as pit traders, as locals, and they come back and try to trade on a screen and can't trade. Karen has come to me more profitable by far than most clients do, and still trying to improve. I do think another lesson that we can take from something Karen said here is she went through a little rough patch, and my personal feeling on it, Karen, I've told you that personally. You've gone through some health concerns, computer problems, some very frustrating stuff to deal with, and that distraction when you're trading, just distracted, is horrible. And you sense that about it and stuff as well. But it's something that we can never get complacent, guys. I mean, you think, man, if I could just make 500 a day, things would be great. Well, you start making 500 a day, and next thing you know, you're cocky and doing something different. Like Karen said, she's changed what she was doing a little bit, and all of a sudden it's not working the same way. So keep those thoughts in mind as you try to go forward. If there's any questions, hit a yes. Throw the questions out there. And in the meantime, I wanted to talk about, and I want to leave this up to you guys what you want to do with it. I had a suggestion as far as getting together a couple weeks from now and taking one day of the 2 weeks, instead of doing the 2 weeks right now, consecutively, take the last day and meet again in 2 weeks. And I want to just leave that up to you guys, whether you would like to do that or whether you would like to just get together in 2 weeks anyways. But the reasoning behind that, if you guys are out here playing around with it, are you going to have more questions? Are you going to want more time to come back in and ask questions at that point after you've been using this for a couple weeks? So maybe you guys give that some thought. Shoot me an email, reply back to me there, let me know what you're thinking. And the other factor, trying to do a live trading day. We've got a little bit of technical hurdle here. I've been fighting the platform at night trying to see how well I can broadcast. And here's the problem I'm running into. If I broadcast a DOM and 2 time and sales and a chart, it's using enough of my bandwidth that if I go into another computer here in my house and log in, it is taking me 8 seconds before my chart and voice come through, versus what it is. And basically, I'm running Camtasia on both computers and comparing the tape, and it's running an 8-second delay when I put up a DOM, 2 time and sales, and a chart. So the more I push through, the slower I get and the harder it is for you guys to track me. So I do have some concerns about that with the live trading. If everybody had a time and sales and a chart and a DOM, things may work out fine. But I just want to throw it out there as an option. If you guys would like to take the day that we were going to do some live trading, come back in 2 weeks, spend another day, additional questions and so forth. I'm happy to do it either way, and I'll let that go to you guys. You guys can just give me some feedback on it. Andrew, your question: are you providing some videos for the drills? I am actually doing that. The reason I decided that there was going to have to be some videos inserted in is just in the delay. It's kind of a strange deal. At times, my voice will come through in about 2 seconds, but the video will come through in 8 seconds, and it doesn't sync up. The GoToWebinar, for some reason, it's transmitting the voice faster than it's transmitting the video. And so if I'm trying to just do this, streaming my stuff through and gesturing and pointing to it, it's no good. So if I tape it, I can tape it live and real, and everything syncs up and everything works good. So that's where I kind of felt it may be more beneficial to just record the drills, record the concepts that we're talking about, like the buyers, the small buyers disappearing and the big sellers coming in, the changes in the tape. It looks like the comments right now, the majority that have responded, I haven't had anybody respond that says they don't want to do another day in 2 weeks. So does that seem like that's a reasonable thing? I don't mind doing a session or letting you guys come in, for the day or something of that sort. But if that would work for everybody, maybe we can schedule a day just a couple weeks out and take the last day. We'll skip Friday session, which I was planning on doing some live trading. I will tape the live trading, put the live trading in the recording along with the drills and so forth. And then we'll take that Friday and we'll schedule that like 2 weeks out. And then that way you guys write your questions down. You're going to have more observations, more questions, and so forth. That sounds good. It looks like that looks pretty much unanimous for everybody that's put a comment out here. So we'll just kind of plan on doing it that way. And then the guys that are watching this on video, it won't matter because they're watching it on video anyways. Well, sounds good. Karen, I want to thank you for being willing to go through that. I know you're not, it's not something you do as far as presenting and teaching. It wasn't why you signed up. Got my dog going nuts out here. UPS must have pulled in or something. Brian, your question, you say your 32-inch monitor is dying, thinking about a 42 1080p. Would it kill you at 3 feet? Your neck will be hurting. I actually at one point had a 42 in here. It's the height, not the width. It's the height that gets to you. You may find it comfortable. I don't know. For all I know, you may be 7 foot tall. I'm 5'9", so I'm not. I'm sitting here at the desk, and I felt like I was in the front row at the theater with my neck hurting, looking up at the screen. It showed up very clear. There was no problem with the text. It was very clear, but there was 2 things I noticed with it. One, it was not real comfortable because the screen was up about 10 inches higher than where I'm used to it. But the other thing that got me was you're looking up high enough that it changes the color. On an LCD, if you look back and forth, the color changes from side to side, and it changed the color. I brought my my plasma in, and the thing that made me nervous with the plasma was the burn-in, because I've got the same workspace every day. And burn-in is not as big of a problem as it used to be, but it's still, if you're doing it with gaming, it will still burn in, and I felt this is probably going to get it pretty close to that same thing. We're going to have, too much difficulty there with it, so I didn't use the plasma. Yeah, the 37. I've thought about the 37s. I actually have a 37 in one of the rooms. I could probably bring it in here and try it, but it's I definitely felt the 42 was too tall. When I looked up, the color didn't look the same as at eye level, and it didn't look the same when I got to the bottom of the screen either. I was kind of sitting in the middle of it, and if I could roll back to 5-6 feet away, it was fine, but sitting there 3 feet from it like you would normally be at a desk, it's pretty tough. Several comments again to you, Karen, thanking you for going through that. It's probably 2 of the worst things that we'll ever run into is presenting something like this to people and calling out trades in front of people. Neither one of them are really comfortable, but appreciate your being willing to go through that. Well, guys, we're going a little bit long again, and I know some of you there were a few that had to bail out, and I know like Pete, I think he's got it the worst because we're starting at midnight for him, and so it makes it pretty late. He has to just catch it on video. But I appreciate all the comments and the questions and your guys being willing to throw your trades out there. Tomorrow, let's get into our management. We'll get the trade management out of the way and try to address those issues. And I will definitely get some trades. In fact, Gerardo, what I'll probably do, I'll probably put 15, 20 live trades on there. It's talk through the management. I could easily throw a couple hours of live trades in there because I do have a number of live trades recorded already, and I can address some additional ones specifically to things we're talking about right here. Think Karen, one last thing, and I meant to tell you this when you were talking about the hesitating. One of the better traders that I've ran into over the years, the guy was he was investing and buying stocks and trading 40 years before I was born. He was able to transition from going down in person to his brokerage, placing orders, to phone orders, eventually transferred over to the screen, trading electronically, and was successful all the way across the board. And he traded an entry method that literally felt like you're stepping in front of a train every single trade. And he was always saying his saying, and he was a crusty old guy, kind of a hillbilly old guy. He always says, "You gotta believe. You gotta believe." There was no reason when you looked at price when he was going short. There was no reason you could come up with not to go long there, but he was stepping in going short. And he made money day after day after day after day doing this. And that was what he always said, you got to believe. And that's really what happens. If we've gone through, we've done the back testing, we've proved it to ourselves, we've been back and forth through our trade setup. We hesitate, we come back, we look at the chart at the end of the day, and it would have worked out beautiful. It's really what it comes down to. You got to believe. It's not that your belief will change the market, but if you've done all the work and you've proved it to yourself in all the testing and all the sim trading and everywhere else, we've got to carry that same belief over into the live trades and just get after it. So, well, guys, hopefully this was beneficial today. If anybody else had questions specific to their trade setup, I did receive a number of other setups, and then guys mentioned that their questions had already been answered, so there was no reason to go through it again. And if there's anything additional, please send it to me. Yeah, Gerardo, that's it. I appreciate that. He says, I started trading live after the day I realized that I will know what to do in the market live. When you realize that you know what you need to do, that's the best strategy. That's where you go live. And Gerardo, I think you were one of the ones that commented on that when I initially asked about trading live or trading sim, that you primarily trade live. And the sim is like if there's distractions and you can't be focused, you're not going to put real money to waste there when you're not 100%. So I definitely think you've got the right tack on that there. Well, guys, thanks again, and we'll see you tomorrow, 12 p.m. Eastern, and hope you have a good afternoon and evening, or morning, depending on where you're at. You bet, guys. We'll see you. Well, I'm watching the YM. I just switched over here a moment ago and trying to get some additional tape reading trades on the recordings just for educational purposes. And what I was looking at, the market had a pretty decent sell-off. In fact, if you look at the the move up, it ran up this morning and then sold off about 100 points. It's gone sideways for the last approximately 2 hours. And I'm watching this, we could draw a level on here, right around 27, 28, and our levels at the top side. And we're kind of teasing these lows here. And one of the things that I kind of like to do at times when I'm trading with these lows is to see if there's any follow through. We had one 10 lot that sold the dead low here. But I like to see if there's any follow through to that downside once there is a push of momentum, and I see that momentum slow down on the tape. We saw here we're spiking down to 67. Right away we've got buyers coming back into it. Here's a 10 lot at 68s. And I think I'm going to go ahead and just get a position here, see if I can pick something up to the long side. Filled here at 69s. What I'm watching with this, I'm going to give it a 10 tick stop. Maybe I'll just give it 12. I'll give it 10 ticks. I don't want to try to catch a falling knife, but I do see a lot of times when we come out of a range that it looks like it's going to break down, and it is a good point at times for reversals to occur. And there was some interest there at 82, 77s, some interest at 68, and there was not a whole lot of follow through on the tape. if that goes 10 points against me, that will convince me that I don't want a part of it. What I'm going to do in terms of targets is I'm going to take some 2-lots and put some 2-lot targets out here. And so I'm going to start taking this off at 79, and then I'll go 15 ticks, and then I'll go 20 ticks. See what I can pick up here. And then I'm going to take my ultimate target and just move it up and see if we do get some kind of a break to the upside. I'll see what I can pick up there. We're still seeing some nibbles to the short side, and there hasn't been a lot of size coming back in and selling that once we broke 74s. They sold 5s, 6s, and 4s with some size. It's enough for them to start taking some profits. Got a bunch of 1s and a couple 2s and 3s. Still no size selling these new lows. Don't like to see it keep punching new lows after you get in it, but bottom line, you make a decision based on what you know, and then you reevaluate later. I think because of where this sits, I'm going to put another order, and I'm just going to combine these 2 orders together. And that way, if we come back up and test this high, that will give me it'll take off a nice chunk at 15 ticks, which is 1.5 for the risk that I'm taking. And then as these orders get filled, this will automatically reduce my stop and my take profit orders correspondingly. I kind of like to stagger things out like this. So I've got a total of 8 lots out here. If those all get filled, that will leave me with 10. If my stop gets hit, that will cancel all of these. So we'll kind of, I guess I'll pause it here and see what I see on the tape here. I guess the size did not sell this on the breakdown to 64s. By no means does it mean that it's over, but it's not attracting big sellers right down here at the lows, and that's something that I try to look at. If we can attract big sellers down here, I'm in trouble. But if it's just 1 lots and just a little flurry of stops, the trade's probably fine. I probably should give this a little more room than that, but it's a $500 risk on the trade, and I think that's enough to say, hey, there is more to the downside if we can't get some kind of a move back up. So I will just pause this and comment if I see something appropriate. The way that I look at this, we still have a fair amount of interest from 1s and 2s. And you have to say most of the trades that go off on the YM are 1s and 2s. But a fair amount of interest down here, 67, 68s, doesn't mean it's over. We haven't seen big sellers trying to crack it down here. And the small size seems to be holding it. We got a 9 lot coming in there on the buy side. We're hitting some lows again. We got down to 63, 62, 61s. I may get stopped out here. We still don't have size. Okay, now you look on the tape, and we're seeing that there's some size coming back into this now, buying those 64s, 65s. It may get cracked, but there's still no size selling these lows. And that's where a guy really gets himself in trouble. When you get size come in selling the lows, that's where they're going to just pound it down. Buyers willing to step back in 64, 65s. Want to see if they can chase it up from here. They're still buying 6s and 7s. We didn't quite get down to this line on the RSI, and maybe I was in a bit early. Probably could have definitely got a better entry just waiting for that to poke below the 30 line. But that's the way it goes on trading. We really need to see some follow through here. I'd like to see some size buying up here rather than just picking it right off the 64s. There's some 3s and 2s. There's a 5. Little flurry of small sellers. Here's a 10 lot bought 68s. Still buying 70s. Yeah, maybe we'll be okay. We'll see if we get enough of a run to make it worthwhile. I definitely was a little bit early on this trade, and it may not work out, but at least they're still buying 70s and 71s, and the sellers aren't jumping back in there with size yet. I see on the the RSI, it kind of poked beneath there. It doesn't really, when I expand it out, it's not quite through on any of them, but it's pretty close. I'm going to turn that chart trader off for just a minute, and we have the divergence there that we've talked about in the workshop, and it probably got me in a little earlier than I needed to be, but there were some buyers that came in here where I picked it up, and sometimes that's enough to make you take the trade, and you just hope your stop holds. It's moving slowly enough. I didn't feel like I needed to risk 20, or 15 even, to know that I was wrong. So we'll see what they can do with this. We still have buyers coming in here, buying 74s. That's always encouraging if they're willing to buy it up a little higher. No sellers coming onto it. Right now we've taken $100 profit, and if I close the trade right now, it would be a little better than a 1-to-1 risk reward. But I would like to see if I can pick a little more out of the trade. I don't really have anything that I can move the stop up. We've got a little bit of selling, came in at 78s and 73, 72s, but it was not able to push it back down into us. Still haven't seen much for big buying back up here now that we've moved back up. And I would like to see some buying if we're going to get through this high and have a chance to get a runner out of this. We would need to see some big size coming in that's willing to buy this as we get up into these highs. We haven't had any buying for about 11 minutes of any size, and that was down at 74 on the way up right over in here. I think at this point we've kind of got our onesies, twosies just pushing it back and forth. There's no size coming into either side. Haven't seen much of anything bigger than a 5 lot go through for a good 10 minutes. Well, it's kind of toying with the stop there. We're down to within a tick. We're still not seeing the much of anything for selling. We had a 35 lot sold 72s, but it didn't really have an impact. It just popped right back up. I kind of think the thing is just toying with me now. I got within a tick of the low, a tick of the stop, and now I've got within a couple ticks of my target. And I guess all you can do is watch and see what happens. Or you can chicken out and just take your money, but I'd like to get a little more out of this trade if I could. I kind of like the price action here. And we didn't come back and make a new low, and it's kind of basing sideways. And I think what I'm actually going to do is I'm going to swap these two orders. And I'm going to put this back in here at 15. And I'm going to take this one back in here at 20. See if we can pick a little more on this trade. By the way, that's something that you couldn't do if you were trying to move your T1, T2, T3 around if you were using your ATM strategies for management, because these are orders that are placed into the active strategy, and yet they're just limit orders. I can do that, and it doesn't cause any issues. There's no problems with doing that. It won't let me change the size of them, but I can move them around, and I can't put my T2 below my T1 and so forth, if that makes any sense. I'll probably have to just edit that out later because it's probably a dumb thing to say. I guess the bottom line, you can't take a T1 and move it above your T2. They have to fill sequentially, but you can take a sell limit if you add an additional orders in to manage a multiple lot position, and you can move those around and change the order that they sit. So I will watch this here, but the reason I switched that, I do kind of like the price action. It didn't come in and make a new low, and we see that kind of narrowing down. And I may regret it, but bottom line, it's a free trade at this point, and we'll see if we can get something out of it. But what I'm seeing is that this, as it's trying to move up, is definitely kind of consolidating and edging its way a little higher. We still haven't had much of anything for sell interest. We had a seller at 72 and 79, but they came right back after it and bought 78s, 4s, and 6s. So that kind of bodes well for breaking more to the upside. So we got the 85s, and I did not get the recorder back on quickly enough. We'll see if we can pick up our 20 points here at the 89. Things so far looking pretty encouraging. We still got some size up here buying 83s, and no sellers jumping on it at all. Everything that's being sold is small size. I'll just center this, and I don't want to trail the stop up too aggressively, but I'm starting to run out of time. Okay, so they punched it through 89s. Had a nice flurry of prints there. Still don't have any big size committing to it. And I'm going to go ahead and just move my stop up and try to lock in 10. I'm running out of time, and I've got to be leaving here soon. So I've got plus 10, plus 15, and plus 20. So it leaves me with 2 lots, and at this point, I'm going to just let this manage the position. I've got to go get ready to leave. I'm heading down to visit a friend in the hospital, and I'll just either let this stop out. I think as far as targets go, I'm going to just move this down, put this up like into these highs, just shy of these highs, and see if we can get back up in there, and then I'll just let that hit one or the other. I thought it might be beneficial to come back and look at this on the basis of a 5-minute chart. Would we have even taken that trade on the 5-minute chart? Was there anything there on the price action on a 5-minute chart that would have made us get into that trade? And you probably would say, boy, it's not likely. And yet it was very visible on the 89 tick and on the time and sales. We had a series of candles that was selling off. It was breaking down through support. And to come back in at that point, right as you're breaking support and having a big aggressive candle, is kind of an intimidating thing to do. It's one of the reasons I don't really concern myself with that longer chart. At times it's nice if you can get yourself in line with the trend, but with my mentality, I like to come in there and scalp for reversals that may be taking place within 2 or 3 candles, and I don't want to be distracted by that bigger viewpoint. But here's what I see with the trade. When we got our entry here, and let me just zoom in on this a little bit. It was selling off very nicely, but at the same time, there were buyers that were stepping into that. And we took a little bit of heat on the trade before it popped up and got the first target at a plus 10. Got the plus 15, got the plus 20, and price subsequently rolled over shortly after I left and quit talking, and stopped that out at plus 10 on the trailers. Price continued to go sideways from that point. But I think one of the things that I really appreciate about this trade setup is that it gives me something to do. It gives me something to think about. I'm not coming back looking at a candle every 5 minutes, but it allows me to think a little bit. And you have to say, in that bigger picture, probably no way you would have ever scalped that right there. If a guy was looking at this and saying, hey, was this increasing volume? Yeah, the volume was a little higher on those 2 candles. So a guy that was trading volume might have picked it up over here and not had the heat. And I would have freely acknowledged I was in that trade a little bit early. But just probably trying to push it a little bit for the sake of recording trades. But bottom line, I had 10 ticks risk. I took off almost half the position at 20. And everything else I either got at 10 or 15. So I guess I could just open up the control center. And what I'm going to do is just bring that in. This was my trades for today. And I'm going to look at that because I had one other trade that I took on gold as well. But I'm going to just turn off the other instruments, and I'll just turn on the YM so we can see that trade alone. We'll generate that report and then go back to our basic view. That trade, it was a $500 risk and it was a $670 gain. When I look at the commissions on it, I went ahead and I just factor in the commissions very high on the YM. It actually only cost me right at $2 because of having a seat lease. So the actual commission cost was 20, but I just have it factor in just to remind myself that commissions are there and they are real. So one trade, I don't know what it was. The worst it went against me on that trade was $350. If I would have held the whole position, the best that it went before it was closed was $1,100. So it was definitely a good risk to reward ratio. Was in the trade a little longer than I like to sit. I don't know why this is showing 15 minutes because I got in there. Just go back to the chart for a moment. I got in that trade somewhere right around 9:44, 9:45, and it closed it out at 10:40. So it was about an hour. I don't know why it doesn't show the time. Maybe it counts that for the first target for the time in trade. But anyways, I will put this up. I hope that it's beneficial to you. I am always interested in comments or questions. So if you have questions about it, please don't hesitate to ask.